making serious progress at a time of these kinds of negotiations.
It's an original path, and I'll be honest, like you, Lisa, I just simply don't get it. What's the auto response? And can we just say that we're in early days of it could be weeks or months? I don't know.
It feels that way.
Yeah.
The Detroit Three just looked dazed and confused.
We mentioned NHS and the doctors here in the United Kingdom. Times of London this morning. Are they going to order the junior doctors, the interns and residents back? Here, there's a story. I'm not sure what the story is in America.
It's a very different labour market. Yeah. Lisa's going to go through the day ahead for you in just a moment. Just to touch base and give you a snapshot of the price action currently. The equity market elevated by 0.1% on the S&P 500. Still in the 430s on a 10-year. Yields up by a single basis point, 431.66. Lisa, crude, WTI, 92.63, up by 1.26%.
Yeah, the big mover is everything else is in stasis ahead of the Fed meeting. Today, President Biden is heading to further clog up traffic in New York City at the UN General Assembly. He's going to be speaking reportedly this morning at some point. Curious to see how he tries to imbue this event with some relevance, as a lot of major leaders of other nations did not show up. Then at 1 p.m. Eastern today, we do get U.S. Auctioning off $13 billion of 20-year notes. These tend to be messy auctions. Very curious to see what this does to longer-term bond yields at a time where you already see it creeping towards some of the cycle highs. And today, there's so many meetings and conferences on the sidelines of the UN General Assembly. I mean, it's just all these sort of, yes, exactly. Yes. Bilats. Would you like to have a bilat with me?
No, the bilat this afternoon.
Isn't this our regular bilat?
The bilat
is
the UN this afternoon. The UN this afternoon, the bilat is Newcastle AC Milan. That's
is that
the
so?
Are you coming round to my room? We're going to watch that together.
I got to go to the dark side. Our boys from Arsenal over
You can go to Janet Yellen's room because she's holding a bilat. Actually, she's speaking at 4:05 p.m. Eastern at the Transition Finance Action Forum. There also are other speakers, including European Commission President Ursula von der Leyen, HSBC CEO Noel Quinn. Very curious to see what the word is on China, because you have the German Bundesbank coming out yesterday and saying it's really China that's the cause of our problems. It's our dependency on China. And Janet Yellen yesterday said there is no way that the U.S. and China can decouple. You put these two ideas together side by side could make for some interesting tensions.
Something tells me Noel Quinn's not going to come out and say the problem's China over at HSBC.
Probably
right?
That's a safe bet.
Yeah, I think that's a safe bet. The complaints about traffic in New York yesterday, text after text yesterday, Manhattan just an absolute mess.
It was a mess before, and then it's worse.
Nuts. Matt Miller, my good friend, Matt Miller was meant to be covering the Open for me back in New York City. He forgot that the UN General Assembly was on, drove his Porsche into Manhattan for the UN General Assembly and almost missed the top of the show.
Okay.
Isn't that classic Matt Miller?
Are you having schadenfreude? Yes. Also that it's a Porsche. Miller. I mean, come on, really?
Classic Matt Miller. It's a problem. Jennifer McKeown, Chief Global Economist at Capital Economics, joins us around the table. Jennifer, good to see you in person. This is lovely. $95 crude is not lovely. How much of a problem is that for these three central banks that make decisions this week?
Yeah, it's absolutely a problem, but you're right to point out that it's a problem both for inflation and for growth. And which one do you worry about? Which one do you think about?
Which one do you worry about?
Inflation at the moment, particularly from the Fed's perspective. It doesn't look like we've got a major issue with the economy at the moment. The economy's been relatively resilient, surprisingly so. The real concern, I think, is that this feeds into inflation expectations and starts back off kind of a wage price spiral that we hoped was gone in the US and was fading. I think for now, it's not a major issue. It's not a game changer, but it's certainly something they'll have their eye on.
The theme today of OECD in Paris coming out with a global readjust, and we're going to speak to them later, a very important conversation. But let's get out front. You people write incredibly trenchant notes, broader 60,000 footnotes. I want you to talk to our audiences in America right now about the worry of an outright global slowdown. How far are we? Alarian years ago told me 3% GDP or lower is a global recession. Are we there?
We're certainly in a period of global economic weakness already, I would say. We know that the Eurozone has been stagnant for a while. Germany's in recession. UK has just had a fall in GDP. The US, I think, is a relatively unusual example of economic resilience. China, too, really quite soft. So I don't think we're in a recession, but we're in a period of...
So what's the strategy to get out of this? My strategy is this really isn't in the textbooks. It's sort of new territory, granted World War II and World War I and all that, but in this new territory, what's the combined strategy to get out of it besides FaceTime at the UN?
It's extremely difficult. I think a lot of our economic models just aren't working now. The pandemic's just thrown them into disarray. We don't really know where the economy stands, where any of the major economies stand relative to their potential. So how much inflation pressure is being generated, which makes it very, very difficult for the central banks, which I think is why they're just very much data dependent at the moment, watching to see how hard the tightening that they've already implemented is hitting their economies and whether inflation pressures are fading.
Which is the most important central bank meeting for you that we're going to get over the next 4 days? We're going to get the Federal Reserve tomorrow, the Bank of England on Thursday, and a whole host of others, and then the Bank of Japan on Friday.
Yeah, I think, well, the Bank of Japan's interesting suddenly again, but I think the Bank of England more interesting this week just because it's facing a really different situation to the US. Wage growth above 8%. The unemployment rate's coming up, but that doesn't really seem to be tempering wage growth yet. Core inflation still very high. We're looking for tomorrow to see whether core inflation starts to edge down. If that doesn't happen, if we see another rise in core inflation in the UK inflation data tomorrow, then I think we could be looking at a 50 basis point hike. At the moment, we're penciling in 25, but I think that's where the risk lies.
What would the response be like to a 50 basis point rate hike?
I mean, well, it would come as a surprise, but not a complete shock, I don't think. It's pretty clear that there's a major inflation problem in the UK, but that's tempered, of course, by the fact that GDP fell in the latest data. So I think the Bank of England is going to try and look a bit forward and assume that this will start to bring inflationary pressures down, but with the oil price so high as well, with wage growth still very high, it wouldn't be that surprising if it decided to err on the side of caution.
Dominic Constam over at Mizuho talks about a fast and deep cut once the Fed goes. Do you agree that the glide paths of monetary accommodation, I mean, we've had so little history of this in the recent decades, can it be fast and deep when the central banks blink and go?
Yeah, I think in the US case, it probably will be next year. I think for the US,
what about in the euro? I mean, John's been better at this than me, but the euro, on a nominal GDP basis, where the euro ECB is just extraordinary. Can they cut fast and deep?
I think it's less likely for the ECB, unfortunately. Wage growth has been really sticky historically. It's been sticky and low previously, but I think now that it's increased,
this
there's
is
a real
not a
risk.
small matter, John.
Bank of France governor spoke earlier on this morning, said we have the right dose, but we have to take the medicine for a sufficiently long time, and we will see the deceleration of inflation. When they say we have to take the medicine, if it's not a recession in Germany and stagnant growth, what does that look like in Europe?
Yeah, I think unfortunately it's just for longer and illness for longer to bring down these inflationary pressures. The ECB, this is really familiar rhetoric from the ECB recently, that it seems like they're at the peak. We think they're probably done hiking, but that it's going to be a relatively long period at that higher rate, which the Eurozone is really not accustomed to, so it will be interesting to see and difficult to tell.
Deutsche Bank called this a low conviction pause, I think. Is that what you would call it? And when I say low conviction pause, I don't mean that cuts are about to come, that maybe more hikes are.
Yeah, I think that's probably right. We're not expecting any more hikes, but I think if you see core inflation rise again in the Eurozone, if there's any evidence that this high oil price is starting to feed through into wage negotiations, then absolutely you could see another hike from the
We say this every single morning at the moment, TK. What a difficult moment for the Europeans, for the ECB, given this backdrop at the moment.
The fancy talk at UCL that Jennifer would know is they don't have the degrees of freedom that the United States has. And the United States has it because of innovation, technology, somewhat demographics, even somewhat immigration. And over here, they just don't have those impulses.
Jennifer, thank you. Jennifer Michione of Capital Economics. We need to build on this as well. New forecast from the OECD. Bramo, growth's going to ease to 2.7% in 2024 from a already subpar global growth expansion of 3% this year. The OECD had this to say: while high inflation continues to unwind, the world economy remains in a difficult place. We're confronting the double challenges of inflation and low growth. Lisa, we're going to catch up with the OECD chief economist in about 5 minutes' time.
And really, this raises a question that we were just talking about with Jennifer Michione, which is, what is the role of central banks? What is the role of rate hikes at a time of stagflation? How far do rate hikes have to go if they're not working?
They become overcome by events.
Well, but at a certain point, how effective are they if some of the inflationary pressures are being driven by things other than the flow of money? That, to me, is a real conundrum that the ECB is facing right now.
It varies country to country, but what I would suggest is OECD was out front in this, and the IMF this morning. Pierre-Olivier Gounache at the IMF looks like a genius this morning. off of that April World Economic Outlook where they really struck people out to 2028. What I find fascinating is how do we get to 2026? Is it the same growth model or non-growth model?
Have you seen the call from Bernstein? 2.5% on a US 10-year. We've spoken to some bulls recently, Morgan Stanley, BMO, Wells Fargo. 2.5% is a new one.
Well, and Ellen Zentner thinks that the next move for the Federal Reserve is going to be a cut in March of 2024. So if you start talking about the potential for rapid deceleration, that means the lag effects haven't taken effect, and you're going to see them.
We'll have to revisit that to the Fed show tomorrow, but there's a whole set of I can't get it out.
You've got it.
Disinflationistas.
Grandma, don't help.
Hold on a second. What was that? What was that last one you did?
When has he ever helped us? What are you doing?
I'm trying to be nice. I'm
Coming
London nice.
On those OECD forecasts, Claire Lombardelli, the OECD chief economist, on their interim economic outlook. Live from London. Good morning.
David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
It's also, in many areas, a win-win relationship in the sense that our trade and investment flows produce gains for China and gains for the United States. And much of it is uncontroversial, should thrive, and it would really be disastrous to try to decouple from China.
It's not decoupling, it's not de-risking anymore. It's diversifying. Treasury Secretary Janet Yellen speaking at a fireside chat at the Clinton Global Initiative with the former Secretary of State Hillary Clinton. We're diversifying, Bramo.
Yeah.
We're not decoupling. Has the administration said it enough times to believe it yet?
What does it mean? I don't really understand what we're supposed to believe because right now it's not very clear what exactly the marching orders of diversification really are.
Decoupling. They're scared of saying that word now, aren't they? Decoupling.
It is a very confusing time for policy between the U.S. and China at a time where you can't just make a sudden fissure and you don't want to start a war, but you have to somehow deal with the fact that there is a rising amount of geopolitical risk. I mean, the Bundesbank went straight at it today.
Let's pick an industry. EVs. Are we decoupling? Can we decouple? Can we decouple those supply chains?
I mean, if Tesla were speaking about this, if Elon Musk had anything to say, no way. This is something that's absolutely instrumental to his business.
The German manufacturers?
They are going to say, we're scared, we don't know what to do.
Precisely. And the US right now, can we please just have some kind of contract negotiation with UAW because it feels like no one's at the table anymore. TK, the Detroit 3 have got a new deadline. It's noon Eastern on Friday. The UAW president wants to see serious progress by midday on Friday, and if we don't, this strike gets bigger and maybe even goes on for longer.
Who's next, I think, is the big thing. Lisa had that chart a couple days ago of increased strikes in America, and it's back decades. I mean, where we are, I don't think we realize how, it's not that this is original, but we haven't seen it for 20, 30
I'm not
years.
just thinking about people who are in unions, TK. I'm thinking beyond that. The signalling effect that you get beyond this. A 20% offer over 5 years, 4 years. And Lisa, at the moment, there is just pushback after pushback from this union. What's the signal effect you get from that, away from union membership, just to an everyday worker who's going to go sit down with their manager at the end of the year? What does this do for those negotiations?
Jeff Yu from BNY Mellon said it really well yesterday. And he said, basically, the union is gambling. The labor market is still very, very tight. And that is the question. If the rank and file outside of unions feels the same, that their job is crucial to their business and cannot be replaced, well, then they will go in there and say, look what the UAW is getting. We want a piece of that too.
TK's taking notes for his year-end evaluation. Equities on the S&P 500 here, positive by 0.16%. There's a little bit of a lift here. It's a quiet start to the week on Monday, arguably a quiet start on Tuesday as well, going into the Federal Reserve tomorrow. 431.46 on a 10-year, yields up by a single basis point. Earlier on today, $95 crude. At the moment, WTI's at 92.75, we're up by 1.4%, and the euro totally unchanged, just in at around 107, 106.94. Some fresh forecasts this morning from the OECD, forecasting global growth will ease to 2.7% in 2024, marking the weakest annual expansion bar the COVID-hit 2020 since the global financial crisis. The OECD writing this after a stronger than expected start to 2023, helped by lower energy prices and the reopening of China. Global growth is expected to moderate. The impact of tighter monetary policy is becoming increasingly visible. Business and consumer confidence have turned down. And Tom, the rebound in China has faded. So the tailwind at the start of the year has turned into a headwind at the end of the year. Crude and China, two of the aspects of that call.
These global institutions in Paris, the OECD, the IMF in Washington have been out front on this. I'll be honest, folks, they've really done a bang-up job of being cautious about a global post-pandemic boom. Joining us now, highly qualified, is Claire Lombardelli, OECD chief economist, who has done her work in the crucible of United Kingdom economics, which is worst job on the planet. We welcome her this morning. Claire, I'm absolutely fascinated if you can extend out your caution into 2026 and 2027. Pierre Olivier over at IMF was able to go out to 2028. Can OECD get halfway there and move out into 26 with a global caution on growth?
Thanks. We're not going to give you forecast numbers for those years, but what I can tell you is that what we're seeing at the moment is weak growth. We're seeing it this year, we're expecting it next year, and without policy change, actually, we don't expect the levels of growth to pick up rapidly in terms of what we need to see in medium term to get economies growing again.
We have scheduled later this week David Folkers-Landau of Deutsche Bank, and he's made real clear fiscal stimulus and a reach beyond austerity is important. You've lived it in the United Kingdom. Are we being too austere? Do we need a global fiscal stimulus at this moment?
No, we don't think that's what the global economy needs at all. In fact, it's important that fiscal policy works in collaboration with monetary policy and certainly aligns with it and doesn't conflict with it. What economies really need to get growth going is structural reform. It's changes to things like trading patterns. We need to, trade should be driving global growth, and we're just not seeing that at the moment. We also need countries to be undertaking structural reforms to get more of their people into work, extending working lives. We need to be invigorating reallocation across economies. It's structural reform that can drive growth, and that's what we're recommending.
What the OECD is describing today in their report is basically stagflation. And it's something that's concerning at a time when people are wondering, how do we get out? And whether monetary policy is the effective tool to do so if it hasn't been as effective as people expected to this point. Claire, do you think that monetary policy has the same effect on inflation in a stagflationary type of environment where price increases are being driven by things outside just simply the flow of money?
No, we're not predicting stagflation. I mean, we've got low growth. You're right, growth is low, but there is high inflation. And actually, we are seeing that monetary policy is working. It is working its way through economies, and we are beginning to see the tide turning on inflation. You know, headline inflation is coming down in some countries, also core inflation. I mean, you're right that there's a lot of uncertainty around monetary policy at the moment, quite how powerful it is, quite how long those lags will be, as you might expect, given a very long period of very low rates. Monetary Policy Act, it is harder to judge quite how powerful that is and how far it needs to go.
On a policy level, on a fiscal policy level, how important is it to your forecasts to see some sort of, let's use the Biden administration's word, diversification of supply chains, or what we're seeing from the Bundesbank yesterday saying that one of the main risks to the German economy is its interconnectedness with China? How much is that your base case, a diversification, or to use another word, decoupling with the Western world and China?
So we are not forecasting a decoupling, as you call it. What we are worried about is the amount of trade that we're seeing and trade intensity, which has stopped growing. In goods, we've seen a real slowing in the increases in trade, and that is a worry. And we would caution governments from going further in that space. Of course, there are issues around security concerns, and it's right to think about that. But actually, the vast majority of trade, we should be seeing greater trade integration. There's a lot more scope for services trade. Those can really promote growth, can promote prosperity, and that's what we would encourage.
Claire, appreciate the update. Thank you. Claire Lombardetti there of the OECD. This call on monetary policy is an interesting one. Limited scope for any rate cuts well into 2024. That's the call from them, Lisa, well into 2024. So all these calls about Q1, Q2 of next year, they're pushing it right the way out to the end of next year.
Which is what we heard from the French central banker earlier this morning. I don't know if that's applicable, though, in the United States. And we heard that from Jennifer McEwen. We heard that or read that in Ellen Zentner's note, where she expects the next cut or the next move to be a cut in March. Is it different? Is the disinflation somehow more powerful in the U.S.? I don't know. I don't know if we're going to see a change because of oil prices and where they are now.
Well, I don't think we think that all rate cuts are created equally. What are we cutting rates for? Because inflation has come down a bit and they want to maintain restrictive levels by basically focusing on the real rate, one. Or two, growth just collapses and they've got that space to cut more aggressively, which is what Tom indicated. I think we need to get into that. When you get the rate cut call for next year from various banks, Lisa, why is it? Because not all rate cuts are equal.
If you have it because growth is collapsing, that's how you get to AllianceBernstein's 2.5% on the 10-year.
250.
Exactly. So this is sort of what we're looking at, with some people gaming that out.
Max Kettner, HSBC, around this table. He got it right this year, big time. He was bullish, constructive on the outlook. Has that outlook changed? The man from HSBC is just around a corner. Equity futures on the S&P 500 positive here by 0.1%. Live from the City of London all week. This is Bloomberg Surveillance.
investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000, 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Let's take a sneak peek at the price action just briefly. Equity futures on the S&P 500 positive here by 0.1%, a little lift. I'll keep this brief. Got a fantastic guest around the table with us. The NASDAQ up by 0.1% as well. In the bond market, 2-year, 10-year, 30-year shaping up as follows. Your 10-year came within a basis point of a cycle high just yesterday. 431.26 this morning, up a single basis point into the Federal Reserve tomorrow. The euro just short of 107 this morning, 106.95, positive 0.04%. I want to get straight to it. Under surveillance this morning, it's this one. It's in the commodity market. It's crude, extending its rally with Brent, touching $95 a barrel for the first time since last November. Crude surging more than 25% over the past 3 months on the back of supply cuts from OPEC+, leading to a flurry of predictions that the global benchmark could hit $100 a barrel this year. One of those predictions around this table, TK, just yesterday, and Rita Sen of Energy Aspects saying triple-digit crude by Halloween.
Yeah, but it's a different $100 than the last time we were there. This is based on post-pandemic demand pickup is the heart of the matter. I know the focus is on Saudi and supply dynamics and that, but this time is, I'm going to go with the this time is different camp, and everybody's got to adapt and adjust to that. I'm going to guess Neil Dudd's going to say, the world's not going to end. We'll get used to it.
What I find interesting is when you read some of the commentary, there is a belief sort of the way that there was about inflation being transitory. There's sort of a same kind of belief in the oil community about energy prices, basically saying this is only for the November contract. But then if you look out further, you can see that they actually do come down because this is being driven by Saudi Arabia. If it is proven that it is being driven by something more demand-driven, the way that you're talking about, Tom, there might be a different, more sustained response in markets.
On a microeconomic basis, high prices will solve itself. You bring it up, you get $5 a gallon gas, you get $9 a gallon petrol in the United Kingdom. That's going to solve the problem. Demand comes in. But what about EM? What about a burgeoning post-COVID Asia? That's what I would watch.
Tom, you're far better at this than I am, but energy demand is fairly inelastic, isn't it?
Yes.
Fairly price inelastic.
Particularly down to the distillates, which
isn't the trade-off elsewhere?
Yeah. No, it's hugely inelastic, and Amrita Sen and others would say if you got to get away from the financial media, focus on the fixation on WTI and Brent, and look at the Steve Shork world, the distillates
diesel.
And all that.
And diesel prices are shooting higher, Bramo, in a much bigger way. Chevron interview, Mike Wirth, Alex Steele, Guy Johnson, fantastic yesterday. You should take a look at that if you can on Bloomberg.com. Can we live with triple-digit crude? I want to get to this story. UAW imposing another deadline on labor talks with Detroit's big three automakers, saying it will expand its strikes at noon Friday if, quote, serious progress isn't made in negotiations. A union rep, Lisa, said no new offers had come in since it made proposals on September 14th. The union is seeking a 36% pay raise, Stellantis offering 21%, Ford and GM offering 20%. Do you want to define what progress is? by noon Eastern on Friday?
Not particularly, no. I don't want to define that. Any other questions? I mean, this is the issue, is that we have no idea what that means. We don't understand what exactly is actually going on with respect to the negotiations, whether there have been new offers put on the table from Ford, GM, and Stellantis. And so at this point, is this basically carte blanche to expand something and prolong something that some people are trying to game at? I'm just going to keep talking. That people are trying to see, will this have an effect on inflation as well as potentially on growth?
It's an odd skill on Bloomberg surveillance, isn't it? Just to keep talking when Tom's interrupted. Story of the last 24 hours. We have questions. Search teams finding wreckage of the missing F-35 fighter jet that mysteriously vanished on Sunday. The jet disappeared after its pilot ejected from the aircraft during a training mission in South Carolina, leading to an extensive search that involved teams from the Marines, Navy, Civil Air Patrol, and local law enforcement. The debris was found around 80 miles northeast of Joint Base Charleston. Tom, we have questions. One is, how on earth did this happen to begin with, and how did they lose track of it?
Engineering, they lost track of it. The transponder, whatever it's called, went out. And, they found it a couple days later. I got to admit, it's odd, but what's more disconcerting is the grounding of jets, and I'm not informed on this, but there's been a series of accidents with $80 million pieces of hardware. That's what I would focus on.
Okay, the $80 million, that's what I want to focus on.
Well,
it actually could be $180 million, some of these aircraft.
Yeah.
If you look at the actual F-35 program or this particular type of plane, it's like insane. It's like $450 billion contract that the U.S. has to develop these planes. So you have an accident. Oopsie, I think I just blew $100 to $200 million.
I look at the aircraft and I go, the truth is out there, but so are lies.
I'm sorry. Where are you going with that?
X-Files.
What are you suggesting happened here on Sunday?
I don't know. Scully knows. Mulder doesn't know.
Move on, TK. Let's get to Max.
Joining us now is someone that makes you lean forward. It is multi-asset strategy, but mostly he is Senior Vice President, Courage to Stay in the Market at the Hong Kong and Shanghai Banking Corporation. Max Kettner darkens the London door today. What is your new outlook? What is the nuance of the last few weeks as you look forward into 2024?
I think some of the nuances you guys were talking about already, right, is oil prices, energy prices. Perhaps that changes a little bit of the narrative, right? That perhaps inflation does pick up a bit more in the US, right, towards Q4. So that's not particularly great news for a Goldilocks scenario. I think the nuances is also going into Q4. What can destroy that Goldilocks picture, right? Because we're all talking about all these horrible things, right? Like, things like student loan repayments and are we hitting recession and all these things. And then we look at high yield spreads and they're just going towards 350 and happy days for everyone, right? Great. So I think the nuances are sort of trying to find out what could potentially break all this, right? What could potentially break that sort of Goldilocks scenario.
Is $95 crude it?
No.
You don't think that could break this?
I don't think so. It's one nuance. I think it's one of those where, to be fair, if I was the Fed, if I was the ECB or the Bank of England, which, lucky for everyone that I'm not, but, if I were, I'd be basically saying, well, what should I do about that, right? What can I do about it? I mean, I'm not an oil producer, so I can't really do anything, and I can sort of use it as saying, look, this is just energy prices. It's something transitory. It'll be going away out of the calculation within a couple of months. Don't worry, right? All the other rest, excluding 15 components from our preferred inflation baskets, then everything looks fine. So I think that's the worry that I have, right? That if we start looking at these inflation baskets that sort of exclude everything that we need for the everyday life, that they are starting to pick up again. And to be fair, if you look at things like super core inflation, right? The action components, the broad-based nature of it hasn't really dramatically changed over the last 12, 18 months. So that is perhaps something towards Q4 where perhaps inflation does pick up beyond just energy prices. Not a new inflation wave, but basically an interruption from that, okay, inflation has gone down in one straight line now, to actually now we're getting sort of this bumpy road ahead, right, in inflation, where we've got to play those turning points in it.
Max, the question everyone wants us to ask, are we still in a window where you think equities can do well?
Oh yeah, 100%.
Until when? How big is that window?
100%. Look, to be perfectly honest, if we think about it, and I know it sounds stupid, but imagine if yields go up. Imagine the 10-year goes to 4.5. What's the reality? The reality is it's probably going to do it because growth is better, right? And because, once again, growth expectations actually turn out to be too pessimistic, right? If you look at Q4 US growth expectations, it's sort of zero. Q1 next year is also close to zero. So the bar to beat is relatively low. So if you get yields moving higher, that's probably in response to growth doing better, so you buy equities. If yields go down, right, then probably rates vol goes down, and then you buy the NASDAQ. So to be fair, yeah, great. I'll just buy equities.
Can big tech still lead, though? And we've seen a recent kind of weakening in the tech profile and an underperformance there. Some people are saying this is the beginning of the end of the tech trade. Are you on that train?
Well, we've heard that for, I think, 16 years, 15 years. So, it's been a lot of beginnings of the end. Now, look, I don't want to be too cynical, right? But
last year was pretty brutal for the tech trade. Let's be clear.
So, but to be perfectly honest, I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US, a bit higher, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
You mentioned all of the dark clouds, including people repaying their debts, and also this question around a government shutdown, which seems like an increasing inevitability in the U.S. Amid this backdrop of strikes and a question of just general dissatisfaction. Which of those kinds of things do you care most about? Could actually have the most impact on your call?
Look, I think the government shutdown, not really, right? Because we kind of got used to it every other quarter. So from an equity perspective,
so
I know it sounds depressing, but if we're honest, right, it was a shock 12 years ago. It's not particularly a shock anymore, right? So from an equity perspective, from a risk asset perspective, that's not the main worry. The student loan repayments also not particularly worried about it, because you can also make a positive spin out of it, right? You can also say, look, actually, from the end of July up until now, repayments have shot higher because actually economic agents, i.e. normal people like us, they're acting completely rationally, right? They're seeing that, okay, this is starting to kick in. So instead of starting to, or having to start to actually pay interest on it again, I'm going to repay it early. And guess what? I have the money, so let me repay as much as I can. So actually, you can also make a positive spin out of it, right? And say, look, people apparently still have the money to do that, right? They still have sufficient money to do these pretty chunky repayments early. So all of that doesn't really keep me that much.
A quick question here. Can you frame out SPX 5,000? I got to make some news today. I got to justify the trip to London. Can you give me 5,000 SPX?
I think, if we think about next year, to be fair, it's not an awful lot away, right? It's 10, 12% away, right? And if we're thinking, but if we're still in a fairly high-ish inflation environment, right, and earnings growth is still relatively fine, yeah, why not?
Noel Quinn's all on good today. He's doing something with the United Nations. I'm not sure what it is. Noel Quinn listens to Max Kettner. HSBC is a prism to Asia like no one else. I personally witnessed it across that little Hong Kong trolley in Asia. How do you link China trauma, and particularly domestic trauma, into all the toxic brew of gloom in the West? How do you link Hong Kong and Shanghai over to London and New York?
Look, I think what's very clear with regard to Europe and with regard to China, and now a little bit less in the US, is, like you've said, there's all this doom and gloom, right? There's all these expectations around doom and gloom. I don't think you guys have had any guests on probably for weeks who are saying, look, you know what? 2023 has been better than expected. We were a bit wrong, right, on Europe and on the US, but guess what? 2024 is going to be even better, right? So I just genuinely cannot see how we're going to get, start to think about 2024, how we're actually going to see 2024 outlooks where people say, look, you know what? China's going to do great, Europe's going to do even better, and US is going to shoot the lights out. I just cannot see anyone doing that.
Great.
So do you want to take the other side of that?
I want to take that side, yeah.
Really?
The thing is, right?
So you're giving us a 24 call right now?
No, look, the one thing that I am not asked at all about, and for months, is what could actually go right.
What can go right next year?
What can actually, in the next 6-12 months, what's actually one thing where we could be saying, hey, you know what? Maybe
I'm asking
things
you, Max,
are not going to fall.
Let's go.
So what is the answer?
So the answer to me is, as long as we still have these really low growth expectations, you have a low bar to beat, and you keep rolling Goldilocks and Goldilocks and Goldilocks, right? It's great.
Goldilocks forever into 24.
Yeah.
Okay.
I think it is a lonely call. I mean, we're
It's
busting his
incredibly
chops,
lonely.
but it's a really...
I'm not saying it's the wrong call. It's not for me to say it's the wrong call, but
line
yeah,
them
it's
up.
lonely.
Binky Chowd at Deutsche Bank, Max Kuttner at HSBC. There's a couple others out there, you know.
Max has been right. I think we should put that out there first. You've been right all year, Max. We'll see about 2024. That's quite cool. Max Kuttner there of HSBC. The annual outlooks are going to start coming through in about a month, isn't that crazy?
They are. They're going to be exciting.
They start to write.
Can we go to the news that matters?
I'm just doing a Goldilocks forever. Yeah.
We got to go to the news that matters here. And this is really pretty cool. The guy with Newcastle is walking into San Siro tonight for the first time ever. John, what is it like to walk into San Siro in Milan?
Amazing.
Well, let's expand. This is a big deal, folks.
It's just a cauldron of noise. It's just a cauldron of noise.
It's a different culture.
Three tiers just hanging over the top of the field, 80, 90,000 fans. That roar in there is so unique. I get emotional in that stadium.
This is poetry.
It's
a cauldron of noise.
I get emotional in that stadium.
He's so damn emotional. He's extending his trip to London next week just so he can go to the Derby on Sunday.
I got messages last night actually saying, why aren't you on a plane? Like, why aren't you on a plane to Milan for the game? I know. Because I want to talk to Will Kennedy about $95 Brent next on Bloomberg TV and radio.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Average of 92 does allow oil prices to go to 100. We're putting out a piece later today which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
How big is your team?
Triple-digit crude by Halloween. Amrita Sen, founder and director of research over at Energy Aspects. This morning, 95 on Brent. Right now, WTI 92.62. The price action elsewhere pretty muted. Unchanged on a 10-year in America, 430.86. We're unchanged there on a 10-year. On the euro, slightly stronger, 107.05. Just about reclaiming 107 in the last 5-10 minutes or so. And equity futures, Tom, elevated, doing okay. It's a quiet start to the week outside of crude, going into the Federal Reserve tomorrow.
Exactly. 3 central bank meetings. Is tomorrow a live meeting, or are we doing definitive coverage for a dead meeting?
The decision is dead. The forecasts are alive. Does that make sense?
The dots.
No one's expecting a rate hike tomorrow, but changes to the dots, changes to the forecast, inflation growth this year, and perhaps next year
if
too.
I'm carte blanche, it's like, où est le dot medium?
Does the median dot come down for 23?
Sorry, like that French there?
Where does 24 go? And what about that longer-term dot as well? Do you start to think about kicking
interesting. Tune in. We're going to be here tomorrow in London, all with our usual guests. Really, we're going to do the quality show we can, and not only to get you to September, but to get you to November tomorrow. as well. This is a joy, and I'm going to take a little moment here to do this. The founder of Bloomberg News a few years ago, Matt Winkler, said, okay, what can we own? And he went to a guy named Stuart Wallace, who's a really odd guy. Like, he's a different guy. And he said, Stuart, build it up. And Stuart Wallace constructed, through airline terminals and the rest, a hydrocarbon team that is definitive in the world. Stuart was exhausted and said, Will, it's yours. Joining us now, Will Kennedy, running all of our hydrocarbon in order. How many people are involved at Bloomberg News and looking at oil and gas?
Oil and gas, probably about 60 to 70 worldwide.
60 to 70 worldwide. Alex Longley's got the thing you're focused on right now, away from what's Brent going to do, what's West Texas Intermediate, is all the different grades of oil, the not in my backyard refineries and that. What's the observation our audience needs to know about what Alex Longley's working on?
I think the thing to see is we're looking at futures prices here, and clearly that's the price that matters. But when you look at the underlying parts of the oil market that Alex and those guys are reporting on every day, you're seeing a very tight market. You're seeing a lot of demand for Middle Eastern crude in China and the rest of Asia. You're seeing a lot of demand for US crude. You're seeing that oil today is worth considerably more than oil in the future. That spread is as elevated as it's been in a year. And you're also seeing a refining system that's stretched because demand for diesel, for gasoline, for jet fuel is looking really strong. So that means that the margin between crude and fuels is also wide, so what people are paying for what they use. So you're just seeing an oil system which looks tight.
So what Lisa brought up earlier, the elasticity or the responsiveness of the demand side of oil, all of that covered by a post-COVID Asia. Our Asia team of those 60 and 70 people, what do they say about the elasticity of Asian demand?
It's this is not quite the elasticity you had in mind, but it's bounced back. And I think that people were worried about Chinese demand in particular over the summer months. But one of the things that's driving this market higher is that people see that China demand right now, despite all the concerns about the property sector, despite all the worries about parts of the economy, is fairly strong, that it is bouncing back, and that reflects good demand for in China, where people are traveling a lot. And it also reflects that fact that increasingly the world is reliant on Chinese oil refineries.
So I want to just go back to the point where you were talking about how a lot of the higher prices are near term. Longer term, people say, they're going to go back down. This is basically high oil is transitory, and that is playing out in the commodity sector through the pricing. What has to change for it to have a sort of stickier feel to it in some of the futures pricing?
I think the market right now is looking for where that point is that, clearly Saudi Arabia and its allies in OPEC have sought to take a grip on the market. They're comfortable with prices coming into this $90 to $100 range. If we touch 100, I think the question then becomes, does OPEC let it go higher than that? And at what point does it start to dampen demand? And I think that really hasn't, we saw that in the aftermath of the war when oil went to 120, it clearly did have an impact on demand. But we've got to find that spot between where OPEC's happy and where it starts to really impact demand. And I'm not sure in the current economy people know exactly where that is.
We also don't really understand whether this is really supply-driven or demand-driven. And this is at a point where, yes, people are pointing to the Saudi Arabia production cuts, but there was an incredible amount of demand before that, and inventories had come down dramatically. How underplayed is the demand side of this story as we talk about it?
I think, as I said, when you look at the bounce back in Asia, but you look at more broadly around the world, demand has probably been much stronger than people expected. It really has been quite buoyant. We are well past probably pre-COVID highs now. We're seeing record oil demand day in, day out. And that bounce back has come through a certain uncertainty about the state of the economy, but it does reflect, A, that the economy is strong, and that, B, the economy still runs on oil.
Well, Saudi and Russia have a monthly review. They've cut back. They said those cuts are to be discussed monthly. Do you have any idea of what the line of the sand is for them to say, actually, maybe we should change?
No, I don't. I don't think we know that. I think that's one of the key questions that people have been looking from here on out. I think they will be very alive to demand for their crude, though. Right now, I think they feel like demand for their crude is strong. They're able to charge very healthy premiums for it. I mean, don't forget, as Javier pointed out in the column last week, the Saudis right now are getting well over $100 a barrel for their crude. Which is something that people don't.
Let's get into that. I think we should finish there. The Saudi premium.
Yeah.
Are they in a great spot right now to charge whatever they want because there are certain places that can only get crude from them and a few other places?
I'm not sure they'd characterise it as whatever they want, but they are in a good spot now. Their crudes are diesel-rich, they're in demand, they're going to Asia. That premium has risen markedly over the last few years, and I think that does reflect the pricing power that Saudi Arabia and OPEC has in the market right now.
Is Russia still on the same page as Saudi Arabia?
Yes, I think that they actually are. I think one thing, rhetorically, they absolutely are. There's been a real effort to communicate together, to show that that political alliance is strong, to show that the leaders of those countries, Vladimir Putin and Mohammed bin Salman, are talking about the oil market regularly. And it is true to say that Russia curbed its exports. Now, a Russian target is not cast iron like a Saudi
Well, something
target.
changed though, right? We talked about this. They moved from volume to price. What was behind that? In terms of the Russians and what they wanted for their crude, weren't they going to export as much as they possibly could, and that's changed?
Well, they are still exporting they haven't paired their exports like Saudi Arabia has paired their exports. Saudi Arabia is doing more of the work, but I think they thought that it was worth doing some work to cement that alliance with Saudi Arabia, which on an oil market basis looks pretty strong right now.
If I was to get in the Bentley and drive down to Bath, there's a price for a liter of petrol where it falls apart. On a gallon basis, we're emotionally at $4 a gallon to $5 a gallon is a national crisis in America. Where's the tip point on a gallon of petrol? Right now it's about $7.40, I think. Is it $8 a gallon? Is it $9?
Well, we are still European enough that we think in litres, I'm afraid, Tom. And I think that the point where people...
See what I got myself into.
I think the point that people really start to feel it is £2 a litre.
£2 a litre.
Which is where it was after the...
John, what's that in a
nothing to him. He's like,
£2 a litre is brutal.
Yeah, I mean, it's well over $8 a gallon, I think.
It's brutal.
Yeah.
And psychologically, the cost of living around, forget the 7 to 8% wage increases, £2 a litre will be the only thing people
The
talk
important
about.
point about £2 a litre, Tom, is you're spending more than £100 to fill out your car.
Yeah, that's what
and
one
that's
of my
what
drivers
people.
said.
Yeah, that's when people really feel it is when they go to the pump, they fill the car, it's £100
Is
or
that
more.
accelerating the EV transition, Will, or are they just sitting around saying EVs are too expensive, like they are in some places?
There are a lot of I mean, I'm sure you've seen on this visit, there are a lot of EVs in London right now.
Way more.
I mean, it is happening in London. I think the thing is that when you get out to the rest of the country where you don't have the charging points, it's happening a lot more slowly.
Tom likes the electric London cabs.
I like the
don't you,
electric
TK?
London
Just
cabs
the
a lot.
silence
I'd
of
buy
them.
one.
Yeah.
Built by a Chinese company.
Yeah.
There we go.
Near Coventry.
Yeah.
Is that really? Is that right? Okay.
Yeah.
Nice.
I can't remember. It starts with an A.
Okay, find out. Will, thank you. This was great.
We got through
Always
this
is.
tots
Will
free.
Kennedy.
We got through this
You want to
tots
squeeze in
free.
some tots?
Yeah, they're rocking it. I mean, they're doing great. I mean, they could take
Great
on
start to the season.
Staying for the match?
We're trying. Pharaoh's working this thing. He's 24/7 on this. John's home at night on the phone.
Trying to figure it out this
7
weekend.
people trying to
figure it out.
stretch the trip into Monday.
But our
I don't know
connections
if
with
I'm part of
Arsenal,
this conversation.
Arsenal are the
You
home.
brought up a sore topic.
Are the home team, right? So our connections with Arsenal not as great as our connections with Spurs.
I have a very
so we've got to
Neil.
get tickets to the Emirates.
Neil at the cigar place is all Arsenal all the time.
Can
I
Neil
think
get
he can
tickets?
us, you know,
Kit Jukes might be able to
50-yard
get
line.
tickets. Have we got Kit on this week?
I don't know. I hope
We should
so.
get Kit on this
Now-
week.
now we
just
do.
to ask.
Are we extending our trip?
You can if you want. Okay. Ed Jardeni,
Dr. Red
of
will
Jardeni
keep her
Research, is coming up. He's been bullish a lot of this year. Let's see if he still is. Equity futures on the S&P 500, positive here by 0.13%. Live from London. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Could be that given that we have this productivity enhancing technology that is AI that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States, and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962 at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Looking forward, the jury's still out on inflation, but that recession risk remains significant.
It might take longer for inflation to get back to target.
It's true there is a resilience of inflation which is more tangible in Europe than it is in the US.
Consumers in particular, they aren't behaving like there is a recession in any form coming around the corner.
There's a risk here about a wage price spiral that isn't going away anytime soon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A two-day meeting at the FOMC begins right now or whenever Chairman Powell gets out of bed in Washington. From London, for our audience worldwide, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Sneak peek of the price action. Equities right now positive by 0.1% on the S&P 500. Main event of the week, Tom. There's three of them, to be fair. The Federal Reserve, the Bank of England, the BOJ. The big one for most is the Federal Reserve, Tom, tomorrow afternoon.
It's going to be interesting to see. And, you know, the way I look at it is with Greenspan, was he having a ham salad sandwich or a peanut butter and jelly sandwich? It was a king. I mean, did they watch what the governor of the Bank of England does when he stops by Greer's? Do they?
We follow the suitcase, the briefcase.
Follow the suitcase and see what's going on.
Communication has changed.
I don't know what to make about it other than there's no other story. $95 barrel oil. And to talk to our guests this morning, including the encyclopedia known as Will Kennedy, we're here.
We're here right
now. And we're going higher.
95 on Brent, Lisa, 92.51 on WTI. We've got questions. What does it mean for the Federal Reserve tomorrow afternoon?
This from Citigroup's Andrew Hollenhorst, just out, basically saying that supply-side constraints exemplified by the auto worker strike, as well as the rise in oil prices, will cast a hawkish shadow on the Fed's meeting. And they talk about this idea for higher for longer that's increasingly getting priced into markets. And if you take a look at Fed funds futures, they are moving up to some of the highest that we've seen for next year, the mid-year next year. People are pricing out some of the cuts that were given earlier in the year.
So hawkish pause, right?
Yeah, well, yes, today, yes.
For Gapen as well, they're looking for another hike potentially in November. Lisa's right, Tom, forget 23, it's into 24. You might get some movement in the dots on 2023. There might be some debate about whether we need one more or whether they think we're done for 23. 24 and the cut still in this market. How much can you push back the idea that we'll get anytime soon?
I don't know. I shut down the Savoy last night, and the band was great. The band was called Hawkish Pause, and they were really, really quite good.
I'm not sure any band that sounds like Hawkish Paws are playing the Savoy.
Their Coldplay and Adele were just great. So, you know, I'm looking at this, John, and it's just obvious. They're going to be on core inflation, stripped out. What's Mike McKee call it? Super service core. Whatever it is. Baloney. Inflation's inflation for the public, and most of the public's flat on their back. Period.
Let's pick up on the Holland Horse notes. We made 2 points, Lisa. Crude, 95, right here, right now, supply side story. UAW, the strikes there. Let's build on that. There's a new deadline. It is this Friday, noon Eastern. UAW President, Mr. Fain, would like to see real progress over the next 2-3 days. And if we don't see that real progress, these strikes get prolonged and maybe they are deeper and more severe. Does that mean anything to the Federal Reserve at this point? Can they make a call based on what's happening with UAW and 3 automakers?
I'm going to sound like a broken record. I often do. Jeff Yu yesterday saying that what the automakers are, what the auto workers are betting on is a tight labor market. If they get what they're asking for, anything close to it, is it because this is a tight labor market and there aren't a lot of alternatives, especially if you see other workers taking a signal from this who are not in unions and demanding higher wage increases? That's really ultimately what's underpinning this at a time when jobless claims keep coming in below expectations week after week.
AMH joining us in about 10 minutes' time from New York. We'll touch on that and the latest from the UN General Assembly. Lisa's going to give you the day ahead and all that good stuff in just a moment. Here's the price action. Stocks up by 0.1% on the S&P 500. Bonds essentially unchanged. Yield higher by a single basis point on a 10-year. Tom, we have to talk about a 30-year that was issued a couple of years back, the May 2050 bond. You're going to love what we had to say at Bloomberg News on that story. It dropped below 50 cents on the dollar in yesterday's session. You might well be interested in that particular maturity.
It's on the edge of Austria.
The price story there, Bramo, painful for anyone who picked up that long bond with yields near all-time lows.
Which is the reason why some people are saying now is the year of the bond. Well, there's been a lot of pain to get here. Today, there's a lot of pain that we are avoiding by being in London during the United Nations General Assembly in terms of traffic. President Biden will add to that today. In his address of the UN General Assembly this morning, curious to hear what he has to say about China, about global cooperation, and the fact that there are a lot of questions around the relevance of the UN at this point, where there's increasing divergence in the world. 1 p.m., the U.S. is auctioning off $13 billion of 20-year notes, not 50 cents a dollar, but they will be looking at yields that are the highest going back to 2011 on the long end. And today, there's so many meetings and conferences on the sidelines of the UN's General Assembly meeting. What I'm focused on is 4:05 p.m. Treasury Secretary Janet Yellen is speaking. There also is going to be Ursula von der Leyen of the European Commission and Noel Quinn, CEO of HSBC. China, front and focus. What do they think about the prospect of decoupling? Yeah. We know from Janet Yellen. Ursula von der Leyen, maybe a little less clear.
Yeah, Max Kettner wrote Noel Quinn's speech.
Is that what you heard?
Yeah, I heard from Max.
Yeah. I'm not sure how much he wants to talk about China. EV tariffs. Yeah. That's what I want to talk about.
Absolutely.
The transition. How do they want that transition to look? Is it all about climate? Is it about industrial policy and domestic champions? US manufacturers, European manufacturers, or are they open to having low tariffs and just having the cheapest provider, which would be at the moment Chinese EVs?
The answer to that is they want the tariffs, and that's what we've heard, and we've heard that change in tone. This is not about an open market because German manufacturers have been horrified by the progress that Chinese manufacturers have made.
That's all coming up a little bit later. Joining us now is Ed Yardeni, president of Yardeni Research. Ed, wonderful to have you with us on the show. We caught up with Max Kettner of HSBC in the previous hour, Ed, and he said we need to focus on what could go right in 2024. Are you more focused on what could go right or what could go wrong?
My view of 2024 is that could be a better year than certainly 2022 was, or even 2023. Not that 2023 is turning out to be a very bad year. As we know, the third quarter is turning out to be remarkably strong. So all in all, I think that we'll get through a lot of these challenges, and 2024 should be a better year for earnings, with the market doing better too.
Ed Yardeni, you and Ralph Enkenpour have been way out front of this on the October rally, and we've talked about a second leg of a bull market. As John mentions, Mr. Kettner of HSBC shares your enthusiasm. The arch pullback of this, is the great moderation over? Is the great moderation over, and does that mean you can't make money in stocks?
Well, I've been really debating in my commentaries about whether it's going to be the great inflation of the 1970s, or it might very well turn out to be the roaring 2020s. And I've been inclined to believe that on a longer term basis, we will see that the 2020s will be a period of tremendous progress and productivity. And I was making that point before the pandemic, and the pandemic sort of got in the way because it really messed up the productivity story big time as people quit left and right. But I think we're making a comeback. I think productivity bottomed actually in 2015 in terms of its growth rate. It was only 0.5% on a 20-quarter trailing basis. I think it's going up to 4% by the end of the decade, which sounds delusional, sounds far-fetched, I'll admit. But those are the kind of peaks we've had in previous growth cycles in productivity, and I think that's where we're heading.
Right. Does a real rate, and some would say a higher real rate, an inflation-adjusted rate, does that impinge on your enthusiasm?
Not really. I think we're going back to normal. The new abnormal was the period between the great financial crisis and the great virus crisis. And back then, interest rates were at record lows. I think we're going back to the environment just prior to the great financial crisis, where the TIPS yield was around 2% for the 10-year, and the inflation premium was around 2.5%. So 4.5% is kind of where the bond yield should be in a return to the old normal, and I think that's what we're doing. I think the economy and the stock market have already demonstrated that they can both live with these kind of levels of interest rates.
So you and Max Kettner seem to be on the same page. And Max came on the show earlier and said, you guys all worry too much. No one asks me what can go right, how good things can be. And that's what they should be asking. But it is my job to worry. That is sort of what I do. So I'm curious, from your vantage point, where does oil fit into this at a time where it's risen 30% since June?
Yeah, well, I didn't expect it. I don't think anybody really expected it. I think the widespread perception was, oh, yeah, the Saudis are going to cut production and the Russians will cut production. But China's weak, Europe's weak, the U.S. is sort of muddling along. And that means that oil prices aren't going to go up as the Saudis would like, but they've been right so far. And so that's a new variable that I've had to incorporate into my thinking. And so just recently, past few days, just to demonstrate that I am realistic and I'm looking at the world as it is, not as I'd like it to be. I did raise my outlook for a recession risk from 15% to 25%. And unfortunately, there is a certain sense of deja vu all over again. We had two oil spikes back in the 1970s. So far, the first oil spike we had last year hasn't caused a recession and hasn't been anywhere near what we had back in the 70s. And I don't think this one's going to be a major oil spike either. I think we are going to find that the demand responds pretty quickly to these price hikes, and it slows down, and oil prices come back down, not dramatically, but at least they stop going up.
What's the break point in terms of when prices of oil really do create a serious headwind and increase the chance of recession?
Well, I think they're already starting to impact demand. It's clearly getting a tremendous amount of visibility in the press. And of course, the price of gasoline is the most visible price of them all. We all go driving around, filling up our tanks, and everybody's seeing that the price of oil, gasoline has gone up dramatically. So I think we're at the point where it doesn't cause a recession, but it causes some demand destruction for gasoline and for other energy products. And that being the case, that could bring the price back down. I don't think it's going to cause a recession, but I think, if we sustainably, if we see the price of oil stays sustainably at $100, $110 a barrel, and the price of gasoline $4.5 to $5 a gallon, I think that could certainly risk a much greater slowdown on the economy than I've been thinking.
It's certainly going to cause some pain. Ed Yardeni, thank you of Yardeni Research. The energy providers, the producers, having a decent month for the month of September, as you can imagine. 92.44 on WTI, through 95 early this morning on Brent crude. If you are just tuning in, welcome to the program. On the S&P 500 right now, we are positive by 0.1%. Yields are a little bit higher by a single basis point, 431.26 on a US 10-year. Coming up in the next hour, Alicia Levine of BNY Mellon on this equity market. Going into the Federal Reserve decision tomorrow. Tomorrow, less about the rate decision, more about the forecast for growth, for inflation, for interest rates for this year and mainly for 2024. We'll get into that hawkish pause with her a little bit later this morning. Max Kettner of HSBC was on the program with us about 20 minutes ago here on Bloomberg TV. And Bramo, what he had to say on Goldilocks. I feel bad because I said Goldilocks forever and now everyone's going to say it was Max, but I guess Max basically agreed that Goldilocks forever means like 2024 and maybe longer.
Did you see me typing the headline for the newsletter?
Max Kettner says.
100%. Goldilocks forever. Exactly. Nailed it. Here's my thing. I mean, honestly, there is this feeling that people have underappreciated the strength. And now there is a question of whether people are just pulling up their previous forecasts for exactly the same playbook as they had at the beginning of this year that were wrong. And now they're just going to roll them out for 2024. And Max is saying, stop being so gloomy. You're just not getting it.
I am sobered up, remembering my grandmother sitting on the couch after the third scotch, regaling us about the pandemic of 1919. And Ed Yardeni said after that horror, and it was worse than COVID, they had the roaring 20s. And what Yardeni said there about ancient history and productivity, John, how many people are in agreement with him? Very few.
What's funny is if you'd asked me that 2 years ago, I would have said quite a few. And then all of a sudden the inflation shock of the last 18 months developed and people backed away from that roaring 20s call. Equities right now on the S&P up by 0.1%. Coming up next on a missing then found F-35 fighter jet, Bloomberg's Anne-Marie Hordern from New York City. From London, good morning.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
We could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
I don't think we should have a shutdown, but I agree with you that I think it is very likely. And I think the reason it is likely is I think Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown.
I was the latest from Senator Ted Cruz of Texas speaking on balance of power with Bloomberg's Anne-Marie and Joe Matthew. Will touch base with AMH in just a moment. Sneak peek at the price action for you this Tuesday morning. Good morning to you. Equity futures just about positive by 0.1%. Yields a touch higher by a basis point or two. 431.86 on a 10-year. The headline this morning in financial markets worldwide, if you're looking cross-asset, it's in the commodity market. It's Brent crude. Brent crude through 95 for the first time this year. Right now, 94.92. WTI, Tom, $92.40.
Yeah, I mean, the West Texas Intermediate to me gets my attention, but to me, the underlying story going into 3 central bank meetings is the resiliency of the equity market. Basically, at 4,500, we've gone nowhere for months. There's been like 18 reasons for the stock market to go down, and on a blended basis away from the big seven, it's been resilient.
It's getting what the bulls wanted, right? Which is a better mix of growth and inflation. That will be captured by the forecast probably that we get from the Federal Reserve tomorrow, which is growth expectations a little bit higher, inflation a little bit lower going into year end.
I mean, it's really great. We welcome all of you. We're in London for the week. We've got a credit conference coming up on Thursday. Who's our guest at the credit
Jim
conference?
Zalta, Apollo.
This is timely, to say the least.
Really timely, yeah.
Why have spreads not come in? And for those of you on radio, we are here affixed to a great scene from our Queen Victoria Street. John, on the break here, you and Lisa were talking about too much optimism on the show today. I'm looking back over at St. Paul's, and you know, I'm just thinking.
Just to be clear, that wasn't the conversation. We can go with that.
But early each day to the steps of St. Paul's, the little old bird woman comes in her own special way. She calls, "Come buy my bags full of crumbs."
Okay. Is there a song?
The world stopped in America in about 1965 when Julie Andrews,
we did Mary Poppins,
Julie Popcorn.
Okay.
And before VCRs and that. Pro tip for those of you with children. This is true of baby Zeke and other little children on our team. Mary Poppins is the longest Disney movie, so you could put it in on Saturday morning and sleep longer.
Just keep it on.
You just keep it on. You play, you know.
Dick Van Dyke.
Dick Van Dyke. Yeah, but back then
really good.
You went. Your
so
sisters,
disturbing.
John.
Why?
Your sisters.
What's my
the
sisters
scene
got to do
behind
with
us
this?
here. The scene behind us here.
Bring them into it.
The scene behind John Farrell was seared in our memories from the 60s because you had to go to 10 birthday parties and see Mary Poppins like 10 times in a movie theater.
Okay, I've no idea why we're doing this. I'm waiting for this amazing segue.
It's a little bit of London.
To AMH. It's all going to make sense in like 30 seconds, except it's not. It's not.
Yeah. Joining us on Washington, Bloomberg, Unga? Is that what we're calling it? Bloomberg Unga correspondent Anne-Marie Horton joins us now in Washington. Let me just cut to the chase. Pomp and circumstance. She's in New York, excuse me, not in Washington. How dare, it's a major folks' pa. French there as well, Lisa, like carte blanche. Anne-Marie, I'm looking at Joe Biden. What's he going to say? I mean, is this first do no harm, or is he going to have an assertive speech today?
Well, President Biden, I think, is really going to make his speech about Ukraine, especially with Zelensky here. And while officials haven't really given a lot of specifics or details about what the president will outline today, Jake Sullivan, his national security advisor, said last week that it'll make up the significant part. They really feel like they made an impression with the global south, the likes of India, the likes of Brazil. Brazil's Lula, by the way, will be meeting with Zelensky. That'll be actually a critical meeting to watch on the sidelines of the UN General Assembly, but also back at home, domestically. That CNN poll in early August, it wasn't just Republican voters that had some concerns about sending more U.S. money to Ukraine, taxpayer money to Ukraine. Even though it's a majority of Republican voters, there is this concern. And obviously, what we've seen the White House ask Congress, in the House, Speaker McCarthy didn't even include Ukraine aid in this continuing resolution to keep the government funding and the government open past September 30th. So I think this will be a big part of the president's speech today, and there's really a twofold approach to why.
Just on foreign policy, AMH, do you get the sense from speaking to the Europeans, from officials, from the German government, that they're on the same page as the United States, as President Joe Biden?
Well, so I had an interesting conversation with Annalena Baerbock, the German foreign minister, on Sunday, and already Olaf Scholz, the chancellor, has come out and said he supports President Biden in a second term. Besides the fact I asked her if that was appropriate, she said that what she is doing now is how they are trying to prepare for the potential of Trump 2.0. And before she came here to New York, she was in Washington, D.C. to meet with Republican lawmakers to talk about and field questions really about Ukraine aid. But also she was in Texas, deep red state, and had a frank conversation with Governor Abbott. So you see some members in Europe are trying to make sure that they are shoring up support and dialogue with Republicans, and they're preparing for a potential Republican administration after the November presidential election. We should note, though, that what is happening in the United States is also happening in Europe. If you look at German politics right now, you have millennials who are actually starting to, some of them, shift towards far-right politicians in Germany as well. The AfD, the Alternative for Germany party. This is a far-right party. And in Germany, individuals are also dealing with concerns about immigration, a ton of concerns about inflation, and you see these conversations also playing out in European politics as well.
Do you get a sense of what the solutions are that are coming from the right, coming from the conservative side of politics?
Well, at the moment, what you hear from conservative politics when it comes to Ukraine is that they do not want to send some of them more money to Kyiv. They think that enough of U.S. taxpayer dollars are going, and at the moment, there's still this war raging on. Some potentially are pushing for, is there any sort of counterability? Is there going to be any sort of peace negotiations? But this is only just one part of the Republican Party. You have others like Lindsey Graham, like Representative McCall, like Mitch McConnell, who want to keep making sure that they are sending more weapons to Ukraine, they are aiding Ukraine, and actually sometimes bash the Biden administration because they say that the administration is moving too slowly.
Emery, this is important, and with your reporting, I can ask an unfair question. In World War II, there were too many times, like going up the spine of Italy, where American troops ran out of ammunition. Are we being so frugal that the Ukrainians are running out of ammunition?
Well, I will say the message that I hear constantly from the Ukrainians is that in the beginning it was, we need weapons, we need them now. Now the conversation is we need ammunition, and we need the ammunition to continue. There needs to be a consistent supply of ammunition, which is why they're asking for more aid. They're also asking for more sophisticated weapons as well, which we have seen the U.S. have some concerns about. But a lot of this does depend on that ammunition they want to see, and that continued ammunition. We can also say that's happening on the Russian side as well. You know, the reason why President Putin met with Kim Jong-un for old school Soviet-era weapons is because they need that ammunition to continue to flow.
Did they find the F-35?
They have not found all of the F-35. It seems that they found the wreckage of the F-35. I had a conversation with someone last night because I, like everyone else in America, I think is asking, how do you lose a $100 million jet? One of these jets costs anywhere between $70 to $120 million. It's the most sophisticated jet program in the United States. And I spoke to someone who actually is a pilot on one of these. And he says sometimes when these mishap happens, and the plane goes missing, you know, this is a stealth plane, it is hard to find, but sometimes it just crashes in marshland and the, quote, earth eats it up. That's where your $100 million is, in the earth, potentially.
It's like Yoda. You know, the plane, the starship lands in the water and sinks and loops there, and Yoda does the finger
I see where we're going now.
And brings the airplane up.
What's going on with Washington, Tom? One day it's like no suits in the Senate, and then at the same time we're losing F-35s. This is what happens when you start wearing hoodies to work, Bramo.
Oh my goodness.
Start
That's
making
the
mistakes.
Conspiracy theory that you're going to come up with is that basically if you don't dress nicely, forget it.
You lose expensive things. You just get scruffy and
and lose your F-35.
Make mistakes.
Make $100 million.
Jane Foley of Rabobank on FX up next.
years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Just experiencing TK without caffeine at the moment. Cups are flying.
Well, yeah, come on. In England, John, all there is hot brown water.
Coffee. What's wrong with hot brown water?
Look, I had Yorkshire yesterday. I tried it. And I did P&G tips this morning at breakfast.
Breathe, Tom.
I don't get it.
Just breathe. In and out. Exhale, inhale. You've got this. It's all right.
The
Futures
coffee's
up
good here.
on the S&P. Okay, we'll get you the caffeine. It's coming.
Thank you.
On the S&P, we're a little bit higher. On the NASDAQ, positive 2 by 0.2%. What was that? In his veins?
Yeah, exactly. Injected.
In the bond market, 2-year, 10-year, 30-year. Your 10-year yield looks like this in a bond market at the moment. Treasury yield's higher by a single basis point to 431.66. The 2-year just won't get away from a 5 handle on a 2-year. 5.0581% on a 2-year this morning. Going into the Federal Reserve tomorrow. This is the move that stands out, though. It's in the commodity market. $95 Brent. Earlier on this morning. At the moment, 94.90 on Brent. We're positive by 0.5%. WTI crude, 92.36, up by almost 1 full percentage point. What does this change for the Federal Reserve tomorrow, if anything at all? Onto the Bank of England on Thursday and the BOJ on Friday. Under surveillance this morning, it's the Bank of France governor saying the ECB will keep rates at 4% for as long as needed. Villeroy saying this, quote, looking at the situation today, we think that is a good level. And barring surprises, we are pragmatic. We look at how inflation evolves. It's more important now to be patient, to be tenacious. Villeroy adding, we have done the right dose, but we have to take the medicine for a sufficiently long time, and we will see the deceleration of inflation. Tom, the medicine,
right?
If it's not 0% growth, I'm not sure how brutal this is going to be in Europe.
John, thanks for picking this out. This is really profound. Reuters reports that he said it's a disease. This is a guy on the edge of Bundesbank, and it really goes back to Banque de France. I was at an IMF meeting years ago, having a cigar of my choice on a roof, and there is Villeroy sitting next to me, and we talked for a while. And the answer here is this is old school European economics. This harkens back to Banque de France from another time.
It's easier to say this when people can still get jobs, when the unemployment rate in France is 7%, when you're looking at a scenario where people feel frustrated with inflation, but okay otherwise. Does that change when the medicine starts biting a little bit more? And we were talking about this with the Fed, and the bad times never came. We were all too pessimistic, as Max Kettner said, and Goldilocks forever. So how do they handle it if there is something negative?
How do they handle it with the gauze, John, of austerity? You studied this. You were our ECB reporter. There is an austere feel, as in Villeroy, in Europe that's different than the United States, and that's how you get into Summer's modern phrase of stagflation.
We're going to solve this. Sarah, would you like to bring the coffee on? We'll make this happen. Let's get you some caffeine, TK.
Oh, right.
There we go.
Yes,
there we go.
Please.
There we go.
This isn't hot brown water,
Thank you,
right?
Sarah.
It's for real?
Thank you. That's for real. black coffee.
Is it?
All right? You enjoy yourself.
It's good.
Let me get to the next story.
I'm tang-free in London. I'm
Have a couple
not
of sips of
thinking
that.
straight.
All right, no grunting. The UAW imposing another deadline on labour talks with Detroit's big three automakers, saying it will expand its strikes at noon Friday if, quote, serious progress isn't made in negotiations. A union rep said no new offers had come in since it made proposals on September 14th. This is what the union wants, 36%. This is what's on offer. Stellantis 21%, GM Lisa 20%, Ford 20%.
And the argument is, at least by the UAW, that there have been no new offers from any of the auto manufacturers since they declared strike. So we don't really understand what those negotiations are if we hear that they're making progress from the auto manufacturers. We hear from the UAW they're making no progress and we have to expand the strikes. How high is that bar? Is it just coming down $4 and saying 36 or nothing? Or 4%?
Is it just about money? I don't buy it for a minute. It's about all these other structural things to reaffirm the unions back to another time and place. All that's vaporized in 48 hours.
This is about money too. Last story. Elon Musk is considering charging a monthly fee for users of X, formerly known as Twitter. Musk saying a small service fee could help fight off bot operations on the social media platform. Musk making the comments in a conversation with Israeli Prime Minister Benjamin Netanyahu at his Tesla offices just yesterday. So this was meant to be about anti-Semitism, and now it's all about how we correct some of these issues with charging everybody?
Okay, so basically this is Elon Musk saying, you're concerned about the bots. The bots are the ones that are anti-Semitic. And yeah, they've increased their presence. And the way that we can get rid of bots is just to charge you more money. It's pretty rich. It's amazing how he found
Did he actually say that? These are anti-Semitic bots?
Well, he said that some of what's going out there is from bots, yes, and that you will get rid of those bots if you actually charge a fee, because it is too expensive to have this type of generation of bots.
We got to stop the show, Lisa. I think it's really important. Within all the heritage of Israel and the United States, and then, going back to Golda Meir and all, what is the relationship of the Prime Minister of Israel to the ADL discussion on Twitter that John Farrow just mentioned? I mean, how do you link New York City ADL into the Prime Minister of Israel meeting with the head of Twitter?
You mean that they're both Jewish? I don't know. I mean, honestly, I think that the bottom line is there has been a tracking of how much more some of the hate speech and the anti-Semitic.
I have seen it. I've witnessed it.
I've witnessed it. I've been a subject of it. But there's a question here of going forward, what the cause of this is. Is it because of an increase in bots?
Right.
Or is it in the sort of increase in the tone generally of the platform? I don't know, but it seems like a good opportunity for Elon Musk to get some more money.
And if you haven't thought about this yet, you don't need to answer, but you're a big user with a big following on X. Would you pay? Or would you leave the platform?
These are TBD questions.
Still TBD, yeah.
Because the question that I have is, what's the alternative? And that's what Elon Musk is pushing, and he's pushing on a string at this point because he has seen some people leave. We were talking about Threads that lasted about 14 seconds, and then everybody went back to X. He changed the name, he changed the algorithms, he fired the people, and people are still on there. And so at a certain point, you have to wonder, is he just going to see how far he can push this and see what it will take to get a revolt? And if he doesn't, you're going to have to be paying fees. And if not, you're not going to have access to the platform.
I'm trying to work out what the Brammo line of the sand is. $10 a month, 15, 20,
I don't want to pay.
30.
And at the same, I didn't get a blue check, and I get people ragging on me for that. But because there are all sorts of copycats and things of that nature.
I've seen them, yeah.
And
have you seen the Twitter feed Toxic Brew? It's like a Lisa thing.
That's a handle Brammo should have.
That's it.
Toxic Brew.
Toxic Brew. That works.
We're going to move on here. I'm going to do one question here.
I think that all is a toxic brew.
It's a little bit different. John and Lisa are going to jump in with really smart questions on foreign exchange. She is Jane Foley of Rabobank, and the heritage of Rabobank is commodities into foreign exchange. And Jane Foley, I want to look out 3 years and 5 years to the climate change effect. Sugar to the moon, cocoa to the moon, a few other things, even cattle's popping up here as well. How is the Rabobank world going to change with climate change and what appear to be surging commodity prices?
It's going to be tough. Now, of course, in the short term, we don't necessarily have surging food prices because prices were high last year. There was lots of planting, but I think we can all agree that over the longer term, you have climate issues, you have issues that could create inflationary surprises in the form of food prices over the next few years. And also the supply side. I mean, look what's happened in the Panama Canal, shortages of water, restrictions on shipping that can go through, impacts to the supply chain. So we know that climate change can bring us inflationary shocks. We know that it can have a detrimental impact on growth. We know that it could potentially make interest rates higher. So the environment that suggests is not particularly
John,
pretty.
this is critical, and that all the focus in the financial media is how to make a speculative return on euro, yen, or whatever. And there's a whole other world out there of hedging commodity transactions.
Okay, so interesting question here, Jane, for you. Climate can lead to inflationary outcomes. Can the policy changes to address climate change also lead to inflationary outcomes? Is this lose-lose on that front?
I think this is a really, really interesting question because we have so many elections next year. So next year, I saw a statistic recently that said countries with a collective population of 4 billion, so that's over half the world's population, go to the polls next year. So we've got the US, we've got the EU, we've got India, we've got Russia, we've got Mexico, and various other countries. Now, amongst those issues that people are going to be talking about is, of course, the impact of climate change, but also the green transition. And what we've been seeing is people, because of the cost of living, because of the energy crisis, because of the impact of inflation, are losing patience with the politician, the push towards a green transition. And we're really seeing this in Europe. Support for, say, the Germany's Green Party really gone down. Support for the far right really gone up. And this is fairly uniform because people are saying we can't afford to lose our jobs because of the green transition, because in Germany, for instance, lots of jobs in the supply chain for car manufacturers will go. And people are saying, we can't afford to buy these electric cars. We cannot afford necessarily the green transition. And that's a real problem.
How do you price that into a foreign exchange call? I mean, not to be too base here, but there's really a question of who's doing the best job in counteracting some of the inflationary forces in this swirling brew of uncertainty of how you're going to deal with this. I mean, this is what we're dealing with the UAW in the US.
In some respects, I think the answer is quite easy because when you are really confused, when you don't know what's going on, people tend to buy the dollar. It is the safe haven. And I think for an awful lot of these political challenges, they're going to be felt on both sides of the Atlantic. But I think it's the euro that will feel the impact of these political crises a lot more relative to the dollar, because the dollar, of course, is the currency of the global payment system, and people need dollars in times of crisis. And therefore, the dollar, in a way, gets protected even when its own fundamentals look a little bit questionable.
And we've seen this dollar strength, and it really has upended a lot of people who thought that the ECB would do way more and that the euro would gain against the dollar, possibly even being in a better situation next year than the US. How much do you think the dollar has to run here if you do see this uncertainty pushing people toward the world's currency, and you also see a stronger than expected outcome in the economy there?
Yeah, well, you have it. You have this much more resilience in the US economy. You have Germany in recession. You have the ECB bringing down its growth forecasts for the Eurozone last week. And in fact, they still look optimistic compared with our forecast for next year. So you have all of these issues. You've got the EU elections in June. You're going to have to see concessions made towards the far right. And when I say the far right, there is a little bit of a difference here because many of these, what we would say far right in Europe, yes, they might be anti-immigration. Yes, they may be really nationalistic when it comes to cultural concerns. But actually, they have often little left-wing tendencies in their fiscal policy. So then you get concerns about the debt outlook. You've got Italy and Spain's debt rising already through some of the parameters that the EU would prefer. Does that mean there's going to be a debt crisis? Well, no. But does it mean to say that people are going to start wondering about the debt and being concerned about that debt? Well, yes. So I think there's lots of economic factors really facing the Eurozone in the next, which are going to come to the fore in the next 12 months. And I think the euro is going to be in the back foot.
A great piece on the Italian budget coming up very soon in the Financial Times this morning. Worth a read if you can get hold of a paper or the online edition. Bramo, I think I've said it a million times already over the last 2 days since we've been here. Europe, what a tough spot for the Europeans on pretty much every single topic we're talking about right now, including this one.
And this, to me, is really going to be a question going forward of how you unify a place with all of these very idiosyncratic stories, including in Italy.
20 seconds. What's your euro call then? Let's go from high-minded climate analysis out 3 years. Give me a euro call out 6 months.
We need to revise it because our forecast for now was 106 and we're nearly there. So, I haven't got around to revising it yet.
News here. Under parity?
But I would say parity next year will be being talked about.
Jane, thank you.
There you go.
Jane Foley, back to parity.
That's tradable.
Jane Foley of Rabobank. on the euro, maybe going back to parity. If you are just tuning in, welcome to the program. Equity futures right now just rolling over as Jane speaks. We're positive by 0.07%. Looking at that euro right now, 107.06.
Surging.
Parity chat, I think for the first time.
Yes.
Sweet, Tom.
Yeah,
on the
she's
euro.
fired up. She's talking about some real sea changes into your, I'm going to go back to fancy talk here. The degrees of freedom that Lagarde has, next to nothing.
Do rate differentials matter, Jane, on that front for that parity call? Is that even a focus for you?
Yes, but I think when growth turns really sour, it's very difficult for a currency to pick up some steam.
Okay, coming up, 8:30 Eastern Time, 45 minutes away. We'll catch up with Simon French, Chief Economist at Panmure Gordon. Need to talk to him about the central bank decisions this week. Federal Reserve tomorrow, Bank of England Thursday, Bank of Japan on Friday. In about 15 minutes' time, we'll be catching up with Alicia Levine of BNY Mellon. Look out for this one on the bond market as well. Big call from Alliance Bernstein this morning, 250 on a US 10-year, 250. Bear in mind, we're at 432 right now. They're looking for 2.5%. We'll speak to Ian Steely of JP Morgan Asset Management. He's like the Bob Michael of London. We'll have that conversation in the next hour. Up next here in London, Craig Trudell on the latest with the UAW strikes.
Wonderful.
Could they be bigger, deeper, and a whole lot longer if we don't make serious progress by Friday at noon Eastern? Live from London, good morning.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenevec bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
We're not waiting around and we're not messing around. So noon on Friday, September 22nd is a new deadline. Either the big three get down to business and work with us to make progress in negotiations, or more locals will be called on to stand up and go out on strike.
Very media savvy over at UAW. President Sean Fain in a video message released on social media just yesterday announcing that further strikes may come if no progress is made by Friday. The clock is ticking once again. We need to make serious progress, and apparently offers of 20% from GM, from Ford, 21% from Stellantis, insufficient for UAW and its president. That conversation just ahead. Your equity market looks like this on the S&P 500, slightly elevated, pushing higher by just 0.06%. Yields are pushing higher again by 2 basis points on a 10-year, 432.46 going into the Federal Reserve decision, TK, tomorrow afternoon.
Our special coverage tomorrow afternoon on that from London. The rumor is we came here because of Arsenal Tots. We're going to see that here this weekend, somewhat. The real reason we came to London was Craig Trudell driving all of our auto coverage here out of London, our global coverage of what they're doing in Germany and the United States, the EV revolution in China, and of course he's been distracted by his Michigan's UAW strike. What do the auto companies do? I'm fascinated. Is silence their best friend now?
I think that they are trying to follow the playbook that they're used to, right, which is keep the negotiations at the bargaining table. And we just alluded to the idea that there are some savvy communications going on the part of the union. They really are taking a different approach of really putting the terms out there, sort of communicating to their members on a day-to-day basis, really sort of whipping them up. And so there's an open question of what the heck do you do that's going to succeed to sort of, reach some sort of middle ground and be acceptable to these workers who have been sort of whipped up by their leadership.
One day in the 70s, my good friend Patrick Lynch, we were in Flint, Michigan playing music. He says, you got to see this. We went over and the horn blew, and out of Buick City came thousands of workers across Industrial Avenue to the 47 bars lined up. Jay's Bar and Grill, I believe, is the only one still left standing. That's the romance. That's what Biden wants. I don't observe that right now, do I? At all.
I don't think, I think after decades now, we've seen these companies really, shrink their presence in places like you're referring to. We will see serious investment as a result of the IRA in battery manufacturing, but it's not where we saw some of the investments in the Midwest. We're seeing factories go up in the South, factories where the UAW has, for the most part, not succeeded in organizing, foreign companies, including some of these battery manufacturers that the Detroit Three are partnering with to power those EVs going forward.
Craig, the media is often guilty, including us, of making things too simple. We talk about what's on offer and we say things like they want 36%. On offer at the moment is 20%, 21%. Can we get into the details of that? It's 21% over a certain period of time. There are other issues at play as well. Where are the big lines for you and for UAW that they think this has got to happen before we even have a real conversation about making progress here?
Yeah, I think you're talking about sort of the base wages over a 4-year term, which is how these companies operate with this union. Every 4 years, a new contract agreement. I think one of the big sticking points of the negotiations is also sort of going back to the days of pensions and the companies footing the bill for pensions that workers hired from 2007 onward have not gotten as their predecessors did. We're talking about retiree benefits, which the union took on with their own trust, and that was a big concession on the part of the union that actually, by the way, has been quite successful, but the companies absolutely do not want to take those liabilities back on. So, how serious the UAW is about getting some of those things back on top of this big gulf in wages. We're talking about serious differences across a whole host of issues, and that's not even getting into organizing battery plants that these companies are going to run with foreign battery manufacturers.
What's the company's excuse, and I say this collectively for all three of them, for why they've really had record profits and haven't really passed that along at all to workers who did give some concessions during the 2009 rescuing of these auto manufacturers?
I think they will tell you that while yes, the workers have maybe not gotten the boosts that they would have liked over the last few years, that the companies absolutely need to have strong profitability to continue to reinvest. We're talking about really significant amounts of money being put into developing electric vehicles and bringing these battery powered models to market. This is a absolute overhaul of their lineups. And if they sort of allow for their labor costs, which are already higher than, say, a Tesla, to widen even further, it's going to put them at a disadvantage and actually going to be a sort of a problem for these workers going forward. They may have to continue to close facilities as they have over decades.
Let's build on that. Ford announced some layoffs in response to the beginning of some of these strikes. Are there any other additional layoffs that are planned or expected as the strikes do roll on?
I I think that actually may be a sort of, byproduct of if we do see the union follow through on this thread of if they don't see substantial negotiations or substantial progress, by noon on Friday. The union has taken this very interesting approach of sort of targeted strikes across all three companies, and they've tried to sort of, narrow the number of workers who are going on strike to sort of make their strike fund last longer. But as a result of those plants going down, you're going to see some spillover effects at other facilities, whether that's on purpose on the part of these companies or a legitimate sort of spillover effect of some of these other factories going down. It sort of remains to be seen. It depends on who you ask.
My first interview at Bloomberg was Rick Wagoner on auto companies, and there was no discussion of EV. Now there's EV, but the same common feature between now and Rick Wagoner a lifetime ago is America can't build small cars. Is there a demand for the Chevy Bolt at $20,000 or $23,000? Does it sell, or is that not going to sell as well?
That's one of the real key issues here, as well as the fact that GM did bring a small, relatively affordable EV to market actually before Tesla brought the Model 3, but it is smaller. It hasn't sold particularly well.
This, John, I think is key.
It is absolutely an issue that to this point we've seen these companies start to get serious, start to bring EVs to market, but very few in the sort of price range that consumers are used to buying in big volumes, the $30,000, $35,000 range. So we're seeing, Cadillacs going, for twice that, or Hummers, or Ford Mustang Mach-E's. The Ram pickup is coming from Stellantis relatively soon. These are very expensive vehicles. We're talking about $60,000, $80,000.
It's nuts. Insane. And that's where the push politically is coming from. In an ideal world for these manufacturers, they'd like a labor-light, high-margin business. Wouldn't everyone? They're not going to get it, are they?
They absolutely aren't. And I do think one of the things that's going to be really interesting is, if we are able to see the union sort of leverage big wins at the bargaining table with these companies and be effective in taking the message to other companies that they've tried and failed to organize. But I think that's a huge ask, right? We've seen the union sort of try and whiff on this over decades, and unless they're able to organize, more widely and more broadly in the U.S., they're absolutely taking a risk of putting their companies at a disadvantage.
I played this game with David Welch a couple of weeks ago. We were both wrong. We said something like 20% might get it done. I know you can't reduce these negotiations down to one single figure, but I'm going to. Any idea what you think is going to get this done?
I think I'll play the easy route. I know that Evercore ISI is out with a note this morning. They're saying 25 to 30%. They expect the companies to sort of settle somewhere around there. But again, I think I go back to some of those liabilities, and whether the companies are really going to continue to push back. As far as we know, they're saying no way, and the union is sticking with those at those.
Are you really working a 32-hour work week here in London?
Feels like 32 hours a day lately.
You're setting the tone for the Detroit 3. Craig, let's do this all week. This was great. Craig Trudell of Bloomberg on the latest negotiations between UAW and the Detroit 3. Lisa, you asked the question, why didn't they pass on higher wages to their workers? Because they didn't have to, and they could get away with it.
Exactly.
And now they can't.
And to me, the big sort of discrepancy in this discussion is this isn't that big of a part of their expenses. They could do it and still survive. So what's it going to be that they have to settle on?
Their viability, their sustainability. You don't believe in the questions around that?
There's a question. I don't know.
Okay.
I'm not sure.
Okay.
Not to a certain extent, I think it might be overblown.
All right.
I've changed my tune 15 times. It'll happen again.
Might change again.
Yes,
Alicia
exactly.
Levine of BNY Mellon. Up next, live from London. This is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet. An example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port destinations.
Functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, where does it take you?
How about the Instagram? Can you about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000, 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
US labor market's all tight up compared to what we have in Europe right now.
These central bank tightening takes time to feed into the real economy.
There's also a great deal of this notion that central banks are going to be sticking to the script.
Central banks don't actually set rates. They respond to the economy.
History would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. One day before a Fed meeting, we are in London at Queen Victoria Street. Good morning on Bloomberg Radio, Bloomberg Television, across America and worldwide. In this hour, we continue the theme of a sustained and even rising equity market. Alicia Levine to join us here in a moment. And John, the whole backdrop of this for Alicia Levine and others is the change. Oil, Brent crude, $95 a barrel.
And what does it change for these central banks this week, TK? Inflation potentially higher for longer. Interesting times. We've got cycle highs basically almost on a 10-year yield this morning. We've got crude at the highs of 2023 going into a central bank meeting, which arguably should head in the direction of a better tone for risk assets, which is growth forecast higher, inflation forecast a little bit lower. Tom, I think beyond 2023, you've raised this question a few times. What is in store for 2024? Call of the morning, Max Kettner, HSBC, on with us a little bit earlier today on Bloomberg TV and radio, suggesting perhaps something that sounds like Goldilocks for a whole lot longer.
And a buoyancy here of Ed Yardeni as well coming in on it. Yardeni, of course, been on board a bull market since October. And Lisa, to me, what's absolutely amazing here, looking at OECD, global slowdown. You know, we talk about two Americas, but there's almost two worlds. There's a world that's prospering People here booming within Premier League. We're going to see Arsenal Tots on Sunday. You think about today, Newcastle, AC Milan. There's like a tourism boom. Jomo X said yesterday from AXA, there's a boom going on, but there isn't.
Or you could say there are 15 worlds, or however many you want to say. I think in the middle, what you're seeing right now is things are uncomfortably expensive. People don't want to pay that ticket to go see AC Milan or the plane ticket to get there, but they're paying it anyway. And that, I think, is the key point. If you look at gasoline prices, we're talking about oil and what that does. There's still a far cry below the $5 a barrel in the U.S. going back to June of 2022. This isn't the same kind of pressure that we've seen even a year ago on the consumer.
I mean, I look at the Gilligan's Island tour you had this summer, John, 3 islands off the coast of Italy. It was a hat trick. And the answer to me, John, is do you think that's going to ebb? Is tourism actually going to ebb? I mean, that's part of this boom.
Airlines say yes. Look at the airlines, the performance on the S&P 500 so far this month. Month to date, we're down about 9% on the airlines on the S&P 500. Two reasons. Labor costs is one. Fuel costs are going up. That's a problem. And potentially ticket prices are going down. That is a change. And I think you've got to witness that change, and this equity market is picking up on that over the last month or so.
I want to go to the strike tension. We've had some really, I mean, what we just did in the last hour with the gentleman from Michigan was brilliant here. But to me, what's wrong about the UAW analysis right now is it's all about wage. And all the other issues that Craig Trudell laid out are not being discussed. And I think they've got to be front and center.
Do you think they are basically red lines? That they're not going to drop them?
Within a negotiation, they're not red lines. There's an amendment, a justice, but I don't see anybody near amendment or adjustment.
Well, and I see this in some of the discussion around the cost of employees by some of the big Detroit auto manufacturers, because if they game it out, some people estimate that their costs go up to $130 a head on average. That is not the wage. And this isn't the take-home pay. This is all of the benefits. This is the health insurance. This is the pensions. And that, I think, gets lost. It's sort of the insurance blanket is getting that much more expensive.
The benefit blanket.
And then all of a sudden, employee costs change. And it's not just the take-home pay.
The overlay on the benefits was just wiped out 10 years ago, whatever, 15 years ago is not there. John, we got such a good guest. Let's get to the data here. Look at Euro popping up a little bit, stronger Euro.
Yeah, just reclaiming 107. Jane Foley of Rabobank on with us about 15 minutes ago, talking up the prospect of parity on the Euro into next year, given the difficulties for the Europeans relative to the upside surprise we've seen from America so far this year. Whether that spills into next year, I've got no idea. 432.86 on a 10-year yield high by 3 basis points. Talked lots about $95 Brent, 92 on WTI, 92.68. Crude high by 1.28%. Tom, and futures, I think we call it unchanged on the S&P, just about unchanged this morning.
Unchanged. We're focused on economics, finance, investment, and international relations, but we digress. We said we got to get somebody on that really can get to the pulse of continental emotion. And you're going to see that today with Newcastle playing AC Milan in Milan. And we needed to go to someone who understands the roar of San Siro like John Farrow. Farrow insisted that Alicia Levine join as head of investment strategy and equity advisory solutions. What is it like, Alicia Levine, the cultural event of Milan and that stadium?
It's alive, and it's alive for 2 hours, and they sing for 2 hours straight. It's fabulous. It's just fabulous.
Would you like to cut in, John, here with the song?
I'd like us to take away those pictures of Inter versus AC Milan, because that did not go well.
That did not go. John, why don't you pick it up here?
I can remember my first game. I watched Juventus versus AC Milan, and I remember walking up to the stadium, and the away fans get there early, so there aren't, clashes, fights, etc. And I just remember the sound bleeding out at the top of the stadium, and I was standing with my dad, and we get closer and closer to the stadium, and it gets louder and louder and louder. And you go inside, and the acoustics in that stadium, it's so unique. All the noise just rebounding off every single corner. And to Alicia's point, the ultras, the fans that sit in the Curva Sud, they do not stop. An hour before the game, through the whole game, and you hear them coming out of the stadium. It's like something you'll never see, Tom. My cousin, Fabio, is in that group of supporters that sits behind the goal, and I'm too soft to sit with them, so I sit
across America. This is religion here at Team Surveillance. John Farrow glued tonight to the screen here in London. Alicia, let's stagger to the equity markets as we can right now. We've got some bullish voices today. Can you be a bull? Are you enthusiastic about the Standard & Poor's 500?
So I'm measuredly enthusiastic, meaning we have to get through the next month or so because the kinds of risks you've been talking about, which is the UAW strike, yields at a cycle high, definitely present sort of wild cards to what is a reasonably good-looking fundamental picture. And of course, these are the things that could really derail the picture. I think that the S&P is typically soft this time of year. Why September and October we can discuss at another time, but it is soft. And yet, we have not seen tremors really in the equity market of the kind we've seen in past years, given the risks that we're seeing. Suggests to me that we're probably going to muddle through, consolidate here. I do think there's some risk to 4,200 here, simply because that would be a reasonable way to absorb some of the yield increase that we've seen, and then move forward from there. I mean, in the end, we're going to finish this quarter at close to 3%. Very hard to get a recession when your GDP on a real level is close to 3%. So even if we slow in the fourth quarter, the year ends strong. We would assume still 40% chance of recession, because in the end, higher for longer means there's going to be further tightening here in the real economy.
Alicia, just want to get your thoughts on 2024. Max Kettner of HSBC was on the program with us a little bit earlier, and he said we need to focus more on what could go right because expectations for 2024 are so low. Do you agree with that, or would you take the other side?
So I would agree with that, and we actually did the same when we do our mid-year review, and that was released at the end of June, because we decided that the focus on the left tail risk had really not been fair to what's going on in the real economy. And in the end, the American consumer has really held up this economy here in ways that I don't think any of us expected at the beginning of the year. And so it's very important to really look at what the right tail risk can be. In the end, if we have no recession this year, the earnings picture can be closer to 225 by the end of the year, and then you grow from there for 2004. If you have between $240 and $250 per share for the S&P in 2024, markets can get over 5,000 to 5,200, which is what we have in print. And that really sets you up for a nice rebound even further from that. A slowdown is not a recession. In the end, even though vastly every time the Fed has tightened like this, we've had a recession, what's different this time is the antecedent. And the antecedent is 12 years of near zero rates. And as we know, that has cushioned households and cushioned corporates coming into this tightening cycle.
Everyone was saying that this rally had to broaden out to be sustainable, and it sort of did for a second and then backed away, and tech kept leading. Is that going to be the dynamic going forward? Because that is truly the growth area. And some of these other areas, like airlines, like auto manufacturers, face some of these headwinds that we've been talking about.
Right. So look, we do need to see the broadening out here. Look, in the end, 97% of the energy names in the energy sector are above the 200-day moving average. Only 62% in the tech sector are above the 200-day moving average. So it is broadening out in a way. I'd say this. I think that tech has to participate. It cannot lag. It cannot lag. If tech lags, it's going to be very hard to get the averages up. Obviously, it's simple math. 40% of the average is communication services and tech. So we do think that the yields here could put a ceiling on some of the multiple expansion that we've seen in the tech sector. But if earnings are moving higher overall, that will support the market.
How bullish are you, just on a scale of full bull to bear? Where are you kind of sitting at this moment?
As I like to say, we're paid to worry. And so I would call myself between a 6 and a 7. I think the fundamentals are very good in the real economy, understanding that there's some softness in some parts of the consumer sector, and yes, some balking at paying some of those fees. Airline fares is a great example. But I do think overall the cushion that households have in fixed rate debt, as well as the corporate sector, I think that's good. I worry more about a yield-induced issue somewhere, whether it's the corporate real estate market or elsewhere. I think that's the place we have to look to where this rosy story may stumble a little bit. So I see it less on the fundamental side and more sort of what's going on in the sectors that are really very sensitive to yield still.
Alicia, thank you. Just wonderful to catch up with you. Alicia Levine there of BNY Mellon Wealth Management, and thank you for sharing your vacation with us, which sounds absolutely wonderful, Tom. 2 AC Milan games, a trip to Monza, all in the space of a couple of weeks. Does it get any better than that?
You know,
just awesome.
It's like, you know,
slice of that
Lisa and I are working all summer, and we're in New York, and like the closest we got to an
took off half
island.
of August.
It's true.
The closest we got was an island called Manhattan, and
it's a great island. Lots of people go on vacation there.
You're doing a George Clooney imitation.
Where else did you go, Bravo? Alaska, Costa Rica.
Yeah.
It's you that didn't go anywhere.
Yeah, well, yeah.
If you're just tuning in, welcome to the program. The S&P positive here by 0.07%. Yields are a little higher by 3 basis points, 432.86 on a 10-year. Simon French of Panmure Gordon joining us in about 15 minutes' time. We'll talk to him about the Bank of England decision on Thursday. We'll talk to Bramo about Bramo's new scale, which is full bear at the one end and full bull at the other. Is that new?
Yeah, I feel like we should actually have one. I feel like
we should have a scale, sure.
Have to place themselves
that they've got
on
to identify
scale.
with when they come on the show.
Exactly. When they come on the show, they have to identify where on the scale they are and then justify it.
It's that kind of market where people are making some real conviction calls here to 2024. John, you mentioned outlooks are coming out, and you know that's what we're going to get to. Off the camera, Jane Foley was really quite good, John, about, you know, we talk about the scale, the bet, the politics going on right now. The delusion we have in London of the prosperity of London versus the rest of the United Kingdom. And among others, Mark Carney has mentioned this to me before as well. And it's not like Paris and the rest of France, but there's some real stark differences in the
Every
United
country's
Kingdom.
got a major city.
Yeah.
And in the UK, if you take London out of the equation, there are some difficulties.
Yeah.
Without a doubt. Without a doubt. Coming up on the bond market, Ian Steely of JP Morgan Asset Management. What did we call him? London's Bob Michael. We'll see if Ian likes that. Up next on the programme, live from London, this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
We could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
Central banks don't actually set rates. They respond to the economy. The Fed, they are finally caught up with the curve. Yeah. That doesn't mean they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
Marvin Barth, founder of Thematic Markets. Can I just say how quick Bob Michael is? So I refer to Ian Steely as London's Bob Michael, and the real Bob Michael appears literally around the corner. Ian, does Bob let you go out anywhere without him? You know, it's like
the shadow of Bob Michael.
Seriously,
compliance issue.
Is that what that is? Ian Steely is going to join us in just a moment. Really important statement has just come through from the UAW president, Sean Fain. I want to share it with you. The former president, Donald Trump, would very much like the support of UAW. I can tell you based on this statement, he's not getting that. Every fibre of our union is being poured into fighting the billionaire class and an economy that enriches people like Donald Trump at the expense of workers. We can't keep electing billionaires and millionaires that don't have any understanding what it is like to live paycheck to paycheck and struggle to get by, and expecting, Tom, them to solve the problems of the working class.
And this is the charm of the President of the United States. You can argue about it all you want about, money that's come in for Joe Biden late in his life. But his entire tenor here is, I was in Scranton, I've been at those kitchen tables, and all the other fancy people in Washington haven't.
That's the pitch. Here's the problem. Billionaires and millionaires. I would take that statement as not just pushing back against the former president, but perhaps the whole political class in Washington, D.C.
Yeah.
Many of which senators in that Senate currently are millionaires, and the president also is one of them as well.
And the calculation here, and I don't have any wisdom on this, is public sector and massively diminished private sector unionization. These are dialogues of another time and place, and the numbers aren't there like they used to be.
Well, my question is, we've seen Republicans try to court some of the Rust Belt and try to get and pick up some of the discontent
they have.
Seen, and they have. And Donald Trump was planning to go there on September 27th to Michigan to stand in solidarity with the UAW in rival programming to the next Republican debate. Will he still go if this is the line?
Well, what's he going to do? Is former President Trump going to say, I believe in a defined benefit program? I mean, those are the issues that we heard from Craig Crudell that we aren't talking about now, besides pure wage, and are they going to make more than an Amazon warehouse worker?
I can't guess what Sean Fain is going to do, the UAW president, but if we were to base our assumptions on that statement alone, that is not a UAW president that wants to go out there and campaign with the former president, Donald Trump. And if the former president wants the support of UAW, based on what we just heard there,
I believe these executives, including Mari Barra, talking to David Weston, these are millionaires and billionaires. Well, maybe they're not billionaires. I don't want to stretch it too far. Maybe Bill Ford is. But the bottom line to your point on millionaires is that's a statement against the executives as well.
It's the political class.
Yeah.
It's on the political class who have spent a life in politics. And I'm not talking about the former president here, obviously, but those who have spent a life in politics and have managed to amass amazing fortunes over that period. And the failure of them to protect the people that he's meant to represent that work for these institutions in Detroit.
In our Fed coverage tomorrow, this will be addressed. I can't imagine it has got to come up in the press conference. Michael McKee, of course, in attendance there, as always. Right now, this is always timely. Is Ian Steely with us? He's International CIO within Global Fixed Income, Currency, and Commodities at JP Morgan Asset Management. He has to share a desk with Bob Michael when he comes into London as well. John, why don't you bring in Mr. Steely here, because you are...
I'm not sure Ian wants to talk to me anymore, but I'll try.
More. I can see Bob over his right shoulder. Hi, Bob.
Ian Steely at JP Morgan Asset Management joins us now. Ian, fantastic to have you with us on the show. Let's just get straight into the bond market. We've got this amazing call from AllianceBernstein this morning, 250 on a 10-year. You and the team are pretty constructive on the long bond, let's say the 10-year. How are you thinking about what this offers currently at 433 on a 10-year in America?
I think you've got to say it's a pretty good valuation. For those people who wanted, to buy back into the bond market earlier this year, we had that rally. We've now sold off again. We're back at the highs of the cycle. When I look at what's happening on both the inflation picture, we are trending down in core inflation over the last 3 months. The jobs picture is trending down as well. We know we've got student loan paybacks. We know we've got tax in California. We know we're coming towards the end of those excess savings. It feels like at 430, that's a pretty good environment to be buying back into the bond market.
Brahma wants to get in here with some intelligent bond questions. I'll ask you a dumb question. Are you clipping the coupon, or can you really invest for total return in the next 12 months?
I think it's a total return. I think, well, firstly, you've got the coupon, 4.3%. That's some of the nicest yield that we've seen in 15 or so years. And then you have got an environment where if we do start to slow, the Fed does start to feel that growth slowing and they need to ease policy, then you're going to get some pretty decent capital returns. And if you look at previous hiking cycles, once the Fed pauses, the bond market does very well and it does much better than cash.
We were talking about the AllianceBernstein call of 2.5% on the 10-year by the end of next year. And John asked the good question of why, right? Is this because of a huge drop-off in growth or just a moderation in inflation? Is that sort of what's underpinning a Fed that reverts back down to something lower? What's your call? What's underpinning your bull thesis here on bonds?
I think it's a combination of two, both of those. So we are seeing that moderation in inflation. We are seeing inflation coming back down towards where the Fed would like it to be. And then we do see the growth weakness. And I think the Federal Reserve, and we'll hear from Powell tomorrow, I do think they believe that they are restrictive and that as the lagged impact of policy, and I think, a lot of people saying, how lagged are these impacts? Well, I think actually, a lot of people invested or a lot of people borrowed at very low levels. They've locked in those low yields, but they will start to come through. And I think that the lagged impacts are going to take a hit next year. So you are going to see that slowdown in growth.
So does this counteract this idea of Goldilocks forever that we were hearing from Max Kettner, or actually by John, but that he reiterated?
Max Kettner.
Max Kettner, that he said. Or is this basically pushing back against that and saying this is something a little bit deeper than that and maybe a little bit more pernicious?
So we're obviously in this Goldilocks scenario at the moment. The market's basically picking up on the fact growth's coming down. We're slowing from an inflation standpoint, but we're not rolling over just yet. But I think we can't have Goldilocks forever. We are going to start to see biting within the growth standpoint. And I think what's happened this year is we've had a lot of support. We've had a lot of support on the fiscal side. We've still had all those payments, all those checks, all that monetary policy, all that fiscal policy that came through in the pandemic, wash its way through the system. I think we're now coming towards the end of that. This period, this Goldilocks, this slowdown period is taking a little bit longer than we thought. But when you look at historical periods, again, there's very few instances, the mid-90s probably been the only one, where we've had that slowdown without dipping into a recession. But you always feel at this point that it is the Goldilocks. It is the best environment until we actually start to dip over.
Bramo wants to geek out, so we can, with a May 2050 Treasury bond. We did this great story in the last 24 hours about how it's trading at sub 50, the price damage done to that long bond. And within the story, they talk about positive convexity. Can you just talk to us about that as a concept and the opportunities that lie in, say, the longer issued debt, the longer maturity debt after all this price destruction over the last couple of years?
So let me start by also saying, let's take a look at the UK gilt market and look at some of the long-dated bonds there that are trading in the 20s and the 30s. So even more so. So
wow.
for US listeners there, so you're doing great. Look, so what you do is that bond, in the end, is going to pull its way back towards par, because ultimately you get par back at the end of the life of that bond. So you get the capital appreciation on that, although you are clipping a slightly lower coupon than you would like, but you'll get those capital gains come through as the bond moves back towards par.
Can you bring this to my Austrian bond, which has been a disaster, my 97-year piece? Do I have positive convexity in my 97-year tanked Austrian piece?
It will have a similar situation. It's just going to take a little bit longer to get there.
50 years. Ian, that's just great.
Ian, this is great. It's good to see you. Ian Steely of JP Morgan Asset Management. It's EK, some real price destruction, and you've been on top of that, Tom, over the last couple of years.
The price destruction's there, and this is to the other side of the debate of AllianceBernstein. If you look at the Bloomberg indexes, folks, they're very valuable. We're not on support. I'm not going to give it a lot of angst, John, but the fact of the matter is, you get higher yields, you get some real technical breakdown.
We've got high yields this morning, up 3 basis points, a 10-year 433.46. Up next, Simon French of Panmure Gordon.
They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Housing data due in about 20 seconds' time. We'll get housing starts, building permits. Mike McKee's going to break that down for you. Going into it, equity futures on the S&P just a little bit higher, up by almost 0.1% on the S&P 500. The NASDAQ totally unchanged going into the Federal Reserve tomorrow afternoon. Your bond market is set up as follows: 2-year, 10-year, 30-year. The 10-year yields a little bit higher through much of this morning, up by 3 basis points. The 10-year 433.46. With that economic data is Mike McKee. Morning, Mike.
Good morning, guys. It looks like another good report for housing starts, down 11.3%. I'm being sarcastic there. Now, how much of that is weather and how much of that is a drop-off in home builders' outlooks towards the industry is going to be an interesting question to ask, because we did see the National Association of Home Builders report lower traffic among customers and a decline in their optimism index earlier this week. Building permits were up 6.9%. So perhaps it was a weather-related thing. Perhaps it was just a slump because it looks like they still are interested in getting some kind of business out there. Let me see the press release. You guys, I don't know if there's any reaction in the markets to this given the Fed tomorrow, but if you've got something, let me know and I'll find out if there's anything more interesting in this number.
Yeah, Mike, never usually get big moves off the back of this kind of data, but it's interesting regardless. Michael McKee, thank you, sir. Yields up just a little bit by 3 basis points on a 10-year, where we were, 433.86. On a 2-year yield, higher by a single basis point. Again, basically where we were at about 5.07%. Just to check in on foreign exchange, we'll finish on the euro here. The euro, a little bit early this morning, getting back through 107. We were in and around 106 for much of the last couple of weeks. 107.12, positive here by 0.2%. The last data point, I guess, setting us up ahead tomorrow, Tom, for the Federal Reserve tomorrow afternoon, with all the forecasts we're expecting from Chairman Powell and the committee.
The Fed tomorrow afternoon, a lot of good coverage on that. Of course, we will be covering the meetings here from our studios in London. And just as important, we follow on to other central bank discussions. Simon French, Chief Economist Pamela Gordon, has been just wonderful with his experience in the British government of framing out a governor of the Bank of England who said, well, we're not going to declare victory. And boy, has the news come down the pipeline since Bailey said that. What are the ramifications of higher interest rates in the United Kingdom?
Well, we think there's about 60% of the 515 basis points delivered by the Bank of England still to crystallise, principally for the household sector in the UK. And that lagged effect is an elongated lag from previous economic cycles, where the structure of the UK housing market, secured debt market, was very different. And that is why I think Andrew Bailey has a really difficult task on his hands later in the week, because all the indicators I'm seeing is with that long lead-in time and the majority of the impulse still to come, we're seeing quite a rapid slowdown in payroll wage inflation. We're seeing a slowdown in core inflation. With the 18-month, 2-year lag, whatever frame, we think it'll peak around Q4 2024 in terms of the tightening of financial conditions for households. He knows that. He sees the inflation picture coming down, and yet he's allowed markets to guide the policy expectations rather than lead them.
Durham, you were steeped in the economic history of all this. How close is the United Kingdom Bailey analog to the United States Powell analog? How separate are those discussions?
I think they're really separate, actually. And I think the last time I was on the show, I talked about the biggest decoupling of the policy environment in Europe from the United States. But it's not just the pathway, it's also the management of market expectations here. We've had some speeches from the MPC, the Monetary Policy Committee, from the chief economist Hugh Pill in South Africa about 10 days ago, talking about a potential plateau, but the market basically didn't believe that and sees the likelihood of a 25 basis point of about 80% as I left my terminal earlier. That is not where the Bank of England wants to be if it's going to carve out a narrative based on the latest data points, which show quite a rapid sharpening of economic momentum, but also price-setting behaviour in the UK.
I won't allow the point you're making to get lost. This is so important. I landed here over the weekend. I read the recent communication from the Bank of England. Then I looked at all the economists' expectations, and they were saying hike, and the Bank of England was basically saying we're not hiking, and I couldn't make sense of it. Are you saying that Threadneedle Street is a massive credibility problem at the moment, and basically the markets are in charge?
Yes, I am. I think they're getting the wrong sort of criticism. They're getting criticism for being too slow in terms of takeoff on the policy path, but actually they moved earlier than the Fed. They moved earlier than the ECB. Actually, it has been the communications through this cycle. Part of it's been quite cumbersome in terms of getting into the wage bargaining negotiation, the profit margin negotiation with corporates, with the household sector. That's not the role, as I see it, of central banks. Central banks, if you see a dislocation between the way the market is pricing your optimal path for monetary policy for financial conditions, you intervene. And it can be quite close to a policy meeting, which is to Tom's question about the decoupling between the Bailey-led Bank of England and the Powell-led Fed. They've been reactive, not proactive in terms of managing expectations for this meeting. And it's been a regular pattern, unfortunately, over the last 18 months.
So even though you don't think they should, do you think they will hike on Thursday?
It's difficult, isn't it? I'm very clear that my reading of the data, and look, I don't want to sit here and pretend that I have a better reading than the 9 members of the Monetary Policy Committee, but I do think that the market has allowed itself to get expectations of a rate hike that I think the Monetary Policy Committee probably look at the latest and the most timely indicator of core inflation and wages, which they set out to their August Monetary Policy Report with their key data points. Those have slowed in July. Those have slowed in August. That's the new data that's come into the marketplace. Taking account of that, there's only 6 weeks till the next policy meeting when they'll have a new set of economic forecasts. You can pause that one out. You can say we're aligning ourselves with the potential pause in the US and in the Eurozone and not be an outlier. You don't want to be a monetary policy outlier in the UK.
There is a question, though, about a reacceleration in inflation, especially on the heels of oil prices that have been climbing. We just got news from Canada that inflation came in at 4% year over year in August versus a 3.8% estimate. We have seen this again and again. What's to say that there isn't something underpinning those inflation figures that will reaccelerate, that does warrant what we heard from Jennifer McEwen, which was a 50 basis point rate hike at Thursday's meeting?
You speak to exactly why an extra 6 weeks is most valuable, because those oil price assumptions, we're seeing similar turbulence in soft commodity markets, a leading indicator of food price inflation. The Bank of England redoes its forecasts in the first week of November. In fact, it does it in late October. It will have at its disposal for the MPC the type of impulse that will come through from those higher prices in terms of headline inflation and the potential second-order effects in terms of core price setting. Why would you not give yourself the optionality of an extra 6 weeks to appraise those leading indicators, but also model the impact of those core inputs?
If what you said earlier, though, is true, that this is a central bank that has lost credibility and lost the plot, then wouldn't you see a pound that just weakens dramatically if they were to do that, if they were to pause, even in the face of people saying you need to hike and you need to hike more aggressively?
My reading of the way people are trading sterling, it's not based on a spread of central bank policy rates. It's on a spread of credibility. If you do a credible pause, you enhance your credibility. I'd expect sterling to strengthen against its major pairs, against that backdrop. If you deliver a message that says, we understand how this economy is evolving, we're in front of the data, we're guiding the market, rather than being reactive to each bit of pricing that they're seeing.
We got a bunch of thugs asking questions of Jerome Powell here tomorrow. What question would you ask Jerome Powell?
Well, I'd be fascinated to see what the FOMC come out in terms of long-term R-star. I think for me that's the key data point in the summary of economic projections we get. Do they believe it's still in that 2.5 to 3.5% range, given all the way out to 2 years we're seeing potential Fed funds rate north of 5? Have we reached a situation where actually the FOMC have got to throw in the towel in terms of long-term R-star and the repricing that would have across equity markets, fixed income markets? That
would move the markets.
Do you think they're ready to do that?
Well, ask the question. You might be surprised by their propensity to give you an answer.
Just didn't seem to go there in Jackson Hole.
Oh no!
In the speech,
this is the skill of the Bloomberg team. So
Mike
that out.
Mike McKee's better at this than I am. Williams will go there. The New York Fed president. What's the guidance you would take from a man like that on where this might be going?
Influence. So the degree with which a debate. You're right. Almost certainly, Jay Powell is far too good an operator to even get tempted into that debate. The degree to which other members of the FOMC can start to frame that debate and say, actually, part of, and we've seen financial conditions loosen quite appreciably in the US economy. Part of keeping those elevated actually is to have that debate in public, such that markets can understand what that pathway is for long-term R-star in the US economy. Because at the moment, the summary of economic projections do not tell you that story.
Liz Ann Saunders was brilliant on this yesterday. John, looking at the Bloomberg Financial Conditions Index, it's screaming accommodation right now.
This speaks to a phrase that Lisa used, re-acceleration. And I think we're talking about the UK at the time. In that conversation, in that part of this conversation, the prospect of re-acceleration in the US, something that we've heard a few times from various guests, is this current disinflationary trend is transitory. Would you go that far?
Oh, the dangers of using that word. Look, there is no doubt. I mean, if we're talking in the context of the US economy, the oil price is more significant. Actually, domestically in the UK, the gas price is more significant, which hasn't taken place or hasn't moved up in the same way. Look, central banks have carved out in the last 6 to 9 months a focus on core inflation. And therefore, are we now going to sort of pivot back to focusing on headline inflation? And given the impulse seems to be through the oil and commodity markets, that's going to be the first order impact in pushing headline inflation. It means feels like you're moving the target every single time the data doesn't conform to your narrative. We're talking about credibility. Talking about the credibility of central banks, you've got to be consistent through the cycle, not just to fit your narrative.
If I could put you in a press conference right now, it wouldn't be the Feds, it would be the next Bank of England's decision in a couple of months' time. That decision, is it November? The November one with the news conference. That is going to be, what are those forecasts going to look like for inflation, do you think?
Well, in terms of, this is why it's the opportunity to talk about how the relevance of gas, wholesale gas in the UK economy being the more relevant one. Actually, I suspect the expectations for inflation will actually be lower for 2024 than we saw last week from the ECB. Remember what spooked the markets in terms of a north of 3% inflation print in the Eurozone in 2024? We got it from the OECD today, 2.9% in the UK. I think the bank will back into that forecast, a sub 3% forecast for CPI, because of the relevance of gas, which on the 2-year curve is about 80% lower than it was in the summer of 2022 when UK macro became the front page story. We had Yellen talking about it, Larry Summers talking about it because of the mini budget. But it was not just the mini budget, it was the dislocation of gas prices and how impact that is on real incomes in the UK.
You're talking natural gas.
Natural gas.
See, in America, we would say petrol. Petrol, we confuse that. We say
gasoline and
I allow you to translate my ropey narrative, Tom.
I said, keep up with
We're
you,
in
Simon.
London.
I did the
I was going to start singing Mary Poppins to you.
The liter of gas 2 hours ago, we were talking about where does it hurt in the United Kingdom, like where will it actually affect Bank of England. There it is, John, $7.57 per gallon, $2 per liter.
It's brutal. I also can't believe
Did I spell liter correctly there?
It's the 1 year anniversary of the mini budget, isn't it? It's on Saturday.
It is.
Simon, thank you. Always a pleasure. Always learn something. Simon French there of Panmure Gordon. If you are just tuning in, welcome to the program. Your equity market on the S&P 500 is slightly negative. We're down here by 0.06%. Elsewhere in the bond market, yields just creeping higher, just a little bit more, by another 4 basis points, Lisa. 34.66 on a 10-year in the FX market. We're not doing much at all. 107 flat on the euro against the dollar, and crude just short of 93 on WTI and back through 95 on Brent.
So here's my question, and I was listening to Simon there about oil and how much the Fed should care about it. The problem is it it goes into goods pricing. And goods pricing is what people see potentially reaccelerating in the U.S. And the key here is if people pay the higher prices, then it is inflationary. If there still is enough demand in the economy for people to be able to absorb that type of price inflation, that's really the concern. So you can't strip it out entirely. It can't be too cute about just saying this isn't going to go into the picture.
Away from the City of London, away from Wall Street, it confuses people. In fact, I think it angers them when we all start stripping out the things they have to pay for, like energy. And if there's one thing that shapes inflation expectations in America, the one thing that I've learned living there for the best part of the decade, it's the price of gasoline.
Well, yeah, certainly if you're responding to the University of Michigan Sentiment Survey.
Precisely. And we're sitting here saying, yeah, you can strip that out.
Right.
You can strip this out.
Exactly.
And things are improving. Coming up, Peter Trubowitz of the London School of Economics. Equity futures just a little bit softer. Your opening bell about 45 minutes away. Live from London. Good morning to you all.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
One of the things with China is they often make mistakes, but they typically don't continue making them. And so it's, in a way, a matter of time before they make the appropriate adjustments and start growing again. But in the short term, I think it's going to be somewhat difficult.
It's been far more difficult than we thought it would be. That was Stephen Schwarzman, the Blackstone chairman, CEO and co-founder, speaking a little bit earlier on Bloomberg Brief with Danny Berger. Danny Berger, Manus Cranny, every single day, weekdays, Monday to Friday, 5 a.m. Eastern Time on The Brief, newly launched. Look forward to that program every single morning. Equity futures on the S&P 500, a little bit softer here, negative by 0.1%. Just pulling back a touch here as yields drift higher again. Up by almost 5 basis points now on a 10-year. 434.86 in the last day or so, last couple of sessions, Tom. We've come really, really close to new cycle highs on a 10-year yield. We're breathing some life into that move again off the back of this move in crude. 95.20 on Brent, 92.80 on WTI.
To correlate this, I would take the move on Brent crude, 95.21, right up near the intraday high, 95.28, and say, given 3 central bank meetings, do we get the U.S. 10-year inflation-adjusted yield nicely through 2%? I don't think that's modeled in the market. That's signal of higher real rates.
The conversation I was hearing this morning off the London desk, Lisa, was whether we should be breathing some more life into this Treasury short off the back of this move in commodities. And then maybe there's this feeling that this $90 price doesn't last that long and you can kind of look through it into next year.
Which is a reason why the disruption from higher oil prices isn't really getting framed out in markets in any kind of catastrophic way. right now it's sort of something to watch rather than the front and the focus.
We'll just, have to see. I think the data flow here, there's a deceptive stasis to the market right now. How long have we been at 4,500? How long has the VIX been 13.XX? And my operative word is deceptive, and that boom, something's going to happen at some point.
There's nothing quiet about this rally.
Yeah,
in crude.
Exactly.
It's something like a 35, 37%.
Well, look, there it goes. It's bursting right now through.
95.50,
on radio,
basically.
Yeah. Well, there we are. Lisa, what do you got? You got some?
Yeah, I just wanted to look at a couple of names. Stellantis in particular. We've been talking about the auto strikes. Stellantis in this case. Those shares are popping. They're up almost 2%, and this comes after the North America Chief Operating Officer, Mark Stewart, was speaking in an interview on television this morning and saying that Stellantis has the inventory to offset the strike impact. So that's some of the communication there. And then with
an odd thing to say, isn't it? Sorry to jump in.
Yes,
Isn't that a strange thing to tell UAW? That we can cope with a harsher strike, bring it on?
It's either strange if you think that it would hurt them, or it's basically a bargaining chip to say, your fund's going to run out before we can really feel the hurt.
Did they have the inventory of Jeep Wagoneers and stuff because they weren't selling?
Well,
or the
that's a whole
Broncos
other
are selling
question.
like hotcakes.
And we can explore that tomorrow. I do just want to bring you two other names that I thought was interesting.
No, we want to talk Stellantis. No, we don't. Don't worry.
But here's my issue. We've heard so many personnel stories of mysterious exits recently, haven't we? Of like different CEOs, et cetera. The latest, Block shares are down by more than 2% after the company said that the head of its Square Payments unit was stepping down. It was a surprise. Jack Dorsey is taking over.
So Dorsey's back.
Dorsey's back.
Okay.
With the beard and some very interesting Instagram posts.
Fire dancing.
That was something else. Okay.
Yes, is that what you were talking about, right?
Course, that's what I was talking about.
I saw that.
And then CBOE, another one with a personnel issue. Edward Tilley has resigned following an investigation that determined that he, the CEO, didn't disclose personal relationships with colleagues. Another one of
a lot
these.
Of that, haven't we?
Exactly. That's what I'm saying. Yeah. This is not the first time. So
Who's the one recently?
It's in the
yes,
air.
BP.
It's BP.
And that was a real question.
I mean, it's every morning you pick up the paper, and there's more of this stuff. People are handling it well in terms of PR and that, but it doesn't go away, does it?
And we always want to know what's the story or the personal relationships. Then we never find out. I always look.
We're going to continue forward now.
The gossip pages.
Of course, we all do. Come on.
SIBO.
We'll move on.
We're going to move on. We're going to continue forward now. Always a high point in London to speak to someone from the faculty of the London School of Economics and Political Science. And this is Peter Trubowitz, an American voice in London here, professor of international relations, and of course working with the August Chatham House as well. I've got one insight I want to go to, and this goes back to your work at Texas in the fabulous LBJ School. You and I are the only two of a certain vintage in London that actually remember stunning on a Sunday night when the President of the United States spoke to the American people and said, I'm not running again. It was Vietnam. It was a crushed LBJ, and there he was walking away. What are we going to see from Joe Biden? Given all the flurry that's out there right now, you are truly a student of this. How does a president exit lightly if he's going to?
Well, I'm not sure we're going to see a bombshell like the LBJ bombshell. I mean, if you go back, that's an interesting comparison. I think LBJ not only lost the support of the American people over the war, but critically, he lost the support of the party leadership inside the Democratic Party. And I think right now what you see in Biden's case is while support is down in the polls among Democrats as clearly among Republicans, I don't see any movement among the Democratic leadership. That's what we would have to see first. We would have to see some cracking in that support. He's always got a way out. He can always say that he saw himself as a steward, right? But the concern is who would be his replacement. And there's a lot of concern inside the party that it would be Kamala Harris. So this is the issue.
I was reading Rick Atkinson's World War II, and I was flat. John, I got this so wrong. I looked up Winston Churchill's age in 1944, and he was a fossil. He was gerontocracy. How in God's name did the United States get to the fossil administration and legislative branch we have now? How did we get to gerontocracy?
Because I think we've had too many presidents who have not been basically curating the next generation. is true of Obama. It was true of George W. Bush, certainly true of Donald Trump. That's the job. The president needs to bring on the next generation. So you could say that Biden has at least made a move in that direction by virtue of who he picked.
Starmer and Sunak are a breath of fresh air. I mean,
I won't offer my opinion on their personalities,
no, I don't mean
Tom,
it, but they're younger.
Certainly younger.
But they're younger.
Parliament's a whole lot younger than the Senate as well. I'll go through the theory, Peter. The theory goes something like this, that the president's not going to make a run for 2024. What he's going to do is draw this out to try and make the primary short. The logic being that if you have a long primary, it shifts the candidates towards the extreme, and he doesn't want the party to go too far to the left.
Yeah.
So he's going to make this call late. What would you say back to that?
I think it's possible, but the problem there is that you don't really give someone enough time to get traction. Who's the heavyweight? Who's the heavyweight in the shadows? From California? He's going to pick up red states?
That's the talk.
Well, I know that's the talk, and so you're asking me, and I'm telling you, I don't know. I mean, I think it has some credibility. I mean, I would think I'd go to Michigan if you're going to go for a governor.
Oh, you have got someone in mind then?
Well, I mean, you can play this out, but if you're not giving somebody enough time to generate financial support, build up a head of steam, I mean, it is true, if you went with a younger candidate matching up against, let's say, Donald Trump, there would be some real daylight there.
What are you expecting to hear from Biden today? What are you listening for?
In that speech, I think that speech is going to be principally geared towards countries in the global south. I mean, some of it will be about Ukraine, and there will be a pitch there. But he's got a great opening here. Putin's not there. Xi Jinping is not there. This is the time to double down on appealing to the global south. There's been a lot of movement in that direction, and he's doing stuff on the sidelines there. I mean, this afternoon, I think he'll be meeting with 5 members from Central Asia, from the stands. And that's the purpose of that, is to expand U.S. influence, go back into Central Asia, and build up a new flank. This one on the west. The other, he just recently tightened relations with India on the south, and of course brokered the rapprochement between Japan and South Korea on the east. So I see these as, so I think that's part of what's going on, at least on the sidelines. But I think the main focus, in addition to Ukraine, will be what the United States is doing for developing nations.
Interesting. Peter, thank you.
Good to be with you.
I would love a longer conversation at some point on this EV transition and the international relations of all of that, because it's fascinating at the moment. Peter Truvitz there of the London School of Economics. Thank you, sir. Coming up on Bloomberg a little bit later today, 11:45 Eastern Time, Jens Stoltenberg, the NATO Secretary General, live from the United Nations, alongside Bloomberg's Anne-Marie. That is one you don't want to miss. Coming up tomorrow, our Fed coverage on the Fed Special. Jim Karen, Morgan Stanley, Kathy Jones, Charles Schwab, Matt Lazzetti, Deutsche Bank, Diane Swonk, Andrew Hollenhorst, Greg Peters, and Jim Bianco tomorrow.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now.
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
From New York City for our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. We are looking at equity indexes doing a whole lot of nothing as we wait for the Fed tomorrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, markets on edge as the Fed kicks off its two-day policy meeting. Oil extending its rally with prices hitting a 10-month high, and the UAW preparing additional strikes unless serious progress is made by Friday at noon. We begin, though, with the big issue, surging oil threatening the soft landing.
We're seeing oil prices on the rise.
Higher oil prices matter a lot.
Oil is really important.
Higher energy prices are a major risk.
It's going to be problematic.
Might affect consumer sentiments, and that should weaken the case for the soft landing.
We're going to see this getting passed through, not just at the pump, but in transportation costs, delivery costs, input costs.
If oil prices go up, what does the Fed do? The Fed is going to be paying very close attention to the path of energy prices ahead.
They are going to be cautious. If we're looking at an oil shock at 120 or something, significantly higher than today's levels, number one, I think that becomes a huge problem for the Fed.
If the OPEC Plus keeps on restricting supply, oil prices can go higher.
But price of oil is going to keep going up.
It could go above 100 in the next couple of weeks.
Whether we're going to have a true soft landing, rather a short and shallow recession, is still an open question.
Joining us now to discuss that open question, JP Morgan's Bob Michael and PGIM's Greg Peters. We are, gentlemen, continually asking over the past couple of weeks, or rather Farrow is, and I listen to him on surveillance, whether or not this rising oil prices and really rising rates is going to put an end to the soft landing narrative because it's engineered by OPEC, or is it a sign rather of demand and a growing economy? Bob, let me get your take first. What do you make of rising rates and the rising oil price?
Yeah, hi, Matt. I think this is certainly OPEC engineered. This is cost push inflation. It's very dangerous for the consumer because a consumer which has tapped out their excess savings and put more on their credit card now has to face higher prices at the pump. And I don't know that they're prepared for that. It reminds me that over the decades, we've always looked at spikes in oil prices have preceded recessions. I think we may see the same thing again.
Greg, what do you think? Do spikes in oil prices and the end of hiking cycles precede recessions?
Well, it's a complicating factor, no doubt about it. I think the real challenge on the table is what can the Fed do about it? And I think the short answer is nothing. And so it's going to be very tricky, I think, for Powell and other central bankers to kind of include the oil narrative into the mix here. And so, Bob's quite right. It does put additional tax on consumers, but ultimately will it complicate the Fed's mandate and whether they need to pause or continue to raise rates.
In terms of what we're seeing on oil, we spoke yesterday with the CEO of Chevron, Mike Wirth. Listen to what he had to say.
Sure looks like it. We're certainly moving in that direction. The momentum, supply is tightening. Inventories are drawing. These things happen gradually. You can see it building. And so I think the trends would suggest that we're certainly on our way. We're getting close.
It sure looks like it. We're on our way. What he means is 2 $100 barrels of oil. Greg, how complicating will it be if we get over that, big round number?
Well, it's a confidence issue, right? And so we're in a very tenuous spot for the consumer. They've blown through their savings. Mortgage rates, interest rates are much higher. So there is a dampening effect here. And so is this the event that really kind of pushes them to kind of retrench and recede? I don't know. They've been incredibly resilient thus far. Just because they've been resilient doesn't mean they will be going forward, though, and I think that's the trick. So, this is yet another complicating factor for investors, for the economy, and for central bankers.
Bob, what do you think? I mean, does $100 oil, does OPEC Plus work kind of hand in hand with the Fed to push us into a recession?
I don't think they're working hand in hand, but this does remind me a lot of the first half of 2008 when energy prices were going wildly higher, and we were sitting around a table saying, you know what, maybe the correct central bank response is to ease monetary policy, because in a rather frail economy with housing under pressure, the consumer can't take a spike in oil prices. And then magically in July, the ECB hiked rates, thus ensuring a recession. So I think this is a tricky one for the Fed. I would do nothing if I were them and just wait to see what happens over the next couple quarters.
All right. My use of the phrase hand in hand was meant, of course, tongue in cheek. We have just one day until we get the Fed decision. The meeting kicks off today. We get the decision, obviously, tomorrow. Bloomberg's Michael McKee joins us for more. So what do we get here, Mike? Is this a screaming hawkish pause, or is it just like an inside voice hawkish pause?
I think Bob gets what he's looking for in terms of the Fed doing nothing. Right now, we've got a 1% chance, less than a 1% chance, according to the financial markets, that the Fed raises rates. So then it becomes a question about what they say rather than what they do. And we get new economic forecasts that could tell us something about that. Look at the bottom line there, PCE inflation. If the Fed thinks that inflation is going to be lower than what they had forecast for the next 2 years, then you're probably going to be looking at an end to the tightening cycle, and it will raise questions about what they do next. How long do they need to keep rates at a high level, the higher for longer thing? The problem for the Fed is how much confidence can you have in your forecast given the huge list of potential problems out there? You're talking about oil prices. We got the student loan payments, UAW strike, government shutdown, the war that Russia's prosecuting in Ukraine, and China's economy. Also, health insurance costs expected to rise next year. So a lot to try to divine from what the Fed puts into their forecasts, into their statement, and what Jay Powell says. The goal, I guess, for the Fed is to try to limit what happens with the forecasts for rate cuts next year. They don't want the markets to get ahead of themselves. And right now, we are pricing in a significant number of cuts for 2024. The Fed will hope, I guess, that they keep those steady. Now, Matt, with your permission, it is tradition on this show that before the Fed meeting, Bob Michael tells me the question to ask Jay Powell, what he wants to know from the Fed chair. So Bob, what is it this time?
Well, I think, Mike, and thank you for asking, I've got loads of questions for the Fed, but I think the first one is we've always felt that a disinflationary trend towards their 2% target was a necessary ingredient for them to pause. We've had that. I want to know, what is their trigger to actually start cutting rates? Do they see inflation moderate and be somewhere in the low to mid twos. So the real Fed funds rate is actually over 3. So they start to ease into that to make sure that they don't accidentally tip things into recession? Or do they wait until unemployment goes up 0.5%, 0.75%, thereby ensuring that they're too late?
Actually, I was going to ask you, Mike, about that as well. All of these concerns for the consumer, but I guess unemployment is the actual mandate, right? We're all watching inflation more closely than we're watching growth, but what does the labor market look like?
The labor market is still tight, which raises the question of, do we still see companies paying more to attract workers? And as long as that's the case, the concern at least, then the Fed is going to be cautious. But they do have the 2% target. I don't think we're going to get any kind of specifics like Bob's talking about, because they don't want to lock themselves in. We will probably get more something along the lines of the old Potter Stewart definition of pornography. Can't describe it, but I know it when I see it.
Wow, I thought that was C. Everett Koop. I want to ask Greg as well, while I point out that the Treasury 5-year yield is up to 4.5%, over 4.5%, the highest level since 2007. I'm looking at a 10-year yield at 4.3566, so that's up there at the highest level since 2007 as well. Greg, what would you ask the Fed? Give Mike some ammunition for his meeting in Washington tomorrow.
Well, I think it's funny that, Bob's question, notwithstanding, I mean, you can ask any question you want, but, the problem is you never get an answer. And I think that's the frustrating part. But the aspect that I would really focus on is our star, the terminal dot, to really get a better understanding of whether they believe that the terminal rates are higher. And I think that gets you to, Matt, the question on the 5-year. I think the market is finally coming to the realization after fighting it for the past 9 months, 18 months, that rates are actually indeed higher here, and we're not going back to this pre-pandemic type of level. And ultimately, I think what will drive that behavior going forward from a rate perspective is that terminal value.
Mike McKee, everyone thinks this hiking cycle is done. I mean, a lot of people are saying they're going to hold and that'll be the last hike. Do you think Powell is going to keep that dot, that one more dot for this year, or is the Fed going to keep that dot in the plot?
My guess is that they do keep the dot in the plot because they want to retain the optionality. If they take it out and then decide they have to raise again, that would upset markets, I think, more than if they leave it in and don't do it. So I would expect that the dot remains.
All right, Mike McKee, go get on the Acela. Don't drive. I can recommend against that with this traffic. UNGA is in town. Bob Michael and Greg Peters going to stick with us right now. I want to get to a look at what's going on in the stock market ahead of the opening bell. For that, we go to Abigail Doolittle.
Well, U.S. futures, Matt, right now are down just ever so slightly, and we have had some breaking news on Disney in the last few minutes. They have put out a filing. They are expanding their investments in parks. Now, what makes this very interesting recently, the big segment that everybody's talking about, of course, streaming, but their most profitable segment is parks. I think it's 60 to 65% of profitability, even though it's only 35% of revenue. $60 billion of CapEx in this segment. The stock is down 1.2%, but over the long run, especially as they look to divest their TV assets, this could be a positive move. Deere down 2.2%. Evercore has cut the shares to an inline on risks to revenue, even as valuation is basically fine. And then Royal Caribbean, Truist has upgraded this stock to a buy. Carnival Corp to a hold. The analysts there saying forward-looking trends for 2024 and 2025 look exceptionally strong. The numbers are conservative. Those shares are higher, Matt.
All right, Abby, thanks very much. Abigail Doolittle there with a look at the equities market. We're going to see the open in just about 18 minutes' time. Coming up, the UAW is raising the stakes.
We're not waiting around, and we're not messing around. So noon on Friday, September 22nd, is a new deadline.
The latest developments in the U.S. auto workers strike. That conversation up next. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We're not waiting around, and we're not messing around. So noon on Friday, September 22nd is a new deadline. Either the big three get down to business and work with us to make progress in negotiations, or more locals will be called on to stand up and go out on strike.
That's the UAW setting a new deadline for Detroit's Big Three, warning that more of its members will go on strike unless substantial headway is made by noon this Friday. Time is of the essence for the automakers. S&P Global Mobility estimating that the walkout is already costing them output of roughly 3,200 vehicles a day. Bloomberg's David Welch joins us now from Detroit, where he is the bureau chief overseeing this action. David, what do you make of the latest warning? I know some car makers are already slipping into contingency plans for drawn-out strikes.
Oh, that's right, Matt. So, look, there's going to be a lot of war of words here, but I think what Sean Fain is upset about is the union has the last offer on the table. They haven't seen a counter from the companies. And maybe the companies are looking at a different way to do this because everyone's been sort of bumping up the pay raises, 1% here, 1% here, and it hasn't gotten it done. So maybe they're taking a step back to figure out what else they can do to creatively make this work. I don't think they're going to want to go too much higher than the 21% where they already are. And maybe 25 gets it done. They don't really know. But, at this point, there is work being done at the table. There are always negotiators there passing things back and forth. But, we haven't had a formal counteroffer from any of the companies since September 14th. And Fain is basically threatening another round of strikes to get them to come to the table with a new offer for him.
How long until this, or will this, David, have any effect on the supply chain for other automakers? I keep asking, I asked the CEO of Maserati yesterday, I asked the CEO of Mercedes. They aren't terribly concerned yet about indirect effects.
Yeah, and they wouldn't be just now because you have 3 plants that, make a couple very specific models. That's not enough for parts plants to say, okay, we don't have enough work to keep going and start laying people off. You would probably need, if there are several assembly plants, maybe more, let's say 2 from each company in the second round of strikes. Then you start to have parts companies that are, they're really maybe hurting for volume for specific parts. But, if he does it this way, those companies can keep going for a while. So it's really a matter of how long this goes and also how quickly Sean Fain decides to ramp up the walkouts. If it goes from 1 plant, as it was the first round, to 3 each in the second round, it just gets more dicey for the parts companies the more he adds on. We'll have to see how aggressive he gets come Friday if there isn't enough progress to avoid another strike.
All right, David Welch coming to us from the busiest bureau in America this week. He covers the autos, and they all do. Keith Naughton, Gabby Coppola, and the whole team. Will continue to hear from them. Bob Michael and Greg Peters still with us, and I wonder what kind of effect this is going to have on the Fed's forward planning. Greg, how closely do you think they're watching this strike?
I think they are. I mean, it's another complicating factor. All we're talking about is complicating factors, right? So the Fed is looking at a myriad of different issues that influence their policy. But the strike has a twofold effect, right? One is the impact on the overall economy, of course, but then wages, right? And so one of the aspects that the Fed is really trying to weaken here is the labor market, and the wage gains is something that, complicates their mandate. So, I think this is a double hit for the Fed in many respects.
How strong do you think the labor market is, Greg? Some people come on and say it just looks stronger than it really is.
I think it's strong. I mean, it's defied all expectations. I think that is the punctuation of this cycle, that the labor market has exhibited so much more strength than I think anyone really forecasted. The ability of this economy to handle higher rates, the labor market handling higher rates. I think there's a lot of intrinsic inherent strength in this U.S. economy. And I think it's more on a secular basis than cyclical. There's going to be cyclical forces, of course, but I think there's structural strength in the labor market, and what we're seeing across unions right now is emblematic of that.
Bob, what do you think about the labor market? I mean, everyone's got a list now of, bearish risks. We heard just now from Michael McKee, but you're also watching student loan payments, restarting the depletion of excess savings. That's one the Fed's been watching closely. The continued rise in mortgage rates and the slump in applications, delayed tax payments for California, Alabama, and Georgia, rising credit card delinquencies, and obviously oil prices. Is the labor market, as long as it's strong, do those things not matter as much?
Well, the labor market has held in very well until now. And then, as you said, there are these wall of things that have just lined up that didn't exist over the previous 9 months. And now the consumer is going to have to deal with that. There has been some slowdown in the labor market. We look at non-farm payrolls, and we look at a 3-month moving average to smooth it out. A year ago, 450,000 jobs per month were added. 6 months ago, 300,000 jobs per month were added. Today, looking at the 3-month moving average, 150,000 jobs per month were added. So it is slowing down, and the consumer is getting tapped out. So I do worry.
Treasury bulls are getting louder and louder, Bob. I just read a story about Alliance Bernstein saying they think we could see 2.5% on the 10-year within the next 12 months. What's your call?
Yeah, I think that the Fed is done hiking rates. I think the inflation we're seeing now is the kind that really slows down the economy. I am concerned as a holder of bonds. Certainly spiking oil prices and strikes are not the things that make for lower bond prices. But we go back to, if this is genuinely the Fed's last rate hike that we've seen, and they're not doing anymore, it doesn't matter if you have a soft landing or recession. The bond market rallies and outperforms cash meaningfully over the next 2 years. So I'll continue to hold bonds, although I'm a little bit more wary now.
Greg, what do you think? Are you wary, or do you back up the truck with, the 2-year at 5, the 5-year at 4.5, the 10-year at the highest level we've seen since 2007?
Well, I'm bullish on bonds, but for a very different reason. I don't think we want or need capital appreciation, right? I don't think we need a world where the 10-year is back to 2.5%. A lot has to go really wrong with the economy here, and so that's something I'm not wishing for. I think the bond market is back to its equilibrium, which is a roll and carry market. Getting the yield, getting the income, that is the value proposition for fixed income. It's not about this massive rally in the face of recession. So to me, I really do like bonds, high quality for sure, but it's about roll and carry. It's not about capital appreciation. And it's a very different backdrop as a consequence of that.
All right, right, great getting your take, both of you. Bob Michael there and Greg Peters, appreciate that panel. Coming up, the morning calls, and then later, Crossmark's Victoria Fernandez makes the case for a balanced portfolio amid a slowing economy. We'll see how slow she thinks it's going to get. That conversation still ahead. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is the countdown to the open. I'm Matt Miller, in for my good buddy Jonathan Farrow. We are looking at equity index futures that are down now on the S&P and the NASDAQ. Russell 2000, little changed. I want to get right now to our morning calls. First up, Truist upgrading Royal Caribbean to a buy, pointing to conservative earnings estimates and strengthening booking trends for the cruisers. Next up, JP Morgan downgrading Planet Fitness to a neutral, seeing limited upside after surprising changes to the C-suite of that gym operator. Finally, Evercore upgrading CVS to outperform, highlighting the stock's attractive valuation and improving operations. Coming up, trimming the leaders and buying the laggards. That's the call from Crossmark's Victoria Fernandez. That conversation up next at the opening bell. We could see drops on the major indexes, little move for small caps, but the big news, I think, is yields continue to march higher, as do prices for crude oil. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Good morning. This is the Countdown to the Open. I'm Matt Miller in for John Farrow. Moments away from the start of trading, we can see that futures are down on the S&P, NASDAQ, and the Dow Jones Industrial Average. Trading starts in just 10 seconds time. There you hear the bell, and we're looking, by the way, at Instacart here, an IPO today. We're going to talk a lot about that throughout the day. I know that Ed Ludlow is going to focus on it in Bloomberg Tech. Let's take a look at some of the other price action that we're watching this morning. Euro dollar trading at 106.90 right now. I think the 10-year yield is absolutely fascinating. Right around 345, right around the highest level that we've seen since 2007. The same is true for the 2s and the 5s at 5 and 4.5 respectively. NYMEX crude up to $93 a barrel. That is not a Brent quote. Brent is up well over 95. So rising oil prices may be threatening the possibility of a soft landing for the Fed. In terms of stocks to watch at the open, one of them is Starbucks. You can tell I've had a lot of their product. The stock under pressure after TD Cowen downgraded shares to a market perform. The analyst writing, quote, "We see worrisome macro and competitive pressures that we expect to challenge China's same-store sales." Bloomberg's Abigail Doolittle has more. Abby?
How can we not start out our day with some Starbucks, Matt? But relative to this call, it's a very interesting one. So the stock is down nearly 2% as we do have TD Cowen cutting shares to an inline, so not a dramatically bearish call. But the reason behind it is China. Now, I do have a source who just recently returned from a trip from China saying that the economy there is much worse than what is being reported on and that the youth unemployment is much higher than expected. So that would confirm this call, along with various China bears talking about the backdrop there, especially around the property bubble and the credit crisis that seems to be unwinding. However, their business in August was very strong. It was up 48% in China on a year-over-year basis to nearly $1 billion. The company remains committed to opening 9,000 stores there by 2025. So you have this real divergence. It's also interesting that this analyst is making this call right ahead of the quarter ending. If he's an Axe, it would suggest that he has channel checks that suggest that the business there has changed so dramatically. On the year, Matt, the stock right now is down close to 5% or so, down last year. If it stays down, and I know that we're only midway through the year, a little bit more than that, it would be the first double drop on an annual basis going all the way back to 2007, 2008.
All right, we'll pay close attention to that. Abigail Doolittle, thanks very much for the update on Starbucks. Let's turn now to the IPO market. Instacart planning to sell shares for $30 or more as it makes its trading debut. Shonali Bassick has more on the story. Shonali, we're starting to get more of these IPOs, but they're like down rounds and worth a lot less than they were during the pandemic.
They sure are.
$9.9 billion. That's where you have Instacart valued into the pricing of its IPO. Remember, they upsized the IPO price here to $30 a share as the high end of the upsized range. So they did raise more money than what was initially expected. Let's put that $9.9 billion into perspective, as you've been saying. It is about a fourth of where it was valued at the pandemic, post-pandemic peak when everyone was ordering online. But for the sake of its early investors, think Tiger Global, Co2, that have not had an exit in a very long time, or a significant one at this scale, if you will. You have Instacart now valued at that $9.9 billion, above that about $8 billion valuation it had in those earlier funding rounds when you saw Tiger and Co2 start to get in. Now, a significant amount of its shares are going to be placed into cornerstone investors' hands. That includes Dan Sundine's D1. It includes a division of Norges Bank. And by suppressing kind of the open demand outside of that, these IPOs have tended to get something of a significant pop, at least in this era, if you will, Matt. But remember, the Instacart IPO is facing a somewhat less buoyant market than what we saw last week for ARM. They did get that IPO pop. Klaviyo prices tonight, trades tomorrow. This is all ahead of that big Fed meeting, so let's see if they get what they want. Volatility is still fairly low, at least lower than what we've seen for the one-year mark at its high.
All right, Shonali, thanks very much. Our Wall Street reporter giving us the latest on that. Let's turn now to media. Disney is developing plans to expand investment in its Disney Parks, Experience, and Products segment to $60 billion in CapEx over the course of a 10-year period. Ed Ludlow has more on the Magic Kingdom. Ed?
Yeah, Matt, that would represent doubling CapEx commitments to theme parks, cruise lines, products, and experiences. It's interesting to see some of the strategy playing out now that Bob Iger is settled back in as the returning CEO. Also, another piece of news breaking this Tuesday morning, ESPN and Disney Entertainment CFO Brian Castellani is leaving the company, the latest executive departure. He is heading on to take a role at Warner in their finance team. 24 hours ago, we reported, according to sources, that Disney's looking at what to do with its India assets, perhaps an outright sale of the Disney Star brand in that region, or a sort of combination piecemeal of some of the streaming rights for sports and Disney Hotstar, the regionalized streaming platform, or indeed a joint venture, as Bloomberg's reported in the past. So this CapEx global doubling to $60 billion is kind of the latest hint of the priorities for Bob Iger. But still lots of questions about some of the other media assets that Disney's been asked about in recent weeks.
I mean, such a fascinating story. We heard from Ken Griffin yesterday, I think on CNBC. He's like, I don't know why we're getting all of this negative press from Florida. And I also was doing the math, Ed. The last time I was at a Disney park, 1986, I was 12.
Well, I've only ever been to the Star Wars experience because, you know, I'm a big fan of lightsabers down in Southern California. But let's go on a little trip and check out.
Ed Ludlow loves lightsabers. Yeah. I got it. All right. Ed, thanks very much for that. Let's turn to airlines. The sector tumbling into a bear market as the price of oil moves higher, obviously putting a lot of pressure on their bottom line. Lures investors away from the U.S. Global Jets ETF. It had hit an all-time low against the S&P. Simone Foxman has more on that story. Simone?
Yeah, Jets ETF hitting an all-time low against the S&P, but the index itself trading near its lowest since May. And Bloomberg Intelligence in a note today saying the negative technical signals could push the correlation between that ETF and the S&P even lower because its July peak failed to close above a January high. But stepping back, let's dive into some of the specifics that we're seeing amongst these airlines. Really, it's clear that the sheen of the summer travel season has worn off. Consumer demand may be flagging in the U.S. specifically, especially for domestic fares. We heard that from Spirit, how it's had to go out and discount a lot of flights. Airlines with international operations have been able to hold up a little bit better, but recently this rise in jet fuel costs has really hit them particularly hard, and that's where we've seen the biggest declines since hitting that peak back in July. Fuel costs cited by Delta, American, Spirit, Alaska, United, among others, reporting changes that could be material to their earnings, and that narrative definitely going to be in focus today as we watch Brent above $95 a barrel. Special mention today, we should also watch shares of United. They're trading slightly higher today, but it's the latest carrier to find bogus parts in two aircraft engines. That's the result of some reporting from Bloomberg. Disclosed this news after hours yesterday, but it doesn't seem to be moving distinctly negatively today.
It's slightly terrifying, unless the parts are machined so well that no one can tell, and so they work perfectly. Right?
Yeah, but it doesn't seem to be a safety issue, of course, at least not yet, and we haven't heard regulators come out and say that, but it is nonetheless concerning to think that bogus parts might be in your aircraft.
Absolutely. Simone, thanks very much. Simone Foxman covering that story for us. Let's get over to Crossmark's Victoria Fernandez, weighing in on the road ahead, writing, quote, "We continue to see many potential market-moving events in the wings. This is why we've been focused on a pullback in the final quarter of the year." I'm pleased to say Victoria joins us now with more. So you think we're going to see the market drop, what, in terms of the S&P by the end of 2023?
I do think we're going to see it, Matt, and you're right. There's all these elements that we see kind of on the sidelines that we're waiting to see them flow through the economy. So obviously the UAW strike, we're seeing that, and what is that going to do to wages across the board for labor? We've got a potential government shutdown. That can cause some volatility in the markets because it looks like it's going to go to a shutdown. It doesn't look like we're going to get an agreement anytime soon. We've got higher yields. You were talking about that earlier, and I think you're right. It's one of the most key issues that we can be looking at right now. And I think you're going to get rate cuts coming out of the market instead of having them priced into the market, which again is going to support higher yields. There's lots of elements that are going on right now that should cause some volatility in the markets. And we have seen, interestingly enough, Matt, that not just the Fed, but global central banks are all moving towards that higher for longer. That'll be supportive of higher yields too.
And the question that Farrow and Bramo have been debating on surveillance over the last couple of weeks is, do these higher oil prices signal stronger demand growth from an all's well American consumer, or is it just engineered by OPEC Plus and a threat really to the soft landing scenario? What do you think?
Yeah, I think it's really more of a supply issue at this point in time. I think if it was in the beginning of the summer when we first started to hear about some of these cuts, obviously there's more demand at that point in time for travel, but we are getting into the winter months, so you do have some increased demand in regards to heating that people need. So it could be a little bit of a combination, but I think supply is the driving force right now. We have a 95 handle on Brent today. That is going to continue to make that core inflation number sticky, and it leaves the Fed really with no choice but to either hike an additional 25 basis points in November or at least keep the level that they're at for a longer period of time. I think that's going to be the focus tomorrow at the meeting. People are going to be watching that dot at the end of next year. Where does that lie? I think it'll be higher than where it is right now.
Absolutely, that and the SEP. The question is, does the Fed watch credit spreads in the event of a downturn? And I actually have a viewer who writes in, a trader, Anthony Stefano of Cabrera Capital Markets. He wants to know, would a blowout above 800 basis points on the 5-year trigger Powell to think that they broke something? And I think, the follow-on to that is, then will that amount to cuts in 2024? What do you think?
Yeah, I definitely think we're going to see cuts in 24, Matt. The question I think most people are grappling with is, when are we going to start to see those cuts and by what magnitude? So I think it's going to be probably around the middle or the second half of next year before they start cutting. The Fed has taken a really long time to get where they are, and they have worked very hard to walk that tightrope to not lead into recession, even though I still think we're going to see a pullback. I don't think they're going to be quick to turn on a dime and say, hey, yeah, let's go ahead and start cutting rates and then add to inflation pressure as demand would continue to go up at that point in time. Credit spreads are important. You've got to watch them. Right now, they're still somewhat stable. The minute we see spreads start to widen out significantly, that's going to be a clue to the Fed that those tightening conditions have worked their way through the economy, and it's time for them to take a step back.
So what do you think of the Alliance Bernstein call today that the 10-year yield goes to 2.5%? Some people are saying back up the truck at these yields because you're going to see massive capital appreciation. Others, like Greg Peters, who we spoke to earlier, are going to say, regardless of that, this is a great return. What do you think of Treasuries?
Yeah, I think you need to have an allocation in your portfolio right now to Treasuries, and we're actually doing it more on a barbell where we're taking that yield on the short end of the curve, taking advantage of that cash flow that you can have in your portfolio, but locking in some of the rates on the longer end of the curve. Look, 434, 435 is a very important technical level, and we keep bumping up against that yield on the 10-year Treasury. If we go above that and close above that, then I think you're looking more at a 450 level. But right now, the market seems to kind of keep that cap right there. If it does, and we get through this meeting and the November Fed meeting, then I think you might see yields start to come back down and you can have that capital appreciation. But either way, I would lock in some rates for cash flow.
Victoria, awesome to catch up with you. Thanks so much for joining us. Victoria Fernandez there from Crossmark. Coming up, GOP tensions looming over a potential government shutdown.
I don't think we should have a shutdown, but I agree with you that I think it is very likely. Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown.
Inching closer to that as the UN General Assembly gets underway here in Manhattan. Team coverage up next. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. We do a breakthrough. We look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
I don't think we we should have a shutdown, but I agree with you that I think it is very likely. And I think the reason it is likely is I think Joe Biden and Chuck Schumer both believe politically it is in their best interest to have a shutdown, because they believe that in a shutdown that the press will eagerly blame it on Republicans, and I think Biden and Schumer think they get a political benefit from it. And so I think their incentive is to try to force a shutdown.
Well, it's not just what Biden and Schumer think, it's what Kevin McCarthy actually said yesterday, that it would be in the administration's interest to have a shutdown. But Ted Cruz says the president also thinks so. Rising tensions on the Hill as Congress faces that looming deadline at the end of the month. House Speaker McCarthy's latest proposal to avert a shutdown is already facing stiff resistance from ultra-conservative members of his party. Here's what he had to say to reporters.
I've told all of Congress, you're not going to go home. We're going to continue to work through this. I'm not giving up on the American people. I'm trying to convey to my members, if we want to be able to win these objectives, we should show the American public our ideas and be able to pass them. Is it a struggle? Yes.
Let's bring in Bloomberg's Kaylee Line. She is in Washington for more. Kaylee, do Kevin McCarthy and Joe Biden agree on too many things for his base?
Well, that's a really interesting question, Matt, because, of course, should something like we saw in the debt seal happen, where Speaker McCarthy actually is able to broker a bipartisan compromise with Democrats, it could actually work against him if he wants to keep the Speaker's gavel. That's when we could potentially see one of these members who have been railing against him actually file a motion to vacate and try to kick him out of the job. This is just one of the reasons why this is a very difficult situation for him to navigate. Him saying that it is a struggle almost is an understatement, because, of course, there's more than a dozen members of his own party who have said they would not vote for the deal that was brokered between members of the House Freedom Caucus and the more moderate Main Street Caucus. That, of course, it would include 8% cuts to domestic agencies in terms of spending, also include many border measures, but a lot of those hardline conservatives would like to see it go further. They want deeper cuts. They also want to defund the federal investigations into former President Trump. They'd like to block spending of previous aid agreed to for Ukraine. All of those things would make it even more dead on arrival in the Democratic-controlled Senate and make it very unlikely that it would ever get a signature from President Joe Biden when it comes across his desk. So it goes to show you that this is not looking like it is bringing us any closer realistically to averting a shutdown. It is a very difficult needle to thread, but time is running out to get this thing sewn up. We're just about 12 days away now from that potential closure, Matt.
So is this dependent, Kaylee, avoiding a shutdown on a continuing resolution, or is it possible that the House gets all of their legislative work done in that time period?
They just really, realistically, Matt, do not have enough time. The House would need to pass 11 more appropriations bills. They've only done one so far, and there's only, I believe, 7 or so legislative days, at least, on the calendar between now and September 30th when that funding is running out. So a continuing resolution like the one on the table that would temporarily fund the government until October 31st looks like it's realistically the only way to avert a shutdown of the government.
All right, Kaylee, thanks very much. That's an important look at the domestic issues we face. Let's look at the foreign affairs issues and get Midtown Manhattan congestion report. Global leaders gathering in New York City for the UN General Assembly. President Biden delivering his UN address at the top of the hour, just minutes from now at 10 a.m. Eastern. Bloomberg's Anne-Marie Horder joins us from the UN Rose Garden with a preview. AMH, what can we expect?
Well, we just got some excerpts from what to expect from the president when he gives this address at the UN. You know, Matt, we should note he's the only leader of one of the permanent 5 countries on the Security Council to actually show up. The likes of Putin, Xi Jinping, Macron, Rishi Sunak, they are not here. What the president is going to really use his address, as Jake Sullivan told reporters last week, is that a really big chunk of his address will be about Russia's invasion of Ukraine. So the president really has 2 audiences here. One is going to be the international community, the global south, that have been reluctant to really want to isolate Russia and ramp up punishments on Russia. And the other, of course, is going to be the domestic audience. If you look at polls, more voters have this fatigue when it comes to sending money and aid to Ukraine, especially Republican voters. And that is why what Kaylee was talking about has been so difficult, not just to make sure the government keeps funding, but also potentially getting that Ukraine supplemental aid through Congress. What the president is going to say on Russia, Matt, is this. Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. But I ask you
this. If we abandon the core principles of the UN Charter to appease an aggressor, can any member state feel confident that they are protected? If we allow Ukraine to be carved up, is the independence of any nation secure? This is the kind of rhetoric you're going to be hearing from Joe Biden when he touches down here at the UN in just about 20 minutes' time.
All right, Anne-Marie, thanks very much for the update. Look forward to the headlines from the president. Now let's get back to the markets. We are looking for some sector price action this morning. In the 20 minutes we've been open, what have we got so far, Abigail Doolittle?
It's interesting, Matt. So we're looking at a very small decline for the S&P 500 of about 0.2%. But a couple of the heavyweight sectors are on bottom. Consumer discretionary down 1%. We also have tech down 0.4%. So let's see if the decline builds up top, though. Energy, not surprisingly. Let's take a look at what's happened over the last 2 months, because you were talking about the airlines earlier and, of course, autos with the UAW strike. Both of these sectors since July down sharply. Airlines, as you were mentioning earlier, in a bear market. This as fuel costs simply continue to climb.
All right, that's what to watch. Markets been open for 22 minutes, but about to kick into high gear. Coming up, the events that you need to be watching out for this week. That's next in our trading diary. This is Bloomberg.
What do you worry most about your economy and Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Farrow. Quick look at the markets, unchanged on the small caps, the NASDAQ and the S&P, both down right now. Let's get to today's trading diary, what you need to be watching all week. President Biden, as Anne-Marie just told us, speaking at the UN General Assembly in just about 15 minutes' time. Then tomorrow we get a Fed rate decision, and Chair Powell will give a news conference, as well the dots and the SEP. That's the big deal. Could be a hawkish pause that we're in line for. Then the BOE, the Bank of England, announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales. And finally, on Friday, a Bank of Japan rate decision. So a couple of other central banks than the Fed making announcements this week. This was the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Have a great Tuesday. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading. It is Tuesday, September 19th. Here are the top market stories that we're following for you at this hour. Consumer crunch. Oil inching towards $100. We're going to look at what it means for consumer spending and if high gas prices dent Christmas. And Instacart's instant profit, well, the company debuts on the NASDAQ pricing at $30 a share. We're going to get the latest. And Biden tops the agenda. We are just moments away from the U.S. President Biden's address to the UN at the General Assembly as that kicks off today. We're going to sit down with NATO Secretary General Jens Stoltenberg. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I hate to say it, but the most exciting thing for me today is Canadian inflation.
It's certainly having an impact on the bond market. I'm surprised it's not our question of the day, if I'm being brutally honest, though, because it includes your two favorite things, oil and shopping. That sounds perfect.
It does. Wait, why is Canadian about shopping? I thought it was just about inflation and gas prices.
This isn't about, no, two separate subjects. Our question of the day is about shopping and oil. It basically brings together your two favorite things.
100%.
The Canadian thing I think is interesting because I think it highlights the fact that inflation is going to be sticky and central banks are going to struggle to bring inflation under control without maybe jacking up rates even higher. So that's going to be an interesting question. You've seen the reaction in the bond market, but I still think the story, and this goes to the inflation story out of Canada, is about oil. And it's whether or not oil is ultimately the story that breaks the consumer. The consumer is using buy now, pay later, credit cards, delinquencies are rising, student loans are about to kick back in again. You've got all kinds of factors coming together. Savings rates have really been run down. Now you get higher oil prices. Is that what forces ultimately the U.S. consumer to finally batten down the hatches?
Yep. And is that actually weirdly good news for the Fed? Like oil's helping them to do what maybe the rate hikes haven't yet 100% accomplished.
Absolutely. I'm not sure they're going to see it that way. It depends if it's a growth hit or it's perceived as being inflationary. I think that is and I don't think we know the answer to that yet. But we have two perfect people to try and get to the bottom of that. As I say, this is Alex's Christmas present. Maybe come early. Does $100 oil crush Christmas, i.e. crush the consumer? Is that what is going to happen in the last quarter of the year? Joining us now, Bloomberg International Economics and Policy Correspondent Mike McKee and Christine Aquino, who leads our Markets Today team. Christine, what do you think? Does oil crush Christmas? Is this finally what forces the consumer to batten down the hatches?
Yeah, Guy, I mean, all of the things that you mentioned in terms of what's holding up the consumer right now, it sounds really, really flimsy, doesn't it? And, I think we have seen the resilience of consumers on both sides of the pond in the UK UK and in the US. But again, it sounds like a lot of it is very much debt fueled. And oil at $100 just sounds like the sort of wild card that could kind of topple a very delicate house of cards, which is what we're sitting on right now when it comes to consumers.
Mike, what do you think?
I don't know if oil will, but Guy certainly may be depressed about Christmas with his list of things that could go wrong.
He's British. That kind of like happens.
The problem is that list, which you could expand on quite easily, throw in the government shutdown in the U.S. and the UAW strike. The problem is you don't know what that situation is going to be like in December or in November when people are starting their Christmas shopping. And that's part of the problem that the central banks have as well. They don't know what's going to be happening then. $100 oil sounds terrible, and if it pushes us up to maybe $5 a gallon eventually, it will crimp some of what's available to spend, but people tend to spend during the holidays anyway. We have seen spending drop off somewhat, but only basically back to where we were pre-pandemic. So do people cut back even further? That's hard to say at this point.
Guy,
Yep.
Ellen Zentner, Morgan Stanley, had a note out time talking just about this and said it takes about 3 to 8 months after the oil shock to really come through, but it takes 3 months for the oil shock to really hit the inflation numbers, and it really just hits CPI, but that's right around Christmas.
Yeah, and it started in June. You take a look back at the oil chart. We are up 30% since June, maybe July. I can't remember exactly. They both start with a J. But since midsummer, basically, we have seen oil prices up by around 30%. So we're already well into this effect. And it is already, as you say, Alex, showing up in the Canadian inflation data. And I think we're going to see it showing up in other numbers as well. The big question, and Mike, I'll get your take on this. The big question is, do central banks look through that, or do they see it as a shock they need to deal with now?
They will look through it, at least as long as they can. The only thing that would get central banks going on something like energy prices is if we started to see inflation expectations become unanchored. And we just saw in the U.S. that in the University of Michigan survey, at least, you guys had Joanne on the other day talking about how we're at the lowest inflation expectations since 2020. And so at this point, it's not an issue. If they did see inflation expectations start to become unanchored, then what you might see is that the last rate increase the Fed's been talking about or put into their dot plot just as sort of a signal. But at this point, I don't think you're going to see anything based on energy.
And we did talk to Joanne Shu about just that and asked about gas prices, and she's like, no one's really worried about it yet. And like they just see it coming back down. So the psychology isn't being embedded in that. However, Christine, I feel like Guy did outline a lot of other stuff. Which is the savings rate, which is student loan debt, et cetera. What do you think?
Yeah, absolutely, Alex. I mean, this is what I'm worried about is kind of everything is fine right now. And I completely agree with Mike and the analysts that we've spoken to. This is not a problem for now necessarily. I think what could turn it into a problem is all the other factors that do lend consumers vulnerable to a sudden shock, right? And this could be particularly it. I mean, in the U.S., I think there's a lot more resilience that we've seen from consumers over a longer period of time. Not the case in the UK. I mean, they're still grappling with a cost of living crisis over there. There's still an overhang of the energy crisis from last winter. We're heading into winter time again, and you can expect people starting to worry about their energy bills again, even though it's not to the same extent in terms of expensive energy prices as it was last winter.
And the key thing that we're all still watching as well, Christine, is what is happening with the labor markets. And that could turn kind of ho-ho-ho or yo-ho-ho into the Grinch very quickly. Because what we're looking at here is a situation where the labor market could turn very quickly and companies will be laying off people very fast. As soon as history tells us that when the labor market cracks, it cracks fast. We're already seeing participation rate going up. We're already seeing the consumer needing extra money. Maybe actually as the labor market turns, the consumer really finds itself in deep water.
Absolutely, Guy. I mean, that is really going to be the sticking point. And again, just the vulnerability of UK consumers in particular to just the global energy cross currents, in addition to what they're dealing with at the moment, is precisely why, this is kind of worrying for now. And so, yeah, I'm definitely going to be looking out for what we see from the UK CPI numbers tomorrow. That's going to, of course, give you a sense of the overall inflation picture in the UK, but again, also in the context of still record wages that we're seeing in the UK. And of course, Bank of England on Thursday, we'll see what the Bank of England team, Governor Andrew Bailey, and the rest of his colleagues think about all of this.
Yo ho ho? What is that? Is that like a pirate Christmas
Christmas, Guy? Like, what are we saying with this?
I'll let you figure that one out. Email in if you want to answer Alex's question.
Wait, is this a thing that I'm missing? Do you guys get this?
You got to pay attention.
Yo,
you guys
ho,
have got to pay
ho.
attention.
Yo-hos? All right, I'm going to think about it. Really good stuff. Okay, and I guess before last we go, and this is because Mike is going to be sitting in, he's leaving for D.C. in just a couple hours. Does the Fed like oil at 100? In that, like, does it help dent growth? He gave me a weird look. But does it help dent growth a little bit in a way that they maybe didn't? That maybe consumers pare back a little bit, but they don't just, fall out of bed?
Well, in theory, that could be true, but they have no guarantee that it would only have a little bit of an effect. And that's the problem. No, they would say if they had their druthers, oil prices would come back down. But at this point, it's really hard to put a damage figure on it because you don't know how high it's going to go or how long it's going to stay there. That's going to be the real question.
All right, guys, thanks a lot. We really appreciate both of you, Bloomberg's Michael McKee and Christine Aquino, as I literally look up yo-ho-ho and retail. All right, anyway, look at another take here from Lisa Shallett. She joins us from Morgan Stanley. Our question of the day is, does $100 crush Christmas? Hey, Lisa, it's great to get your perspective. Does it?
Well, I think you guys have done a great job talking about the potential headwinds that it could provide for consumers. I think the bigger question that we struggle with as we talk to investors is what is it going to do for company profits? And the issue here is it wouldn't necessarily be a problem if expectations were modest. But expectations, as we know, are quite strong. And so part of our reticence about the market and part of our reticence, as you noted, our economist Ellen Zentner talked about, we're entering the fog of so many unknowns, is that expectations are for corporate profits to essentially V-shape and recover quite strongly starting here in the third quarter, ending with, kind of year-over-year growth into next year of 10, 12%. And that's the problem as far as we're concerned, is not so much that, the consumer may cool, but that expectations are that the consumer is not only going to remain resilient, but potentially reaccelerate their spending, exiting Christmas into the new year.
What does that mean for margins, Lisa? What does that mean for costs?
So, we've long been, of the opinion that analysts always misunderstand the secondary and tertiary margin implications of higher oil prices because they seep into everything in terms of transportation and logistics and supply chain costs. And so, we, as we have been, and perhaps excessively so, conservative and concerned about margin achievability. A lot of analysts seem to be forecasting that margins are going to expand, and that's something that we would question. We think that these headwinds are material.
So, Lisa, does that mean cyclicals are definitely a place not to be?
Well, I want to be careful because I think that there's lots of types of cyclicals, right? Some of us would call energy stocks and energy-related stocks cyclicals, and yet now we believe is a great time to be buying them because those may be some of the beneficiaries of what's going on now. In addition, we know that there are some structural tailwinds for some of the more capital spending infrastructure-related industrials that remain, quote unquote, good to buy or good to own here. Where I'm concerned is more of that consumer discretionary cyclical. So some of the retail-oriented names would be the ones where I do think there continues to be some risk.
The market's already started to knock those stocks down pretty hard, Lisa. How much more is there still to come?
I think that there's a lot more because I think it has to do with how are we defining what is consumer discretionary. Once upon a time we defined it, simply as some of the general merchandise and apparel type categories. But what we have to remember is that consumer cyclical exposure is quite large in companies that are very dependent on advertising. And I think we know who some of those suspects are. They're among the Magnificent Seven. It's not entirely clear that providers of mobile devices are not going to be impacted by a challenged consumer. So I will just say that while some folks may like to think that the Magnificent Seven are completely defensive, I think in large part they're consumer discretionary stocks.
I love what you didn't say in that. Lisa, along the same lines, we got Instacart. Just to update everyone, it's indicated to open at 39. Remember, it was IPO priced at 30. And that's an interesting company, and I'm not going to talk specifics, but just the idea that they're shifting to ad revenue, which you just pointed out. They're very levered to the consumer, and that's how closely are you watching the IPOs that come out as an indicator of market health and kind of where the growth is?
Yeah, no. So your question is the right one in my humble opinion, and the issue is more around what is the appetite among investors for IPOs, and to what extent are people looking to deploy risk capital into some of these earlier stage names. And I think from that perspective, just generically, the fact that we've been able to launch these deals speaks to liquidity in the market, speaks to decent appetite, and those are good fundamental dynamics for the market. Whether or not, I personally would be jumping into a name like this right here, now up, almost, 30% on my IPO offer, that's not necessarily something I would be taking here this morning.
Lisa, okay, final quick question. If the Fed pauses, do I buy stocks or sell stocks?
So our analysis is that, the pause here is not, the elixir. Quite the opposite, especially if the pause is going to lead to your first cut. Typically, when the Fed begins to cut, the initial months after a Fed cut historically have not been good for markets, because you do get into a growth scare. You do get into the questions of, hey, does the Fed know something that I don't know, and might a slowdown actually be more imminent as opposed to some big reacceleration. So our best guess is that we're going to move sideways from here off of a pause, and that right now the upside I think is very limited by both very high expectations, high valuations, and earnings that need to be realized against a backdrop of some growing headwinds.
Lisa, before I let you go, too, I just wanted to get your take on yields, because we've seen the 5-year yield hitting its highest level since 2007, et cetera. Do you like yields right now, and do you buy it for the appreciation, or do you buy it for the yield?
So what I tell people is you always should be buying fixed income or bonds for fixed income. And right now, that coupon payment looks very juicy and very attractive, not only versus recent history with regard to the asset class, but versus stocks, quite frankly. I do believe that the risk is what we would call asymmetric, meaning I do believe that there's a higher probability that there's downside to yields in the 12 to 18 months ahead of us than further upside to yields. But I'm buying for coupon, and I'm not trying to be cute here, thinking I'm going to make a lot of capital gains in bonds over the next 3 to 6 months.
Hey, Lisa, this was great. We really appreciated you spending time with us. Thank you so much, Lisa Shallot of Morgan Stanley Wealth Management. Looking at the S&P down by about half a percentage point. It is 16 minutes past 10. What time is it? I don't know. It's 16 minutes past 7 on the West Coast. We do want to get to the startup, but I do think that President Biden is starting to speak right now at the United Nations. So let's go there first to the United Nations General Assembly and President Biden.
Mr. President, Mr. Secretary General, my fellow leaders, about a week ago, I stood on the other side of the world in Vietnam, on soil once bloody with war. And I met a small group of veterans, Americans and Vietnamese, and I watched the exchange of personal artifacts from that war, identification cards and a diary. It was deeply moving to see the reaction of the Vietnamese and American soldiers. Culmination of 50 years of hard work on both sides to to address the painful legacies of war, and to choose to work together toward peace and a better future. Nothing about that journey was inevitable. For decades, it would have been unthinkable for an American president to stand in Hanoi alongside a Vietnamese leader and announce a mutual commitment to the highest level of country's partnership. But it's a powerful reminder that our history need not dictate our future. With the concerted leadership and careful effort, adversaries can become partners. Overwhelming challenges can be resolved, and deep wounds can heal. So let us never forget that. When we choose to stand together and recognize the common hopes that bind all humanity, we hold our hands in that power to bend that arc of history. My fellow leaders, we gather once more at an inflection point in world history. With the eyes of the world upon all of you, all of us, as President of the United States, I understand the duty my country has to lead in this critical moment, to work with countries in every region, linking them in common cause, to join together with partners who share a common vision of the future of the world, where our children do not go hungry and everyone has access to quality health care, where workers are empowered and our environment is protected, where entrepreneurs and innovators everywhere can access opportunity everywhere, where conflicts are resolved peacefully and countries can chart their own course. The United States seeks a more secure, more prosperous, more equitable world for all people, because we know our future is bound to yours. Let me repeat that again. We know our future is bound to yours. And no nation can meet the challenges of today alone. The generations that preceded us organized this body, the United Nations, and built international financial institutions and multilateral and regional bodies to help take on the challenges of their time. It wasn't always perfect. But working together, the world made some remarkable and undeniable progress that improved the lives of all people. We avoided the renewal of global conflict while lifting more than 1 billion people out of extreme poverty. We together expanded access to education for millions of children. We saved tens of millions of lives that would have otherwise been lost to preventable and treatable diseases like measles, malaria, tuberculosis. HIV/AIDS infections and deaths plummeted, in no small part because of PEPFAR's work in more than 55 countries, saving more than 25 million lives. It's a profound testament to what we can achieve when we act together, when we take on tough challenges, and an admonition for all of us to urgently accelerate our progress so that no one's left behind, because too many people are being left behind. The institutions we built together at the end of the Second World War are an enduring bedrock of our progress, and the United States is committed to sustaining them. And this year, we're proud to rejoin UNESCO. We also recognize that to meet the new challenges of our decades-old institutions and approaches, they must be updated to keep peace with the world. We have to bring in more leadership and capability that exists everywhere, especially from regions that have not always been fully included. We have to grapple with the challenges that are more connected and more complex. And we have to make sure we're delivering for people everywhere, not just somewhere, everywhere. Simply put, the 21st century results are badly needed. They're needed to move us along. That starts with the United Nations, starts right here in this room. In my address to this body last year, I announced the United States will support expanding the Security Council, increasing the number of permanent and non-permanent members. The United States has undertaken serious consultation with many member states and will continue to do our part to push more reform efforts forward, look for points of common ground, and make progress in the year ahead. We need to be able to break the gridlock that too often stymies progress and blocks consensus on the Council. We need more voices, more perspectives at the table. The United Nations must continue to preserve peace, prevent conflict, and alleviate human suffering. And we embrace nations stepping up to lead in new ways and to seek new breakthroughs on hard issues. For example, on Haiti, the Caribbean community is facilitating a dialogue among Haitian society. I thank President Ruto of Kenya. I thank him for his willingness to serve as the lead nation of a UN-backed security support mission. I call on the Security Council to authorize this mission now. The people of Haiti cannot wait much longer. The United States is working across the board to make global institutions more responsive, more effective, and more inclusive. For example, we've taken significant steps to reform and scale up the World Bank, expanding its financing to low and middle-income countries so it can help boost progress toward meeting the Sustainable Development Goals and better address interconnected challenges like climate change and fragility. Under the new president of the World Bank, change is already taking root. Last month, I asked the United States Congress for additional funds to expand World Bank financing by $25 billion. And at the G20, we rallied the major economies of the world to mobilize even more funding. Collectively, we can deliver a transformational boost to World Bank lending. And because the multilateral development banks are among the best tools we have for mobilizing transparent, high-quality investment in developing countries, reforming these institutions can be a game changer. Similarly, we proposed making sure developing countries have a strong voice and representation at the International Monetary Fund. We're going to continue our efforts to reform the World Trade Organization, and preserve competition, openness, transparency, and the rule of law, while at the same time equipping it to better tackle modern-day imperatives like driving the clean energy transition, protecting workers, promoting inclusive and sustainable growth. And this month, we strengthened the G20 as a vital forum, welcoming the African Union as a permanent member. By upgrading and strengthening our institutions, that's only half of the picture. We must also forge new partnerships, confront new challenges. Emerging technologies such as artificial intelligence hold both enormous potential and enormous peril. We need to be sure they are used as tools of opportunity, not as weapons of oppression. Together with leaders around the world, the United States is working to strengthen rules and policies so AI technologies are safe before they're released to the public. To make sure we govern this technology, not the other way around, having it govern us. And I'm committed to working through this institution and other international bodies and directly with leaders around the world, including our competitors, to ensure we harness the power of artificial intelligence for good while protecting our citizens from its most profound risk. It's going to take all of us. I've been working on this for a while, as many of you have. It's going to take all of us to get this right. In every region of the world, the United States is mobilizing strong alliances, versatile partnerships, common purpose, collective action to bring new approaches to our shared challenges. Here in the Western Hemisphere, we united 21 nations in support of the Los Angeles Declaration on Migration and Protection, launching a region-wide approach to a region-wide challenge to better uphold laws and protect the rights of migrants. In the Indo-Pacific, we've elevated our Quad partnership with India, Japan, and Australia to deliver concrete progress for the people of the region on everything from vaccines to maritime security. Just yesterday, after 2 consultations in diplomacy, the United States brought together dozens of nations across 4 continents to establish a new partnership for Atlantic cooperation so that the coastal Atlantic countries can better cooperate on science, technology, environmental protection, and sustainable economic development. We brought together nearly 100 countries in a global coalition to counter fentanyl and synthetic drugs to reduce the human cost of this affliction, and it is real. And as the nature of the terrorist threats evolve and the geography expands to new places, we're working with our partners to bring capabilities to bear to disrupt plotting, degrade networks, and protect all of our people. Additionally, we convened the Summit for Democracy to strengthen democratic institutions, root out corruption, and reject political violence. And in this moment where democratically elected governments have been toppled in quick succession in West and Central Africa, we're reminded that this work is as urgent and important as ever. We stand with the African Union and ECOWAS and other regional bodies to support constitutional rule. We will not retreat from the values that make us strong. We will defend democracy, our best tool to meet the challenges we face around the world. And we're working to show how democracy can deliver in ways that matter to people's lives. The Partnership for Global Infrastructure and Investment addresses the enormous need and opportunity for infrastructure investment in low and middle-income countries, particularly in Africa, Latin America, and Southeast Asia. Through strategic, targeted public investments, we can unlock enormous amounts of private sector financing. The G7 has pledged to work with parties to collectively mobilize $600 billion in infrastructure financing by 2027. The United States has already mobilized more than $30 billion to date. We're creating a race to the top with projects that have high standards for workers, the environment, and intellectual property while avoiding the trap of unsustainable debt. We're focusing on economic corridors that will maximize the impact of our collective investment and deliver consequential results across multiple countries and multiple sectors. For example, the Libido Corridor will extend across Africa from the western port of Angola to the DRC to Zambia, boosting regional connectivity and strengthening commerce and food security in Africa. Similarly, the groundbreaking effort we announced at the G20 to connect India to Europe through the UAE, Saudi Arabia, Jordan, and Israel will spur opportunities and investment across 2 continents. This is part of our effort to build a more sustainable, integrated Middle East. It demonstrates how Israel's greater normalization and economic connection with its neighbors is delivering positive and practical impacts, even as we continue to work tirelessly to support a just and lasting peace between the Israelis and Palestinians, 2 states for 2 people. Now, let me be clear. None of these partnerships are about containing any country. They're about a positive vision for our shared future. When it comes to China, I want to be clear and consistent. We seek to responsibly manage the competition between our countries so it does not tip into conflict. I've said we are for de-risking, not decoupling with China. We will push back on aggression and intimidation and defend the rules of the road, from freedom of navigation to overflight to level economic playing field that have helped safeguard security and prosperity for decades. But we also stand ready to work together with China on issues where progress hinges on our common efforts. Nowhere is that more critical than accelerating the climate crisis, than the accelerating climate crisis. We see it everywhere. Record-breaking heat waves in the United States and China, wildfires ravaging North America and Southern Europe, A fifth year of drought in the Horn of Africa. Tragic flooding in Libya. My heart goes out to the people of Libya. That's killed thousands of people. Together, these snapshots tell an urgent story of what awaits us if we fail to reduce our dependence on fossil fuels and begin to climate-proof the world. For one day, my administration, the United States, has treated this crisis as an existential threat from the moment we took office, not only for us, but for all of humanity. Last year, I signed into law in the United States the largest investment ever anywhere in the history of the world to combat the climate crisis and help move the global economy toward a clean energy future. We're also working with the Congress to quadruple our climate financing to help developing countries reach their climate goals and adapt to climate impacts. And this year, the world's on track to meet the climate finance pledge that made under the Paris Agreement, $100 billion to raise collectively. But we need more investment from public and private sector alike, especially in places that have contributed so little to global emissions, but face some of the worst effects of climate change, like the Pacific Islands. The United States is working directly with the Pacific Island Forum to help these nations adapt, build resilience to the climate impacts, even as we lead the effort to build innovative new partnerships that attack the global challenges from all sides. From the First Movers Coalition, which is mobilizing billions of private sector community and the private sector commitments, to creating a market demand for green products in carbon-intense sectors like concrete, shipping, aviation, and trucking, to the Agricultural Innovation Mission for Climate, which is bringing farmers into the climate solution and making our food supply more resilient to climate shocks, and the Global Methane Pledge, now endorsed by more than 150 countries, which expands our focus beyond our carbon emission targets to reduce the potential greenhouse gases in our atmosphere by 30% in this decade. It's all within our capacity. We need to bring the same commitment and urgency and ambition as we work together to meet the Sustainable Development Goals of 2030. These goals were adopted at the United Nations in 2015 as a roadmap for improving lives around the world. But the hard truth is, for decades of progress, the world has lost ground these past years in the wake of COVID-19, conflicts, and other crises. The United States is committing to doing its part to get us back on track. All told, in the first 2 years of my administration, the United States has invested more than $100 billion to drive development progress in bolstering food security, expanding access to education worldwide, strengthening healthcare systems, and fighting disease. And we've helped mobilize billions more in the private sector investments. But to accelerate our forward progress on the Sustainable Development Goals, we all have to do more. We need to build new partnerships that change the way we tackle this challenge, to unlock trillions of additional financing for development, drawing on all sources. We need to fill the gaps and address the failures of our existing system exposed by the pandemic. We need to ensure that women and girls benefit fully from our progress. We must also do more to grapple with the debt that holds back so many low and middle-income countries. When nations are forced to service unsustainable debt payments over the needs of their own people, it makes it harder for them to invest in their own futures. And as we work together to recover from global shocks, the United States will also continue to be the largest single country donor of humanitarian assistance at this moment of unparalleled need in the world. Folks, cooperation, partnership, these are the keys to progress on the challenges that affect us all, and the baseline for responsible global leadership. We don't need to agree on everything to keep moving forward on issues like arms control, a cornerstone of international security. After more than 50 years of progress, under the Non-Proliferation Treaty. Russia is shredding long-standing arms control agreements, including announcing the suspension of the New START and withdrawing from the Conventional Forces in Europe Treaty. I view it as irresponsible and makes the entire world less safe. The United States is going to continue to pursue good faith efforts to reduce the threat of weapons of mass destruction and lead by example, no matter what else is happening in the world. This year, we safely destroyed at least the last chemical munitions in the U.S. stockpile, fulfilling our commitment toward a world free of chemical weapons. And we condemn the DPRK's continued violation of UN Security Council resolutions, but we are committed to diplomacy that will bring about the denuclearization of the Korean Peninsula. We're working with our partners to address Iran's destabilizing activities that threaten regional and global security and remain steadfast in our commitment that Iran must never acquire a nuclear weapon. Now, even as we evolve our institutions and drive creative new partnerships, let me be clear. Certain principles of our international system are sacrosanct. Sovereignty, territorial integrity, human rights. These are the core tenets of the UN Charter, the pillars for peaceful relations among nations, without which we cannot achieve any of our goals. That has not changed, and that must not change. Yet, for the second year in a row, this gathering, dedicated to peaceful resolution of conflicts, is darkened by the shadow of war. An illegal war of conquest brought without provocation by Russia against its neighbor Ukraine. Like every nation in the world, the United States wants this war to end. No nation wants this war to end more than Ukraine. And we strongly support Ukraine in its efforts to bring about a diplomatic resolution that delivers just and lasting peace. But Russia alone bears responsibility for this war. Russia alone has the power to end this war immediately. And it's Russia alone that stands in the way of peace, because Russia's price for peace is Ukraine's capitulation, Ukraine's territory, and Ukraine's children. Russia believes that the world will grow weary and allow it to brutalize Ukraine without consequence. But I ask you this: if we abandon the core principles of the United States to appease an aggressor, can any member state in this body feel confident that they are protected? If we allow Ukraine to be carved up, is the independence of any nation secure? I'd respectfully suggest the answer is no. We have to stand up to this naked aggression today and deter other would-be aggressors tomorrow. That's why the United States, together with our allies and partners around the world, will continue to stand with the brave people of Ukraine as they defend their sovereignty and territorial integrity and their freedom. It's not only an investment in Ukraine's future, but in the future of every country that seeks a world governed by basic rules that apply equally to all nations and uphold the rights of every nation, no matter how big or small. Sovereignty, territorial integrity, they are the fixed foundations of this noble body. And universal human rights is this North Star. We cannot sacrifice either. 75 years ago, Universal Declaration of Human Rights captured a remarkable act of collective hope. I say that again, collective hope. Drafted by a committee representing different regions, faiths, philosophies, and adopted by the entire General Assembly. The rights contained in the Declaration are elemental and enduring. And while we still struggle to uphold equal and inalienable rights of all, they remain ever steady and ever true. We cannot turn away from abuses, whether in Xinjiang, Tehran, Darfur, or anywhere else. We have to continue working to ensure that women and girls enjoy equal rights and equal participation in their societies. That indigenous groups, racial, ethnic, religious minorities, people with disabilities do not have their potential stifled by systemic discrimination. That the LGBTQI plus people are not prosecuted or targeted with violence because of who they are. These rights are part of our shared humanity. They're absent. When they're absent anywhere, their loss is felt everywhere. They are essential to the advancement of human progress that brings us together. My fellow leaders, let me close with this. At this inflection point in history, we're going to be judged by whether or not we live up to the promises we made to ourselves, to each other, to the most vulnerable, and to all those who will inherit the world we create, because that's what we're doing. Will we find within ourselves the courage to do what must be done, to preserve the planet, to protect human dignity, to provide opportunity for people everywhere, and to defend the tenets of the United Nations? There can only be one answer to that question. We must, and we will. The road ahead is long and difficult, but if we persevere, and prevail, if we keep the faith in ourselves and show what's possible, let's do this work together. Let's deliver progress for everyone. Let's bend the arc of history for the good of the world, because it's in our power to do it. Thank you for listening. You're kind.
President Biden addressing the UN General Assembly in New York. Bloomberg's Amory Hordern has been listening to the speech just delivered by the president. She joins us now from the United Nations. Amory, walk us through the message that was delivered by the words said by President Biden.
Well, he started talking about climate, a number of issues in the world that a lot of countries here, alongside Climate Week at the UN General Assembly, can get on board with. He then, of course, moved into China and how the U.S. views China. He reiterated this talking point that you not just hear from U.S. officials, but as well as European officials, about managing competition with China. He says we do not want to decouple, we are de-risking. And then finally, at the end of his speech, he came to Ukraine. And he said that the U.S. will continue to support Ukraine. He called out Russia a number of times. Of course, Vladimir Putin is not attending this UN General Assembly. But when he talked about Ukraine, he really made it more about upholding international sovereignty for each individual country. And this is really the outreach I think the Biden administration wants on the international front. And he talked about upholding rights to every nation, no matter big or small. Sovereignty, territorial integrity is a fixed foundation of this noble body. And I think that's key for him to really want to make sure that they can keep including the global South to see the world the way the Biden administration sees it. And some of these individuals in these countries have been reluctant to really want to put more pressure on Moscow. Of course, while Biden was speaking, we also heard from Speaker McCarthy in Washington, D.C. And their Ukraine aid is a huge part of a debate right now amongst the Republican caucus. And what Speaker McCarthy said is that he wants to make sure that they are tracking and there's oversight on the taxpayer dollars that the U.S. is sending to Ukraine. And he said he's going to have some questions for Zelensky, who's going to be addressing the UN at noon, but then later this week heading down to meet with Biden and then a number of Republican lawmakers.
McCarthy also had some fairly sharp words for China as well. Amory Hordern at the UN, thank you very much indeed. Amory will be back within the next hour. She'll be joining us from the United Nations. She's going to have an interview with Jens Stoltenberg, the NATO Secretary General. Let's switch gears and turn our attention back to the question that is vexing the financial markets right now. What impact is this sharply rising oil price gonna have? And where does it show up the most? Is it in corporate profits or is it with the consumer? So our question of the day, a fairly straightforward one. Does $100 oil, Brent is approaching that, crush Christmas? Does it crush the consumer? Does it crush the consumer right at the end of the year? Is Q4 going to be tough? A new survey out from MasterCard indicating that the consumer will actually look through this, remain resilient as the holidays approach. Joining us now, Michelle Meyer, MasterCard Economics Institute Chief U.S. Economist. Michelle, always great to talk to you. Perfect setup on a day like today. Oil prices are ratcheting higher. The consumer is already under pressure. High gas prices are basically a tax at this point. Is that going to affect Christmas? Is the Grinch coming in the form of $100 oil?
I mean, obviously, we have to keep a very close eye on the trajectory of oil prices and how much consumers are paying at the pump. But when you take a step back and you think about the trend in consumer spending so far, it's been strong. And remember that the holiday season doesn't just start during Christmas, right? It starts well before that. So it's this extended period of consumer spending where consumers are navigating a variety of different factors as they try to do their best to prepare and to spend during this holiday season. And I still think the number one factor that drives consumer spending and will drive this holiday season is the labor market. And there it has been a story of strength with continued job creation, continued turnover of the labor market, and wage growth that's running above normal.
Hey, Michelle, so what are you guys sort of forecasting for the holiday season, and sort of where and what do you expect people to be spending on?
Sure. So, Alex, we're forecasting 3.7% year-over-year growth as measured as retail sales ex autos from November 1st through December 24th. And that shows, as I mentioned, a spending trajectory that is quite solid, and one that is really kind of returning a bit back to a more normalized pace of spend, similar to what we're seeing in the overall economy. Inflation pressures are moderating. We are seeing a lot more choice out there for the consumer, and we think that the consumer is going to have a lot of power as they navigate this holiday season.
So, Michelle, you don't see a recession under the tree this Christmas. That's not what we're all getting.
You're sticking with this theme of the Grinch.
He does. He does. You know, he can be pessimistic.
Yeah, no, I think that we're in a good place for the economy. I think that, you know, it's part of this rebalancing in the economy that's been underway as we settle down to something that I think is more sustainable and healthy growth with more tame inflation pressures, even some price reductions for some categories. So when you think about the economy from a nominal perspective, yes, we're shifting gears into something that's more consistent with slower growth, but I think more sustainable growth. And that's important to remember. And I think a lot of people kind of miss that, right? This idea that we have to shift gears, and it's going to be okay when we do it.
Okay, so I'm going to just actually piggyback a little bit on what Guy's saying. So if I look at myself as a barometer for the consumer, this is what I'm doing. I'm only spending on majorly discounted items. I am buying those things that are super on sale and then storing them for Christmas, and I refuse to spend anything that's full price that I don't need. If I'm representative of that, what does that tell me about the economy?
Well, I think that that's going to lead to a lower inflationary environment, which is actually quite desired after what we experienced throughout the last 2 years of very high inflation. And by the way, Alex, I think that what you're describing really does resonate with a lot of people, and I think the retail community is preparing for that. There were a lot of lessons learned from the last holiday season. When we look at our, daily insights of how consumers spent during the last holiday season, it was one of fits and starts, focused on those moments in time where promotions were most attractive. So last holiday season, to the extent that it's indicative of what's to come, we had a really healthy start around October with a lot of promotions, a weakening in early November, this big burst of activity around Black Friday, softening again, and then a burst at the very end for those that procrastinated in terms of their spending. So that's a consumer that has choice, and it's an economy that's going to see softer inflationary pressure.
What happens in January, Michelle? Student loans are really going to kick in January. We've all spent a lot on credit cards in the run-up to Christmas, it sounds like. How does the beginning of next year look? I'm beginning to hear a lot of people worrying about Q4, going into the beginning of next year as well. What happens after Christmas? Is this the last big Christmas that we're going to see for a while?
Well, look, I mean, we always have to be on alert. As you mentioned, there's a number of speed bumps that we have to be prepared for as we enter the end of the year and into early next year. And I think that we have to focus on what's happening in terms of overall, expansion in the economy, in terms of how companies are investing in labor, how companies are investing in capital, in IP. That's continued throughout the cycle, despite expectations that it wouldn't persist. And then how consumers navigate this holiday season is going to tell us a lot about the state of the economy in January. But I expect us to come out of this with still steady growth, slightly or right around potential.
I mean, I think my takeaway is I'm still spending. But it's just really contained. Michelle, it's always good to see you. We super appreciate it. Thanks a lot, Michelle Meyer of the MasterCard Economics Institute. All right, time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and in the world of banking and finance. There's only one today. It's Instacart, the IPO. IPO'd at 30. We're getting closer and closer to opening in the first trade. Bloomberg Shalini Bassick joins us. What do we know so far?
So far, pricing indications indicate a very healthy IPO pop. We know that the market started out kind of muted today, so good news for Instacart here. There is such little float and ability to buy new shares right now. These IPOs are getting some hefty love at the beginning. So pricing is indicated give or take $38.90 right now, $38.80, almost $39 a share. That would indicate about a 30% or so pop. Again, the spread tends to narrow into opening. We expect it to open in a couple hours here, hour and a half or so, sometime around noon or 12:30 according to my sources. So we are getting closer. Very healthy IPO at more than $9 billion, almost $10 billion in market value based on the fully diluted shares outstanding. Yes, it is about a fourth of where it was at its peak in valuation in 2021, but it is, I would say, above where a lot of early investors, Tiger Global, Co2, bought in at a less than $8 billion valuation funding round a couple of years ago. And we know that some of those investors were watching so closely because they're the ones that really need to shore up some dry powder at this point.
Sonali, how much is going out of the door? How much is going to be retained by existing investors? How important is today's price versus tomorrow's price?
It's important, right? If you don't trade well on the first day, it tends to not instill confidence into trading onward. And tomorrow, Guy, is very interesting because Klaviyo is pricing tonight, started trading tomorrow right before the Fed decision. And so you have a lot of elements of variability introduced into the market beyond the shareholders themselves and what they are taking on the plate today versus tomorrow. The interesting thing about the early shareholders, you have to think about who are coming in as cornerstones as well. A unit of Norges Bank, D1, Dan Sundime's firm as well. So to your point, how it is today versus the end of the week is a very big deal. We've been talking about this. You take Kenvue, for example, one of the bigger IPOs of the year. It's been trading pretty sideways all year. And so we're getting really excited about these IPOs last week, this week, but we really have to watch them go on because that pipeline of IPOs hitting Q1 of next year before the election cycle, they're waiting for the risk appetite to be maintained for the listings that we're seeing this week.
Real quick, who wins? What investment bank wins today?
Goldman has really been taking a really big page out of the playbook here. If you think about the Uber days, you had Morgan Stanley really leading the charge in tech listings. My sources tell me that these were kind of years-long investments that are now paying off. And it really, we'll see if Morgan Stanley wins the next cycle, but Goldman right now is really in the lead.
Sonali, as ever, thank you very much indeed. We'll bring that pricing as it happens. We'll bring you the details as we finally see Instacart coming to market. To process now, we're getting back into the groove. Sonali Bassick, thank you very much indeed. Coming up on the European close, Jens Stoltenberg, the NATO Secretary General, will be joining Anne-Marie Jourdain at the United Nations. We've just been hearing from the president. This is Bloomberg.
Greg's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Tuesday, the 19th of September, European stocks near session lows. You know what the worst performing sector in Europe today is? Retail. We'll talk about that in a moment. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele. $4.55, European stocks down by 0.2%. Volume's all right today, but to be truthful, we are waiting for the main event. We're getting into the central bank story tomorrow. The Fed starts today. That's going to be when the narrative maybe comes alight a little bit more. BP, first female CFO. Obviously, it's all change. Everybody's interim at the moment, but it'll be interesting to see whether that sticks. Kingfisher, I think, is the intrigue story. I mentioned what is happening with the retail story. This is the owner of B&Q. It's the owner of Castorama. It's the owner of Screwfix. The story in France is looking pretty dismal right now. Places like Poland are looking very weak. The consumer appears to be retrenching. Kingfisher, Alex providing more evidence of that. It's that stock being hit hard on the back of it.
All right, here in the U.S., you got the S&P now down 0.7%. The NASDAQ 100 is off a full percentage point. Let's dig in a little bit. So Disney, one of the worst performing stocks within the S&P, down 3.5%. They're going to spend tens of billions of dollars to upgrade some of its theme parks. But the real question is about its business model. What do they do with ABC? What do they do with ESPN? Now, on the flip side, one of the best performing stocks in the S&P is Royal Caribbean. Truist giving Royal Caribbean an upgrade to buy from hold. We've seen this recently over the last few weeks. That kind of we hit the bottom and things can get better for the cruise liners. So, okay, maybe we're still going to go on vacation. The 5-year yield, though, up 3 basis points. Probably this is also what's hurting tech. At one point hit its highest level since 2007. And I'm telling you, it is all about Canadian inflation. That comes in hot. It sort of brings in the thesis of we're going to see higher for longer, and a pause doesn't mean a stop when it comes to rates. And that, you know what, inflation can reaccelerate, helped by gasoline prices.
Help by maybe an interesting choice of words there, Alex. Yeah, it's going to be interesting to see how that impacts Europe as well. The latest data, though, out of the euro area suggesting that actually, now that we have the final read on the last set of data, inflation is falling. There was a little bit of a surprise on the upside. That has now been revised away, and as a result of which inflation is coming down. I think this provides further evidence of what is happening here in Europe, Alex, and that is growth is slowing quite rapidly, and it's already beginning to feed through into inflation. Now, whether or not gasoline energy prices start to impact that, we will wait and see. Canada is a good example, but certainly all of the evidence now in Europe is pointing to a slowdown. As I say, growth and inflation And that's something the ECB is going to have to pay attention to fairly soon.
Yep, and that was really echoed today by Stephen Schwarzman, Blackstone chairman and CEO. He talked about Europe in an exclusive interview with Danny Berger.
Europe is slowing down as the central bank continues to raise interest rates. No one ever knows where these things stop. It's certainly suppressing growth. So I think it's a reasonable expectation for Europe over the next year to have pretty muted performance.
Steve Schwarzman talking to Danny Berger a little bit earlier on today. Takes us back to our question of the day, which we were talking about in the last hour. $100 a barrel on Brent. Does that crush Christmas? Is the Grinch coming? That's our question. Andrea Felsted, Bloomberg Opinion. Mark Cudmore, who leads our M Live team globally, joining us both on set. Andrea, you feeling Christmas this year? Is it going to be the Grinch, or is Santa going to show up?
It's not going to be a sparkler. It's not going to be a stinker, but it's probably moderate.
Okay, so you're not optimistic, though?
I'm not optimistic. Some people are really optimistic about Christmas, and I think that's misplaced. The consumer, there's no doubt about it, the consumer has held up much better this year than anybody expected. But the cost of living crisis hasn't gone away, and we've got the pain from interest rates. That is going to weigh on some consumers, not all, but some consumers.
Mark, what do you think?
I mean, I'm going to be the Grinch here.
That's
yes,
not surprising.
$100 a barrel oil will steal Christmas. Absolutely. Look, when I was last on the show with you guys, I think it was July, and at the time I was talking about how resilient the consumer would be, and I was calling for higher yields, and I was saying you still got to be bullish stocks, because we talked about the time that stocks markets could cope with higher yields at that point. But you know what? The consumer is now going off the cliff analogies here at the moment, and I think that ultimately the consumer is going to hit the wall in the next quarter. Bloomberg Economics has done a lot of work on this, and I think it's going to be much more pain, much more drastic than people think. I think a US recession starts in the fourth quarter, and what we're seeing at the moment is that oil prices rising. We're not seeing a real reaction of break-evens. We're not seeing a real reaction in rates, and that's because everyone knows this move in oil, unlike last year, isn't super inflationary, because consumers don't have excess savings to spend, so instead they're substituting. They're spending money on less productive stuff, so they're spending money on oil rather than more productive stuff for the economy, and therefore it's much more of a growth impact this time. Yes, there's an inflationary impact, but it's much more about the growth impact, so therefore it's stagflationary impulse, and it will steal Christmas.
Is the European consumer more vulnerable to this than the US consumer? European consumers still got savings. The European consumer has been hit by a range of other factors that US consumers haven't been, but nevertheless the savings rate is still relatively high. How insulated is Europe versus the United States?
Am I allowed to steal the wisdom of one Guy Johnson, who was informing on me on this idea earlier on? Look, you made some good points to me earlier on when we were chatting on in the pantry. I was like, I am too focused on the US consumer and maybe on the Asian consumer, UK consumer, because of the time zone I'm based on, normally based in Singapore. And I think that German economy is in such a basket case of this scenario.
Yep.
But I think you made a very good point that, yeah, European growth is terrible. But we know that. It's discounted. It's kind of in the story. No one thinks that Europe's going to be a great engine of growth. We've played that dynamic for a long period of time. And that if we're going to get a global growth slowdown now, because US is going to be much worse than expected, China's still struggling, I think, again, that story's priced, then maybe the European consumer is a little bit more insulated because of their social security networks, because they have a little bit more excess savings. But I'm admitting I am stealing this idea from you.
Wow, I don't know what to say to that.
Just Alex, did you enjoy that?
Yeah, you guys totally set me up for this one. Wow. Okay, Andrea. However, we did get watches of Switzerland today, right? Saying that the U.S. consumer, was it that company said U.S. consumer is picking up a little bit? So do we distinguish between European, Asian, and U.S. consumers in the U.S. best of the bunch?
That's probably because it was really this time last year that the younger aspirational consumer began to slow. And so we could be getting to the point where we're not seeing things get any worse in that sector.
Okay, so the Rolexes are back on the market. We have heard from Richemont over the last few days talking about the fact that the consumer is slowing, the fact that it's reaching up in inflationary impulse. We'll put oil in there as well, into the upper echelons of the income bracket. You've also got champagne sales slowing. Alex is aghast at this news that people aren't buying or aren't going to be buying as much champagne. Previously, the upper-end consumer has been insulated. Is that starting to crack?
No, I think the upper-end consumer is still insulated. I think they are still spending strongly. That they are much more affected by shocks than they are movements in oil, movements in GDP. So if we have a stock market rout, if we have a property collapse, that top-end consumer will suffer. But at the moment, they are pretty much okay, that top-end consumer. They may be feeling a little bit nervous, maybe not buying quite as much, but they are still pretty resilient. I was at the Burberry show yesterday, lots of excitement about their new collections, and really trying to put that brand back on the map, raising prices to get to just those types of consumer.
So, Guy, this really echoes what we just heard from Michelle Meyer, which is, you're still spending. We're still going to see an okay holiday season, 3.7%. It's not crazy. You're going to be taking advantage of discounting, but it's still there. It feels like that's the theme. That doesn't say crushing. That's not, a Grinch situation.
No, but I think you put the student loan story next to falling savings rates, next to a labor market that's beginning to get a little worrisome. Mark, and I think that's, we talk about oil prices maybe having an impact, but it's the labor market that will really determine what happens here.
Yeah, it is the consumer, but the consumer is influenced in their confidence by the labor market. Part of the reason that the consumer has been continuing to spend much longer than people thought is that the labor market's been so strong. So even if you spend on your savings, well, I'll just borrow. I can always get another job. I can keep on demanding higher wages because higher wages because of such competition for my labor out there. It's when the labor market goes that the consumer really suffers. And I think that point that Andrea's making, that the higher end consumer still has a lot of savings. We talk about excess savings being spent down. On aggregate, they haven't disappeared yet. But the problem is they've been spent down at the bottom end of the income spectrum. And it's those people who can't spend anymore. But as Andrea points out, the higher end consumer will tumble very quickly when the stock market rout happens. And the stock market rout happens after everyone realizes that the lower income consumer can stop spending, the labor market's cracking. So what's the order of this now? Well, I think that you start getting a more nervous stock market from here on out. I'm still officially in the bullish camp and too soon to embarrass, but around this period of time, you no longer much upside. And then I think that you probably get the recession probably starting around the end of the fourth quarter, but we may not realize it to the next year. The quickest we've declared a recession is 4 months after, but we'll still be debating it. You got to remember, back in 2007, in October 2007, the Fed meeting was talking about the soft landing, and it was about a mid-cycle slowdown. And then December was the start of this massive recession. It could be the exact same scenario. It could be December is the meeting. We don't think things are too bad. Fed's talks too hawkish. And at the same time, we're getting growth going off a cliff. Rates are still staying higher for longer, and they're promising that. And that really crunches the higher-end consumer as well. And that's when we get the stock market rout.
All right, Mark.
Alex, I have to say, Mark may be dressed in green, which is okay. We can talk about rugby at a different date. He may be dressed in green, he may be the Grinch, but he can definitely come back.
He's dressed in green? What are you talking about? He's dressed in blue. We got to go. Mark, guys,
He's currently dressed in blue.
Mark, I'm Maria Felstead. Guys, thanks a lot. Coming up, morning question of the day. Does $100 crush Christmas? Emma Wall joins us from Hargraves Lansdowne, head of investment analysis. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under
tightening would be a worse mistake than over-tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
What is it going to do for company profits? And the issue here is it wouldn't necessarily be a problem if expectations were modest. But expectations, as we know, are quite strong. It's not so much that, the consumer may cool, but that expectations are that the consumer is not only going to remain resilient, but potentially reaccelerate their spending.
This is Shannon, of course, Morgan Stanley Wealth Management CIO, speaking to Alex and me within the last hour. Takes us back to our question of the day. We're looking at $100 a barrel. We're not there yet. We're getting there. We're moving in that direction. But if we do get there, does it crush Christmas? I.e., is the consumer going to be under such pressure at that point that Christmas will be cancelled? Emma Wall joins us now to discuss. Hargreaves Lansdown, head of investment analysis. That doesn't sound like a lot of fun. Do you think it's going to happen?
I don't think it will crush Christmas in and of itself. It depends what it then leads to, because oil at $100 a barrel starts to make the whole central bank rhetoric of we have inflation completely under control a bit of a farce. So we know that oil is a huge contributor to CPI. They can talk about core inflation all they want, but ultimately what are people and indeed corporates having to pay for? CPI. So if it continues to rise, and indeed the drip-on effect, because of course it's not just at the pump, individuals who pay more for oil, it's also any corporate that has anything to do with haulage, for example, that will see those squeeze.
So Emma?
If it then leads to inflation coming back up and central banks having to respond, then yes, potentially it crushes Christmas, but I think we're a couple of steps off that.
So Emma, even if we don't get to that extreme, I'm wondering, what opportunities does it create? Like the lower end consumer, that gets hit the most. So is that going to hurt certain areas in European equities or U.S. equities more? Or is it go buy energy stocks, particularly over in Europe, because they're undervalued versus the oil price? How do you play it then from that perspective?
I think at the moment, actually, there isn't an obvious investment play, and that's simply because, to answer your question directly, consumers have weathered far higher prices than this at the pump. We're at 3 point something in the US, and it was at 5 at the very peak. So I think there's a bit of a buffer before then you potentially start to see that impact. But then to counter that, maybe now is the entry point, because stocks may come down a little bit from here, but it's better to be too early than too late when you're looking to benefit from the bounce. So I think ultimately, as your previous guest was saying, this might be actually another contributing factor to the global route. And actually this we could turn back in 6 months' time and say, actually, this is the beginning of that extra bit of pressure that comes down. And then I think only then actually do we start to see real attraction in UK and European equities. I think it is really going to take an entire global route for people to realize the value that's stored there.
Wow, that could be an interesting process to work our way through. Yep, that's the Grinch coming for Christmas. Emma, Alex is very excited about Canadian CPI today.
I am.
It's re-accelerated. I pause. It is re-accelerated because of the oil price. You're hinting at the fact that maybe central banks have more work to do here. How do financial markets react if the pause that we're expecting doesn't materialize or doesn't last?
Well, first, I suppose I'd counter that with there's not necessarily a pause here in the UK. We are expecting 25 bips. And indeed, the ECB last week indicated that may not be the last rise we see this year. But yet, in general, most of the market is expecting a pause from here. Markets don't like uncertainty, as well as I do. I think if there is a real change in direction because of that pressure from oil price, again, I think that's a catalyst for the global market route. I do think that stock markets are assuming that
You sound quite bearish.
I am bearish. I was bearish when I came to talk to you 6 months ago, so I realise I may be
really
like that clock that's right only twice a day. But I really do feel, actually, that the evidence is beginning to mount. The inflationary pressures, the Bloomberg figures yesterday about wage expectations from US. I mean, that kind of statistic is a real leading indicator to the fact that inflation is becoming more and more baked in.
Emma, quickly, what do you buy? Where do you hide out then as we wait for the route?
I do think if you're prepared to be a bit early, that there is some value to be found in UK equities. and that's not just my view. We've been talking to quite a lot of kind of multi-asset investors over the last couple of weeks, and they are beginning to tentatively buy in because the total return aspect, you're still getting some very attractive dividends, which are well covered in the UK market, but it's tentative.
Yes. All right. We appreciate it, Emma. Thank you for coming in. Emma Wall-Hargraves, Lansdowne, head of investment analysis. I don't know, between Emma and Mark, I'm really feeling bummed. Okay, coming up, speaking of unbummed, he was one of the few analysts who accurately predicted a slump in Volkswagen shares 2 years ago, and now he says it's time to buy. Philippe Bourgeois of Jefferies on why he's so pumped for the German automaker. This is Bloomberg.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
One of the few analysts to correctly predict the slump in Volkswagen shares almost 2 years ago now thinks it's time to buy, double upgrading the stock today with a buy rating and a €150 price target. Philippe Bourgeois, global autos analyst over at Jefferies, joins us now. Philippe, why the double upgrade?
Well, you know, it feels that you look back on Volkswagen, it seems like a lot of what could go wrong has gone wrong. And the valuation is half what it was 2 years ago. And yes, you can kind of carry forward what you've seen in the last few quarters and continue that trend, or you could take a view that this company is still powerful and strong. Management is aware of the issues and they're going to do something about it. And that's kind of what drives our thinking that there's limited value in trying to projecting the recent past into the future, and it's worth looking at what can be done to correct the situation.
Why doesn't the market recognize the value of Porsche in the VW stock? It's always confused me.
Yes and no. I think there was this easy story about, yes, you list Porsche, and the market always knew Porsche was worth that much. It was in Volkswagen. It didn't have a listed price, but we knew about it. In that transaction, what happened is effectively Volkswagen lost control of the core cash flow of Porsche. Now, once Porsche SE got the minority blocking rights, they effectively get de facto blocking rights over the cash flow. And I think there was a net loss of value for Volkswagen and for a stock that we knew all along was worth that much within the Volkswagen situation. So effectively, it was a net negative.
Philippe, the argument though with, there is enough bad news, you trust management to take care of it, but things can always kind of get worse. And I wonder, what specifically gives you more confidence now that maybe there's been enough worse stuff?
No, I think I've looked at the company for many years, and I feel like there was something, and I say that carefully, there was something very insular about Volkswagen. They were going to be the world leader. They were the best. And It's a company that 25 years ago used to cooperate with other car makers to share costs, make sure they invested wisely. And then they decided to do everything on their own. And I think that's expensive. And I think in some ways, like any conglomerate, they've all kind of struggled between need to centralize, need to give the brand independence. And I think that management hasn't really managed that properly to ensure that the conglomerate that Volkswagen is was becoming capital efficient. And we look at management today, we listen to Dr. Blumer, and it feels like there's a big questioning of what they've been doing for a number of years and a willingness to rethink sharing. You know, they're going to China to cooperate on platforms. We think they're going to do something on software. And that's a big change of the management philosophy at Volkswagen that that caught our interest.
Philippe, is the China risk fully priced into European automakers, though, including Volkswagen? The risk that the Chinese respond, retaliate, if we are going to see EV tariffs?
Yeah, I mean, I think it's interesting because the risk is two ways. You know, the German presence in China and, of course, the Chinese OEMs coming into our markets. I wouldn't say it's priced in, but at the same time, I feel like it's interesting to keep in mind that half the investment of Volkswagen in China is Chinese companies. Are they going to drive this business down to zero? Probably not. The Chinese also have been very good at playing the level playing field game for a number of years, asking Western brands to invest and produce cars in China. What Europe is considering doing is reversing that logic and asking the Chinese to have a level playing field in Europe. So I think there's a lot of noise, there's a lot of commentary. At the same time, fundamentally, I think we're going to see less market share of Western brands in China. That's already happened. We're going to see market share for the Chinese in Europe. The question is, do we manage that the same way that Europe managed the penetration of the Japanese brands 30 years ago? And Europe never wanted to keep the Japanese out. They just wanted them in on a reasonable term, giving time for the European competitors to raise their game effectively.
Philippe,
and I think the same thing will happen over here with the Chinese.
Staying with our news of the day, too, if oil hits 100 and kind of stays around there, what happens to the car makers? Does that help the shift to EV, but it also maybe kicks up their own input and manufacturing costs? Like, how does that play out for these guys?
Well, it does help the EV. I mean, EVs, I think, is now well understood. There are all kinds of issues about how you make them, etc. But fundamentally, it's a more efficient use of transport, almost efficient use of energy. And the more expensive traditional energy becomes, the more attractive EVs can be. Of course, the electricity price can go up, they can be carbonized, etc. But overall, the efficiency, the amount of energy you need to move a vehicle in an electric powertrain is a fraction of what you need in oil. And that is going to continue that trend, I think.
Do we need to see government support, though, to make that transition work? I saw a story the other day suggesting that VW is having to lay people off because corporate help via government is not coming and therefore demand is falling. How as an investor do you understand the politics involved in that?
Yeah. No, I mean, I think it was clear all along, and I think Tavares at Stellantis made that very clear. This cannot, there needs to be incentives, but they cannot last forever. To some extent, we've done the relatively easy part. You sell expensive EVs to people with good income, and you incentivize them. That was easy to get that penetration. Now you need to get to the middle of the market. It's more expensive, it's more complicated, and the supply is not quite there yet. So, but I think it's not a surprise anybody could think about this logic.
Yeah, when you're explaining like that, there is some logic to the logic. Philippe, always a pleasure. Nice to see you. Nice to read the notes. Thank you very much. Philippe Houchois of Jefferies. Closes next. This is Bloomberg.
Greece. When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenevec bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Stocks finishing the day here in Europe. It's been a muted session. Actually, we've rolled over this afternoon. That probably makes it makes it look a bit more muted than maybe actually it's been. So that's the kind of day that we're looking at. DAX down by around 0.5%. CAC and the FTSE 100 absolutely flat. Let me show you how the session has developed. Volume's been all right today. It was a little light yesterday. Today, looking a little bit better, but we're going into the main event obviously tomorrow with the Fed. You've got the Bank of England coming up, you've got the BOJ on Friday. There's lots to get through over the next few days. So here we are, little pop first thing, but a fade throughout most of the day. That takes us, we'll get through the auction, but basically we're down by around 0.1%. Flat on the day is the kind of index narrative. Single stocks, there's some interesting narratives here to develop. Let's talk about them. Kingfisher, I think, is the one that really stands out. Fits with the retail theme that we're talking about today. This is the owner of B&Q, Screwfix, Castorama, these kinds of stocks, DIY businesses. And they basically came out today and significantly downgraded profit expectations. Weakness in France, weakness in Poland, that's the narrative. The consumer is beginning to retrench. The consumer is beginning to suffer a little bit. Kingfisher stock gets marked down significantly. The retail sector is the worst performing sector in Europe today. Ocado, though, out with slightly better numbers and actually a profit lift, which the market liked. But as you can see, the reaction on the downside significantly greater than the reaction on the upside. I think that's an interesting sort of point that you want to bear in mind. There are cracks beginning to form, and if you miss and you downgrade, boy, do you get punished. We were just mentioning Volkswagen. Philippe Houchoir's upgrade note today, certainly adding to the upside. Double upgrade to buy. That stock up by 2.85%, nearly 3% on the day. Everything that could go wrong has gone wrong, basically, seems to be the narrative, as a result of which, upside from here, Alex. Let's talk about the day ahead. We do get into the main events tomorrow. It is, of course, the Fed. The traffic continues in New York to be a problem with UNGA. You've got German PPI data. Car registrations out of Europe, talking of what's happening with Volkswagen, is going to be interesting. We get the UK RPI index and UK CPI. Now, the inflation story is starting to get very interesting. And why is it starting to get interesting? Because oil is beginning to pick back up, Alex. And we've seen that in the Canadian data today. Are we going to see it in the UK data starting to be reflected maybe tomorrow?
Yeah, I mean, that was basically why. Gas prices, there you go, and did have effect in the bond market. So ahead of the UK CPI data, we also want to take a look and look ahead to the Bank of England on Thursday. Akshay Singhal is EMEA head of short-term interest rate trading over at Citi. Just set us up. How is the market positioned for the BOE and for UK CPI tomorrow?
Thanks. Yeah, I think, going into the Bank of England, going into CPI, We have a lot to look at, but really I think the market is very asymmetric in terms of the reaction function, and that's because any downside miss to CPI really means that the MPC suddenly doesn't need to hike rates anymore. And they've already laid the groundwork for that over the past 6 weeks, including in the August monetary policy report. And so if you do have that little bit of a downside shift, you could suddenly be looking at a Thursday meeting where the market really suddenly is not very confident of whether they hike or not. We're going in with about 80-85% priced in, but all of a sudden, if that comes out a little bit weaker, I think it's very reasonable to suddenly shift and think that it's much closer to a 50-50 call going into Thursday.
What happens if we get a Canada and gas prices contribute to a higher than expected print coming out of the CPI figure tomorrow?
It's a real risk, and the Bank of England has historically, especially over the past 2 years, really missed the mark in terms of their inflation forecast. If we do get that increase in CPI, a big upside surprise, the real issue here, though, is that the Monetary Policy Committee has kind of committed to only doing 25. You even had Catherine Mann, the most hawkish member of the MPC, trying to convince other members just to hike rates now. So it's not really clear that they're going to upshift and get anywhere close to 50. It's really just a question of whether they'll hike 25 in this week and then maybe again in November. But really, I think that...
But does it increase the chance of that signaling about the kind of the subsequent rate hikes? Do I start to price that in tomorrow? From what you said so far, what I'm hearing is the bigger risk actually is we get a CPI miss. The market's not positioned for that. They're priced for a hike.
Yeah.
But I'm wondering kind of how the market looks at that hike and then says, yeah, but it's not going to be the last one. We could see significant. I'm just wondering what the sort of symmetry between those two is.
Absolutely. I think you do have that risk. But you have to remember that this print tomorrow is the last data point before September. And then if you start looking ahead to November, you have a whole nother set of data.
Sure.
And you even have the same thing with the Canadian CPI, right? We get another print before that October Bank of Canada meeting. So while it suddenly looks like they should be hiking rates in October, if you get a downside miss in the next print, all of a sudden that goes out the window.
So Akshay, I guess I wonder over the next 4 days, we're going to get 11 central banks, all across the world. And I'm wondering which is going to move rates more? Where are we going to see the most volatility come from?
So, I mean, number one is always going to be the Fed. The Fed leads all the other central banks in terms of the communication. And they've done a fantastic job over the last year of leading markets as well. And the credibility that Powell has gained over the past year, really, has been incredible. And to the point where, his words are really what drives a lot of the other markets and what drives fixed income markets across the world. Now, I'd say that a lot of the other central banks that we have this week, most of their policy outcomes are kind of known. For instance, you take the Bank of England, I'd say, most people are really expecting a hike. It would take a pretty big miss for them to not hike. Same thing with a lot of the European central banks like the Norges Bank or the Riksbank, SNB. So all of these, their policy decisions are not really up for discussion. It's more the forward guidance. And in terms of that forward guidance, most of the central banks, even though they want to be done, they're going to have to give that nod to higher inflation, higher energy prices, which means that they need that optionality to hike rates again in the future.
The opposite side of that is that oil prices are going high right now. Now, that's in some ways inflationary, but actually it feels like at this stage in the cycle, it could be more of a tax on the consumer rather than an inflationary concern. I'm wondering how you guys are thinking about how the curve is going to develop from here. If the consumer does crack, if the labor market begins to roll over, how much downside is there going to be over the next few months, potentially at the front end, as the market realizes that the Fed might just be done, but also may have to start thinking about what's happening with the cut story as the economy begins to roll over and potentially quite quickly? How likely is that scenario that actually we see quite a big shift in the shape of the curve as the labor market starts to come unstuck, as the consumer starts to feel the pressure of student loans, of high oil prices, of the rates that have already come through? There's plenty coming down the track.
There is. There's a lot coming through, and higher oil prices will definitely shift that balance. But I think, for the past couple of years, central banks have been very attuned to all of these exogenous shocks and needed to hike rates as a result of that. So while the dynamics might be shifting in terms of suddenly meaning that that's more of a tax on consumers, That's not the way it's played out in the past couple of years. And I think that central banks historically take a little bit longer to shift those models. So I wouldn't expect them to suddenly shift and go, actually, this is going to hit demand a lot harder. In reality, it probably increases the chance of further rate hikes. And all of the central banks are still looking at inflation as risks are tilted to the upside, not downside. And given that outside of the US, all the other central banks have one primary mandate, they really need to be keeping that optionality for further hikes rather than thinking about cutting.
It's going to be fascinating to see how quickly the data potentially moves. Actually, great to see you. Thank you very much indeed for setting us up for what's going to happen tomorrow and into the Bank of England, clearly on Thursday. The Fed tomorrow, of course. Actually, Singal, EME head, short-term interest rates trading over at Citi. Let's take a quick look at where European markets have finished. To be honest, yesterday was quiet. Today's a little noisier, but not much. The noise really kind of gets amped up tomorrow into the Fed, then into the CPI data, into the Bank of England, into the BOJ. So today, a little quieter, as you can see. The DAX under a little bit more pressure, but the final numbers, we've rolled over as the session has progressed, but actually a fairly flat session. As I say, Monday, Tuesday quiet, Wednesday, Thursday, Friday, super busy. This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster. Stocks definitely trading heavy today. Tech being led down the most here. NASDAQ 100 off by a full percentage point. Abigail's tracking the moves. Abby?
Yeah, and here's this decline, Alex, and it's sort of out of nowhere because overnight these are the NASDAQ 100 E-mini futures basically flatlining along even and then starting out around 8 a.m. starting to take a dip lower. Probably the major reason being yields higher. We'll be taking a look at that in a moment, but it's broad-based relative to the big laggards that are dragging. If we take a look at what's happening beneath the surface for the NASDAQ 100, we'll see that Amazon is down more than 2%. We'll also see that Microsoft is a laggard on the day. Starbucks, interestingly, down more than 2%, one of the biggest point drags for the NASDAQ 100. This, of course, as it's being downgraded on some China concerns. Real deterioration. It's interesting because China in the last quarter super strong, up more than 46% year over year. But we're hearing lots of reports about how the China economy is weaker than some had been reported before. This analyst seems to be confirming that. Interesting call going into the report that will be coming up in the next earnings season. As for those yields, everybody's talking about 433, 435 is an important technical level. The reason they're talking about that is if we go back a year, we were around that level. That was the highest that the 10-year yield got briefly. And then a few weeks ago, similar deal, trying to punch through right now this resistance. It does appear likely that this will happen because you can't see it so well here, but it does, there's a set of higher lows, which tells you that the sellers of treasuries, they could start selling even more. We could see this 10-year yield go, I would say, pretty quickly above 5%. A lot of people have been talking about 4.5%, but if we go through this level, I think it's going to be a much bigger move. As for the NASDAQ 100 and the pressure that it's creating, we're starting to see more of a breakdown here. This is that uptrend we've been following all year. We've been following to see whether or not the NASDAQ 100 can hold it. That has been the case, but right now, Guy, we have now, for a second day in a row, we are below the uptrend. You can see the 200-day moving average calling below. The RSI is starting to round down. Net, this looks like some investors are nervous going into the Fed, and as I speak about it live right here, I wonder what this means around the Fed, because this looks very rate sensitive to me, and it does look like we could see a bit of a breakdown, similar to what we've had for Apple over the last several weeks.
Yeah, keeping an eye on Apple firmly, but as you say, market's a little softer going into the Fed. As you say, maybe rates don't come down, maybe as quickly as some had anticipated. Watch the dot plots. Abigail, great stuff. Thank you very much indeed. Alex, I know this is a story that you've been paying a great deal of attention to. BP is appointing Kate Thompson as interim CFO. Now, it's the first time we've seen a woman in that role. This, of course, after Bernard Looney's unexpected departures, causing a sort of moving of the deck chairs. But it does seem as if you want to be a CFO at a large oil company, you need to be a woman now.
That is actually a trend. Exxon has a woman who is CFO. Shell also does. Chevron announced some leadership changes back in July, where the incoming CFO will also be a woman, and then now BP. I just also think it speaks to the point, Guy, of the lifers in these industries. You're there for decades to make decade-long investments. You need people that have really been there, and I wonder how thin the deck is for BP.
Well, if Looney, you pointed this out to me earlier, if Looney had sort of gone in 5 years' time, then maybe they'd have been planning. They clearly haven't been able to plan for this. Helmut is going to have a lot of work to do to figure it out. Can they go internal? Is the deck deep enough, as you say? It's going to be a tricky decision.
Yeah, it really will. They're in there for a long time, like decades, to make these kind of decisions. Okay, well, coming up, leaders from around the world are in New York for the 78th session of the UN General Assembly. Jens Stoltenberg, NATO Secretary General, is in Manhattan. We speak to him next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
So President Biden has just been speaking at the UN General Assembly, making a number of points about where he thinks America should be positioned and where the world should be positioned as well. Politics is beginning to ramp up in the United States in a way that we haven't seen for a while. Steve Schwarzman, the chairman and CEO and co-founder, of course, of Blackstone, speaking earlier on today to Bloomberg's Danny Berger at the IPM Private Equity Conference, which is taking place in Paris, he had a lot to say about US politics and the current state of American politics and where we go next.
American politics, I've found, at the presidential level is pretty volatile. The people you think are going to win, whether it was Hillary in 2016, and they didn't win, other people who were no place, they end up winning. In 2015, about where we are now for a presidential election for the Republicans, you had the governor of Wisconsin in first place. You had Jeb Bush in second place. You had Rudy Giuliani in third place. And by the time there were 2 or 3 primaries, they were all gone. And somebody named Donald Trump won, who wasn't even in the game. And so I think all the straight line predictions of what's going to happen, I sort of just sit back and say, I've seen a lot of volatility in my life of what the public wants. Apparently the public is not that interested in really older people.
That was Steve Schwarzman, Blackstone chairman, CEO, and co-founder, along with Bloomberg's Danny Berger, joining us there. So that's interesting, Guy, because does the Biden administration know that it could be a volatile playing field? I don't know. I think what also could be interesting is as we kind of drum over the next 11 days to a potential government shutdown, what that looks like, how it's resolved, who the players are, and along with the United Auto Workers strike as well.
I think the UAW's put Biden in a really tricky place. I don't know how he quite deals with that and finds his way out of that. But I think this also applies to both sides of the aisle. Whether or not the American people want an older generation to continue to run the country is a difficult question. I think this is an issue for the Trump camp as well as the Biden camp. The Republican, who's going to ultimately be the Republican candidate, I think is a really tricky one at this point. What happens? There's so many players that could still come in, Yonkin. There's all kinds of names that are still being talked about. Let's talk about how the next few days are going to play out and what this all means. Anne-Marie Hordern joins us now from the UN. Anne-Marie, I'm fascinated. I think we're really building up to a critical moment for US politics once again. The potential shutdown is there. America's ability to continue to fund the war in Ukraine is up for grabs right now. There's a lot of pieces that are going to fall into place potentially over the next few days, which could have an impact on that general election.
Yeah, it's a critical week, I would say, especially when you're looking at funding Ukraine and that supplemental aid package the White House had requested, which, when you look at some of the Republicans, the defense talks, especially in the Senate, they want to make sure that's through. But this Ukraine aid is not even in the continuing resolution that the Republicans put on the House floor. And McCarthy didn't mince words when he said no, he would not be putting it in. But Zelensky is speaking today at the UN General Assembly, and he's going to make his case to the international community. But of course, he's also going to be making his case to a domestic U.S. audience. In early August, you had the CNN poll that showed that actually most Americans are a little bit concerned, and there's some fatigue about the taxpayer dollars that are going over to Ukraine. And McCarthy spoke today and said that they want to make sure that there's an oversight, proper oversight to this. And he said he's going to be asking Zelensky some questions. So Zelensky will speak here. He will then go to Washington, D.C. later in the week. He'll be at the White House for a bilateral with President Biden. And then he's going to huddle with a few lawmakers. And the most key there will be Speaker McCarthy and his Republican caucus.
Anne-Marie, what does Zelensky need to deliver? Like, what are the assurances that he needs to give?
Recently we did see Zelensky do a shakeup of his cabinet. We have a fresh new defense minister in Ukraine, and there was concerns about, the oversight when you saw where the potential money was going in the Defense Department. So he says he is committed to making sure he's cracking down on corruption that still lingers in Ukraine.
Anne-Marie, is there growing concern, because I'm certainly reading articles about it increasingly over here in Europe, about what a Trump administration would mean for the global order, for the global international architecture? Is that something that people are talking about actively in the corridors of the UN as the General Assembly meets?
It is certainly something people are talking about. I spoke to Annalena Baerbock, the German foreign minister, on Sunday after she really did a U.S. tour of conservative America. She met with Governor Abbott of Texas. She met with House Republicans and Senate Republicans in Washington, D.C. before she came here to New York. And she said that there was a shock. And by the way, we should note that Chancellor Olaf Scholz has already come out and said he hopes Biden wins the next presidency. She wouldn't go that far, but she said there was a shock in Europe that there would be the Trump administration would openly question NATO. And she says that now Europe would be better prepared. But when she spoke to Republicans in Washington, she also said she understood some of their concerns. Look at what is happening in Germany right now. You have millennials that are looking to the Alternative for Germany party. They are polling very highly right now in Baerbock's own country. And that is because there are concerns similar to the United States about things like inflation.
Yeah, which leads us to the government shutdown. We got, countdown 11 days. Does McCarthy have control of the situation?
Well, he says he's going to put the bill on the floor. That bill likely will get voted down, although there are some members of the Freedom Caucus that worked on this bill and members of the members that are more centrist in his party. There are a number of individuals who just, to be honest, want to wreak havoc. I wouldn't say they're Freedom Caucus members. Some are, or some just aren't. But there's about 10 to 12 individuals that want to vote it down. He has a slim majority. He can only lose 4 votes. But at the end of the day, that will give him potentially some breathing room then, because his own party voted it down, for him to then just pass a clean CR, continuing resolution, to keep the government spending and the government open past September 31st. But this is going to be a fight, not just within the House, but also within the House and the Senate. When you look longer term about appropriation bills, they're about $100 billion apart.
Yep. The next few days are going to be fascinating. I know you'll be there to cover for us as we count down to that moment. Anne-Marie, thank you very much indeed. Anne-Marie Hordern joining us from the UN in New York. What are we going to talk about next? Nick Einhorn, Renaissance Capital Director of Research, joining Bloomberg Technology, joining Caroline Hyde and Ed Ludlow. Both of them are in New York. In terms of what's happening with markets right now, we are on hold. We are waiting, we are watching, we are clearly on tenterhooks, waiting to see what the Fed is going to deliver us for today, for tomorrow. For today, a little bit of a shock coming through in terms of the narrative around that Canadian data. The other story we're watching as well, which the guys are going to be covering on Bloomberg Technology, the Instacart IPO. We're looking forward to exactly and seeing how that one goes. That's next. This is Bloomberg.
given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. The big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. Yeah. I don't believe for a minute that we can have a Cold War II without a similar risk.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from Bloomberg's world headquarters in New York, I'm Caroline Hyde.
And I'm Ed Ludlow here in New York City. This is Bloomberg Technology.
And coming up, we have full coverage of the Instacart IPO as the grocery delivery and software company it gets ready to trade this hour. Much more ahead.
Plus, Apple seeing bright spots in China as iPhones sell out within minutes of being released.
And we'll speak with Eric Whitman, the incoming CEO of photo and video app Visco, get his outlook for the social media company. But, of course, we want to really be digging in the hot news of the day. This is largely around an IPO story. Instacart, of course, finally a VC-backed company coming to the markets. We're anticipating that first trade. Katie Roof is here also anticipating all your sources, waiting with bated breath. Remind us as to whether or not they're making money on this, because we do know that the valuation is significantly lower. They're in the heyday of COVID for them.
Sure. I think, it depends on when they invested. I mean, if, anyone who just invested in the round in 2021 where they were valued at $39 billion, they're not making money yet, if ever. But the investors that invested very early, when it was just a tiny startup, then certainly, it's turned into a multi-billion-dollar company. And early indications show that this company is probably going to pop a significant pop, maybe like 30% or more. And so that would put it at or above the $13 billion valuation that the company lowered itself to last year, its internal valuation. So the company was aware of market conditions and market realities. They knew that, $13 billion was, a more reasonable target.
More than a decade old, this company. Since its founding, it has changed the way in which it sort of strategizes, moves forward, particularly under Fidji Simo, the new CEO. I spoke with her and discussed sort of the era of competition. And it really does feel as though Fidji sees everyone as a competitor in many ways. They fundamentally, though, say they are uncontested market leader in grocery delivery, but they're continuing to really gain share. They're looking at strengthening, in particular, the competitive advantages of ultimately advertising, of software. Katie, how's this company pivoted under Fidji?
Sure, yeah. So many people think of them just from the consumer-facing side where they receive groceries. But obviously, if you look at their revenue, they have a lot of different revenue streams. They have software, to help with fulfillment. They've really strengthened their advertising business, which is, they have so much data about consumers and what they like to buy, which is really valuable for people trying to advertise groceries. So they've done a lot of different things, and also they have subscriptions, so people pay more to be regular customers of Instacart. And something that's been a little controversial, sometimes they charge more per the price of the item than what you would pay in stores. So they're collecting revenue from customers in a lot of different ways, and particularly from business partners.
Now, I don't know if my household's different, but actually it's my husband who generally does the grocery order via Instacart from time to time. But I spoke with Fiji about what this means as a moment. Look, there are very few women bringing companies to IPO. It's also notable that she feels that a lot of her customers are women. 70% of the shoppers are women. So it's really important, she says, to build the right product, have the right voices at the table. She's really been trying to lean into the amount of executives, a diverse leadership team that she has, Katie. But talk us through that team and what this means for, well, not the founder, but certainly a female CEO to bring a company to list when we see, what, less than 1% of all IPOs being led by women?
Yeah, certainly it's a very low number of newly public companies that are helmed by a woman. But yeah, she makes a good point. I mean, a large percentage of household budgets are controlled by women. So you look at who a lot of the people are that are buying groceries, it's women. And so certainly, it helps to bring that perspective. But yeah, I mean, she's, the current CEO, she's someone who's very seasoned in the business world. She worked her way up at Facebook, being, one of the top executives there. So she's not some, junior person who didn't know what she was doing. She's, already well respected in the tech world.
And boy, she brought her advertising prowess to this particular business. Katie Roof bringing us all the inside track on what is a VC unicorn finally listing after a couple of years hiatus. Let's get a little bit more on the world of IPOs and just talk to Nick Einhorn. He's Director of Research over at Renaissance Capital. And we're on the trajectory. We've had ARM, that popped. Yes, it seems to be rolling over somewhat now, but it wasn't VC backed. Now we get the likes of Instacart. Then we look to a Klaviyo. How important are these listings, Nick?
Yeah, they're definitely very important. It's really been 2 years with almost no tech IPOs. One or two. Mobileye was a successful one last year, but these 3 deals in the last week are definitely a good barometer for the health of the tech IPO market. And like you said, ARM has been public before. It's a very mature company. So it's really Instacart and Klaviyo that I think are the better indicator for where tech appetite is amongst investors right now.
What do you make of the way in which this company has been listed? It was notable that they sort of priced on a Monday. That's not usual, but they really were trying to ride on the coattails, it felt like, of ARM. The fact that they've got a CFO who was at Goldman leading these sorts of issuances. We know that they're well navigating these sorts of markets, but the fact that we could get quite a big pop, it seems like, at the initial trade. Are they leaving too much money on the table to have a successful IPO?
I don't think so. I mean, we know we're in an environment where the IPO market has not been particularly strong lately. Certainly, there's a lot of caution out there on the part of investors. And so I think they needed to convince investors that it was a good valuation, that the stock was being positioned to trade well. They got the cornerstone investors involved, as well as the private placement from PepsiCo. So kind of a lot of things to sort of help make sure the deal is a success for investors. And I think part of why... Oh, sorry, go ahead.
No, just a little bit about the competitive moat, or lack thereof, Nick. There's been some hand-wringing about really how much they can fight off not only some sort of frenemies, their customers who might be building out their own e-commerce plays, the fact that they are also seeing competitive elements from Amazon as well. Who is the key competitor for you?
Yeah, I think there's definitely a bunch of them. Amazon is one. DoorDash, I think, is an interesting one. Obviously, they're more focused on restaurant delivery, but they've been building a grocery business over the last few years, and they've taken a lot of share in kind of smaller transactions, so more impulse buys versus the weekly shop. Instacart thinks they still have a good advantage over the kind of the weekly purchasing, but DoorDash is definitely a key competitor. And then the grocery retailers themselves, especially Walmart, some of the other big ones, are definitely competitors, but Instacart also works with them, a lot of them, on the back-end technology. So Instacart, I think, is trying to kind of shore itself up there.
Nick, what have you learned about the risk tolerance that technology investors have now the IPO window broadly is open back it up?
Yeah, I think there's definitely still some caution out there. We're not in the 2020, 2021 mindset. But one indicator we look at is the Renaissance IPO Index, which is the underlying index for our ETF that tracks the IPO market. And that's up about 33% year to date versus about 17% for the S&P 500. So I've definitely seen some of that risk appetite come back into the space over the last year. It's still not where it was, but I think we're in the right direction for IPO activity to increase.
There's a lot of excitement, right? There is some sort of IPO window back, and in the background you have the Fed. We started talking about China. We started talking about the macro and the economy globally. How short-lived do you think this IPO window is going to be?
I like to be optimistic. One indicator we look at a lot is the VIX, the volatility index, and that tends to signal whether IPO activity is increasing or decreasing, and that's been coming down this year generally. It's in the teens now, I believe, so that's usually a good level for IPO activity, but obviously a lot can change quickly. So, fingers crossed we can maintain good activity going forward.
Why getting Renaissance Capital on is so important for our viewers is because you are doing that hard work of pre-IPO companies, bringing that research, that transparency. Who then are you waiting for? Who's waiting in the wings when we think we get through this week of Instacart, of Klaviyo? Is it onto Turo? Who are the other key names that you're going to be keeping and updating your research on?
Yeah, Turo updated their prospectus recently, so we think they're likely to come soon. Birkenstock filed a few weeks ago, obviously not a tech name, but a well-known consumer name following on from some successful consumer IPOs in the summer. And then beyond that, there's a lot of companies that are waiting in the wings, probably looking to see how Instacart and Klaviyo do this week. Companies like everybody from Reddit, down the line, lots of tech companies, lots of companies in other industries. So we think there's definitely a big backlog. It's just a question of when they think conditions will be right.
All right, Nick Ihorn of Renaissance Capital, thank you for your time. I want to get a quick check on the markets because there's other news stories out there driving individual names. One we're looking at is Block. Lisa Henry is leaving the company, 9 years at Block. She ran the Square business. Jack Dorsey, who is already at the head of Block and chairman of the board, is going to come in and run Square, and analysts saying they see that as a positive, even though it's a long-time leader leaving that company, a stock that's not done well year to date. Disney down almost 4%. They're doubling their CapEx commitment for the parks, entertainment, and products division to $60 billion over a 10-year period. They're going to be investing in the theme parks and cruise lines business. We're getting more insight into what Bob Iger is doing. Now that he's back at Disney, what's the strategy? That moving the stock lower. And Amazon down 2.8%. They just announced they're hiring 250,000 seasonal workers for the holiday period, particularly in logistics. This is a company that ended the June quarter, had 1.46 million employees, having actually cut back, Kara, as you know, throughout the early parts of the year. That kind of weighing on the stock. It had been down anyway amid everything that's going on this week. And by the way, just a quick update on ARM. We're in its fourth trading session now, and it's trading at $54.80. We're below the price where it opened on Thursday. Interesting how short-lived that was in terms of the pop that we got and then the downward trajectory thereafter, Kara.
Maybe a little profit taking, maybe a little, still above that $51 where it priced, but notable as we check on these other IPOs. But Ed, we've got a wild story coming up for everyone because Microsoft has uploaded confidential documents to a federal court by mistake. It's all on that website. We'll have more on what they reveal. That's next, and this is Bloomberg Technology.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing is actually the risk-taking is what's going to move. And so We've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Okay, time for some Talking Tech. And today we talk all things Microsoft, starting with its AI research team accidentally exposing a large cache of private data on the software development platform GitHub. That's according to a new research from a cybersecurity firm called Wiz. The exposed data included Microsoft employees' personal computer backups, secret keys, and more than 30,000 internal Microsoft Teams messages. Plus, Amazon's hiring Microsoft's product chief, Panos Panay, to run the division responsible for Alexa and Echo smart speakers, that according to Bloomberg sources. Panay is almost 20-year veteran who led Microsoft's Windows team and was central to the company's hardware push with its Surface computers. And Microsoft plans to refresh the Xbox consoles in the holiday season of 2024. That's according to a product roadmap mistakenly posted online as part of its case against the FTC. The changes are improvements to power consumption, better wireless technologies, and built-in storage, and a physical redesign. This is one hell of a leak. Let's get more on it with Bloomberg's Cecilia D'Anastasio, who's with us in New York. Let's start with how on earth that information came to light.
Thank you so much for having me. We are hearing that Microsoft accidentally leaked confidential documents about plans around new Xbox consoles, refreshed Xbox consoles as soon as 2024, upcoming games that have never been announced before, and a variety of things.
Can we get to the bottom of how or who? Because there must be a lot of hand-wringing internally today.
There's a lot of hand-wringing internally today, especially because of the other leak that you referenced earlier.
Bad week.
Yes. Our understanding at Bloomberg, a source told us that it was not the FTC behind the leak, it was Microsoft.
Okay, so Microsoft potentially trying to trail back as to who and how. But does this happen often? Do we see these sorts of leaks and this sort of integral data that actually is very hard to find in terms of price points, in terms of ultimately IP that they're going to be revealing?
Gaming companies are famously very, very secretive about upcoming plans around these things. And this is the biggest leak in Xbox history. It's fair to say.
Okay, I get it. There's a leak. Leaks happen. The big news is we're getting a mid-cycle Xbox console refresh, which just doesn't happen. And full disclosure, as our audience knows, I'm a PS5 guy right now. What do we know about this new Xbox?
I have to say, personally, I'm shocked because in June, Xbox head Phil Spencer told me that he didn't see an imperative to have a mid-cycle refresh. And so we're kind of trying to reconcile this competing information now. But it is typical for, after 4 years, a console to come out with a refresh that has increased storage, like you were saying, and things along those lines.
So I guess bigger picture is we did get some insight into Microsoft's video game strategy. What did we learn?
We learned that Xbox is planning a mid-cycle refresh as soon as 2024 and a new console as soon as 2028. Of course, these plans are subject to change, as everything in the gaming industry can be very volatile all the time. We learned about updates to beloved games, including from Bethesda, which is part of ZeniMax, which Microsoft acquired as well. We learned about discussions around acquiring a Nintendo, which we knew that those discussions had happened. We didn't know that the board was interested as well until the recent leaks this morning.
And I mean, in this macro context where we're thinking of a Federal Reserve tomorrow eyeing inflationary pressures, I was interested that price points aren't going to be going up, even by 2024.
It is surprising because the price points on video games have gone up from $60 to $70. But consoles are, something that they're a luxury item. They're very expensive, and especially when gaming PCs are becoming increasingly popular and eating up more and more of kind of what people would spend on consoles, it makes sense.
Makes sense.
Makes sense. Bloomberg's Cecilia D'Anastasio on set here in New York. Thank you. Now, coming up on Bloomberg Technology, Apple's iPhone 15 is all the rage in China, even after Beijing expanded a ban on Apple products in many public workplaces. All those details next. This is Bloomberg Technology.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands which are more sensitive.
Apple's iPhone 15 is off to a strong start in China. The new iPhone sold out on China's Tmall within a minute of becoming available, according to the site's operator. For more, I'm going to bring in Bloomberg Intelligence senior tech analyst Anurag Rana. Anurag, you and I and Caroline have been talking about China for a week now when it comes to Apple. What is your first impressions of how the next-gen handset's doing?
No, it's a good news, and as we have talked before, China is the biggest wild card for Apple over the next 12 months. So any news like this is good news for Apple's iPhone sales, which all of us know will dictate Apple's overall financial performance in the near term.
So in the June quarter, Apple went from a 3% year-on-year decline to an 8% top-line growth. And what Tim Cook said was it was switchers. And my understanding of switchers, it's somebody buying an iPhone for the first time or transferring from a domestic brand. How do you see the technology upgrades on this next-gen iPhone 15 being a part of that switching story?
Yeah, I mean, our analysts in Asia already told me a while ago that the camera upgrade is such a big deal that it's going to drive a lot of enthusiasts to go out and get the Pro Max model, which is what excited us most during the event, that actually the pricing for that went up. So overall, I think this is a good thing because people are upgrading for the new camera. It's going to drive ASPs. It's going to drive new units. So I think it's good news for Apple at this point.
Anurag, can you line up where you take the most signals from, particularly when it comes to China? We're all trying to read those tea leaves at the moment. And yes, we've got Tmall. They're selling out within a minute or so. But then Barclays is saying early pre-order data from China continues to point to difficult iPhone 15 cycle, negative mix shift. Where do you go for the signals that are the right read?
So, one of the things you have to think about it from Apple's point of view, they do want to ship these things if there are orders. So when we look at lead times and we track it every day, sometimes it's very difficult to say whether it is because of the changing mix shift of the model with some supply issues, or is it just a demand? I think this is why we need several more weeks of data before we can, comfortably say that Apple sales are going to be healthy over the next 12 months, because December quarter is the big quarter for, all consumer electronics, and Apple's no different there.
Yeah, Morgan Stanley overweight price target 215. They too are saying that actually the China data points are better than expected. So we try to dissect where to get the real takeaway. Can you update us a little bit on your worries and risks around China? It felt like the narrative of last week after their event. What then of now? Are you getting any more signals on just the sturdiness of consumer and indeed government purchases?
Yeah, I think Mark Gurman, really, I talked to him about it, and it really, one of the things you have to remember that last time something like this happened, or increased rise of nationalism in China, it did have a negative impact on Apple. So we just want to make sure that, because what the government said for, the government phones, which is not a new news, it's been around for a while, but it was splashed around quite a bit, that it didn't change the consumer behavior. And so far it looks like things are on track for Apple. But again, we need a lot more data to be comfortable for the next financial year.
Just reflecting on being at Cupertino last week, and there was a lot of emphasis on the color selection for the Pro, the higher end Pro and Pro Max, because in China, red and gold resonate with the consumer. We didn't get that. But the Chinese consumer also tends to favor the latest technology, powerful processing, next generation camera. In your analysis, Anurag, do you see a differentiation between consumer behaviors in North America, Europe, China?
Oh, it's massive behavior. I mean, gold would do really well in India, Middle East. I can think of a few more countries. I personally am going to get the blue one next on Friday, but I know a lot of people who would want the red and the gold.
If anyone wants to know, I would definitely be a gold kind of a gal, but I then go and buy a really ugly, clunky thing to cover it all up so that I don't break it. Anurag Rana, we thank you. Enjoy your blue version, Bloomberg Intelligence. And I mean, Ed, the fact that you just said it's a week ago, just over, that you were in Cupertino. Time just flies, but this really was the purpose point that we were hearing from Apple, the new unveil, and as to whether or not it seems as though the mixed signals are pointing that it is a positive sales.
It's why going over the technology is so important.
Yeah.
The story was the Chinese government saying to government agencies and state enterprises, tell your staff to leave their iPhone at home, get a Chinese brand. Would that impact the psychology of the Chinese consumer at large?
Yeah.
Well, that's what we just talked about. No, they like color preferences. They want the latest technology. 5 years of data tell us that.
They want foldable phones?
Yep.
There's a great piece on the terminal about the lack of foldable coming from Apple.
Yeah, it was funny because when we were in Google I/O earlier in the year, they came out with Pixel Fold and they had really high compute.
Yeah.
And then we started talking about running AI, generative AI locally on devices. For me, it's just a feel in the hand thing, clunkiness of folding the phone, but maybe that resonates in China too.
And we know that the price point resonates in China. It also resonates for the bottom line and the fact that this is going to be driving up average selling prices. So certainly some price targets still on the higher side for Apple. Meanwhile, though, coming up, look, we're just talking about AI. Let's dig into it a little bit more, particularly when it comes to digital health. We're going to be joined by M13 partner Latif Parashar. That's next. We're going to talk also about the IPOs, Ed.
Yeah, we're going to talk about IPOs, but there is one mover that's been listed a little while. I want to talk about Rocket Lab, down around 8% now. It had opened as much as 10% lower, its biggest drop since May of 2022. This is about a failed mission, small satellite launch on the Electron rocket, and the payload did not make it to orbit. This is the third time that they've had trouble with the Electron. It's a rocket provider that is a high cadence launcher, nowhere near SpaceX, but one of the ones actually putting stuff into space. But this third failure really impacting the shares. We will bring you more on that story throughout the program. This is Bloomberg Technology.
want to be a consultant. And what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results. And that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
No, you're not. You're here.
Oh my goodness. How did I get here? Let's move on quickly and cover that with markets. NASDAQ 100, tech leading losses in public markets. Remember, the Fed makes its decision in 24 hours' time, widely expected to hold rates. We follow rates because they discount the future values of present cash flows the other way around. But also, if you're a private market investor and you're looking at public proxies, you're paying attention as well. Bitcoin, as you've been discussing in the past week, Caroline, continues to kind of march a little bit higher despite the risk-off sentiment that we're seeing. But look at yields creep higher as well. I think all eyes on the Fed, despite what's happening in other areas of the public markets and the tech sector.
Yeah, we've got to go micro. It's all eyes on one particular IPO today. We're awaiting where it trades. Instacart, our own Shonali Barsuckers, of course, keeping abreast of where we're going to be going from a price point. It looks like it's going to pop. Shonali, it looks like we're going to rise higher.
Oh, yeah, sorry about that. I didn't hear you over there, Caroline. So, yes, we are waiting for it to open, and it is indicated to price around $42 a share. That makes it more than a 40% pop if it makes it at the open. It also gives it a valuation upon the open at about $14 billion. That is not only above where it expected to be valued at out of the gate, it also is above its most recent funding round when it was valued and it slashed its own internal valuation to closer to $13 billion. And so upon the IPO pop, you are getting a little bit of boosted valuation. It's still, as we've been talking about, a far cry from that $39 billion valuation that it was able to ink in the heydays of the pandemic for Instacart when a lot of people were using the delivery app. Now, I know you and I will talk about this later, but the sell that Instacart might have as an AI-focused company, it doesn't even meet what you would get from Klaviyo as well, that is pitching the same type of idea here and is expected to price tonight in Instacart's wake. You had also Klaviyo up their IPO pricing range as well. Let's see if they're able to meet that, especially because the markets they're meeting are a little more muted than the markets we saw last week that ARM had listed into.
Yeah, it's interesting that ARM is coming off of those previous highs, but ARM's big sell was it's an artificial intelligence empowering company. And I actually spoke to Fujisimo about really the AI pitch that she's trying to take to the investor at the moment. And she's saying, look, with generative AI in particular, there's a really big opportunity to make the grocery even more convenient. We have all the data, they've got the expertise, they're making that experience happen. But look, it does take time, Shonali, but that's sort of their moat, isn't it? The fact that they've got this proprietary data that others aren't going to be able to have. That's going to be a tough sell, though, to remind people to go with them over the competition, particularly not only for an investor that's institutional, but a retail investor that they're pitching to right now.
it's a great question. And you're talking about the retail investor. Remember, this is the first IPO underwritten by SoFi, which is one of the secondary underwriters in this particular IPO. We've seen SoFi, for example, serve as an allocator to almost a dozen IPOs besides this one. But to the point you're making, this is the idea of bringing more retail interest in. As far as the moat goes, you're right. They are pitching their own data as it pertains to their client base here. But there is a general concern about what the margins for this business looks like and how fast they can keep diversifying, bringing in kind of that ad money as well. And what the broader economic environment looks like. Throughout the programming today, we've been talking about how much the consumer can come under pressure with some of these inflationary forces still at the fore. I would say Instacart, Klaviyo, hitting the market right before that big Fed decision. Timing is everything in the IPO market. And remember, we do have a scenario here in which even with the market flat to lower for the S&P 500, NASDAQ, and the SOX Semiconductor Index, you still have these IPO pops. It just tells you how much is at stake here for investors who want a play at new shares, as well as, remember, the question I've been getting all day, who wins? Think about Sequoia, D1, which will still have a very significant stake in this post-IPO, as well as some of the founders themselves of these large investment firms. Dan Sundine personally will have a stake in Instacart out of the listing.
Well said. I mean, we're looking at the ticking higher in terms of the indication price now at $42.61, Shonali. The fact that they have, like ARM, taken that playbook of having a lot of intentional investors who are going to be sticking around, taking a huge amount, I think about 2/3 of the overall shares that are going on offer, are already been allocated to some of these linchpin investors, the PepsiCos of this world. What did you make of that sort of new tactic that we have going on?
Yeah, it's interesting. Limiting the float, drumming up interest, PepsiCo being involved from the beginning. Klaviyo has a different set of cornerstone investors, more along the lines of the investment community, the lines of an Alliance Bernstein involved early on. But this seems to be the Goldman Sachs playbook, doesn't it? They are leading this round of IPOs. They were one of the lead underwriters on ARM. They are lead on Instacart. They are lead on Klaviyo. It is a big moment for Goldman Sachs in this wave of tech listings. Instacart's CFO as well, we know, had that Goldman Sachs alma mater, that expertise over there in terms of what it means to take a company public, especially in the world of TMT, technology, media, and telecom. That's also, by the way, the relationship that brought in SoFi with Anthony Noto, formerly in that world at Goldman Sachs as well. The new kids in town are David Ludwig, who leads global equity capital markets over at Goldman Sachs, Kim Posnett, who recently took over as head of TMT at Goldman Sachs. Big moments for them. ARM was a success. Instacart is looking like it's about to be more than 40% of a pop on day one, even in a down market. And Klaviyo tonight, trifecta.
I mean, yeah, all eyes on Nick Giovanni. He's going to be waiting with bated breath, of course, the CFO of Instacart, who is over heading DMT globally for Goldman up until 2021. Shonali, always so great to get your perspective when it comes to the ins and outs of what's happening on Wall Street and the people behind these sorts of deals. And we also know that people that have been backing these sorts of deals are, of course, the venture capital community. And let's therefore dig into VC Spotlight. We're taking a look at, well, overall, the IPO pipeline, the excitement that breeds for certain players, such as M13. And we've got the general partner joining us about some of the areas they've been allocating to of late. Latif Paracha, who leads the firm's investing strategy, focusing on digital health in particular, on fintech. You've got, what, $900 million in assets under management. And just for a moment, the IPO, the excitement, the exuberance of some companies that are VC-backed becoming public. What does that mean when you're writing a Series A check?
Thanks, Caroline. Thanks, Ed, for having me on. It's incredibly exciting. I mean, to unlock the IPO markets really then unlocks the growth market, which as an early stage investor, ultimately, that's what we're looking for. And there's Instacart, Klaviyo's tonight, and then we think there's a significant pipeline of really great companies that will unlock after that. So it's very exciting, and the best companies go public. And so we are always, as VCs, investing in early stage, looking for those generational companies to go IPO.
Is it really that much of a domino effect? So you see several companies go public. If you are a startup's done Series A, B, C, D, E through M, does that open up the opportunity then for you to do a big growth stage round because there's more money going into public markets as well?
It all trickles from the public markets, and so the growth investors that fund our companies need to return capital to their investors. We all have to return capital to our investors, and the way that the momentum will work is with the IPOs that will start to unlock. They'll start to return capital, and then they can invest that new fresh funds into our companies, which is going to be required ultimately to get them to the scale that a Klaviyo or an Instacart is today.
I'm fascinated by valuations at all end of the curve for startups. You know, those names that have gone public in this past week really emphasized artificial intelligence as if it was going to help them out. Is the same thing happening at the other end in early stage where you attach AI to your domain name, your valuation goes up?
That happens. We're very sensitive to that as a firm. You know, we really believe in hype cycles and being very sensitive to where we are in hype cycles. But hype cycles can be a good thing. In AI, you know, it allows for boardroom conversations and budgets to open up, and that can really help our companies. But we're very sensitive to the valuations that early stage companies can attach, and making sure that the founders that are building these companies really have domain expertise in AI and have a clear path to show how the AI is going to enable some product or service that can service the end customer.
And everyone's been trying to push that forward. Like, where is the disruption coming? Which industry groups? Legal, clear. But healthcare has been time and time again referenced. Is that something that you're focusing in on?
Yeah, it's a big focus for our firm and for me personally. If you look at healthcare in this country, it's $4 trillion of spend, nearly 20% of GDP. And I think we're really still in the very early days of the digital transformation. So we've, at the firm, invested in really innovative care delivery models around new areas of medicine, like Form, which is a market leader in obesity. And we've spent a lot of time now focusing in on how can you use AI to really support clinicians and health systems to drive better care and ultimately better outcomes for patients. And that's really always our end goal, is how can you deliver better outcomes and simultaneously rip costs out of the system.
I mean, we had a VC on from Underscore VC yesterday based in Boston. We're thinking of Fiji Simo and her team at Instacart celebrating in San Francisco today. Does it matter where these founders, where these businesses are being cultivated, being born? How are you getting access to all of them?
Founders can be built, you know, anywhere. We'll go anywhere to find the best founders. Ultimately, what we're focused on is founders that have real domain expertise. And so I'd love to give you an example of a company we just announced called Carenostics, which is providing localized AI for health systems. And so it ingests the healthcare data of any healthcare system. Yes. And by doing so, it's able to detect diseases much earlier. So of the $4 trillion of spend in the US, 90% of it is because chronic diseases go undiagnosed. And so they've shown and have great data to show that chronic kidney disease, for example, they can identify 3 times the number of patients. They can identify 20 times the number of asthma patients much earlier on. And this can really drive tremendous, you know, health spans and lifespans for patients. And that to us is really, really critical. So we'll go anywhere, but ultimately in the case of this company, the CEO is based in Philadelphia. So I took the short train ride over and sat down and you know, we did a deal. And that company, the founder, we think is a leading AI expert in the world.
All right, and 13 general partner, Latif Karacha, thank you so much. Coming up here on Bloomberg Technology, how one company is helping other businesses better adapt to the work from home model. My goodness, we have a debate coming up. We'll talk to Joep van der Voort, the CEO of Remote. That's next. This is Bloomberg Technology.
skincare for men in their 70s that have a lot of wrinkles. I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. We've been monitoring Instacart after its big IPO today. Now, that deal was priced at $30 a share, and we have seen an intraday pop. The stock at one point getting up to around 43 shortly after trading began just before 1 o'clock Eastern time. And as Bloomberg Matt had reported, there was plenty of demand. The IPO was said to be more than 23 times oversubscribed.
Yeah, absolutely. And I think it's really fascinating because we haven't seen very many IPOs this year, right? They're all down rounds as well. What we've seen so far is going for a much smaller valuation than it did during the pandemic. Let's talk about this right now with Brianne Lynch because she's in, I think, a unique position to talk to us about coming to market. She's the head of market insight at Equity Zen, which is a marketplace that gives individual investors access to pre-IPO equity. And Brianne, I was talking to a colleague of yours yesterday, Akshata Balkari, about the slowdown or the drop-off that we've seen in the IPO market. I wonder if it's not partially because of the success of platforms like yours that, I guess, lessen the pressure on executives from employees to generate some liquidity. On the other hand, you probably need IPOs to help boost the asset prices a little bit to get those animal spirits flowing.
Yeah, absolutely. I think the whole system has to work together for us to have a functioning secondary market. So while platforms like Equity Zen enable shareholders to sell their shares prior to an IPO and enable investors in turn to invest in these companies, there's really no broad, wide-scale access until there's an IPO or exit. So this is something that investors in the public markets have really been waiting for, along with shareholders in the private markets who have been eager for that wide-scale liquidity event. And with venture exits down 79% year over year, there's a lot more demand for more of this activity, and hopefully ARM and Instacart and some of these so far successful IPOs will spur more activity.
And Brianne, in the case of Instacart specifically, does the fact that you've got some somewhat similar business, I think about DoorDash already, the market's gotten its head around that business. Are there enough comparables that investors felt like they were armed and ready for this IPO by comparison to some other companies going public?
Yeah, I think the fact that Instacart has DoorDash as a public comp certainly helps when it comes to pricing and valuation, where you see Instacart trading now at about probably a $13 billion valuation or so. It's at a much higher multiple than where DoorDash is trading. But that being said, it's a different business. Advertising accounts for 29% of their business. It's something that Dash and these other companies don't have, and it's in some ways the driver of profitability for Instacart. So it's certainly different, but I would say having those public comps helps.
I feel like we've only had 3 IPOs this year. When I think about it, Kenvue, obviously ARM, and then Instacart, but there have been a few more. Still, what's wrong with 2023? Why is it so bad for coming to market?
Yeah, it's certainly been the quietest market for IPOs since 2009, and a lot of the macro uncertainty earlier this year had led companies to pause their plans. You had SVB's collapse, a lot of uncertainties around inflation, what rate hikes would look like, geopolitical risks, and while some of those risks are still in the market, there is more certainty. The VIX is trading at levels that it really hasn't been at since 2021. So for companies that have their ducks in a row, meaning they are profitable, they are growing at 30% plus, and have the key hires in place to successfully IPO, this market is probably a good time for them. But really, you do need to be checking all those boxes to enter the market now.
And Brianne, briefly before we let you go, now that we've had the ARM and Instacart offerings, I mean, it's still early days, but there was this theory that would potentially open the door to others going public. Do you feel like the market is strong enough for some other names, particularly in tech?
I think it will, and especially the fact that Instacart is entering the market, accepting a down round, and seeing where it trades from here. That will encourage other companies to do the same. It makes it a little bit less taboo. When you think about the public markets, things trade up and down constantly, and that's accepted. That's just not the case in the private markets. It's expected that you continue going up and to the right indefinitely until you exit. So I think this will be a little bit of encouragement for companies who may accept, okay, I have good fundamentals. I may raise at a down round if I raise capital last in 2021, but that's okay because public investors may be in this for the long run.
Brianne, thanks so much for joining us. Brianne Lynch, Head of Market Insight at EquityZen. As she said, it's a platform that allows people to trade pre-IPO shares. So I think a really fascinating story there. John, let's get back over to the Earthshot event at the Plaza Hotel just down the road. From here, Prince William is speaking right now, and I just want to tell I believe Prince William is speaking right now. He might be speaking right now. There he is. Fantastic haircut. You can check out more from Prince William and the Earthshot event on Live Go on the terminal. This is Bloomberg.
But it's been wonderful going back. It's been, I think 2014 was the last time I was here in New York. I've been trying to come back for a couple of years, but with COVID and my grandmother passing away last year has not meant it able to.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Tomorrow's Fed decision, we did get another reminder today of the challenges in central banks fighting inflation here in Canada. The inflation rate, for example, in August rose by more than expected for a second straight month. Some of that was higher gas prices, which may not faze the Bank of Canada, which recently held rates steady. But let's get some more perspective from Claire Fan, an economist with RBC. And Claire, it is interesting. The market today seems to be absorbing higher oil prices and maybe even the inflationary environment here in Canada as they gear up for that Fed decision on this idea of, do we need to be ready for higher inflation for longer and higher interest rates for longer? What's your take right now?
Yeah, so the inflation data for August this morning obviously was a step away from Bank of Canada's 2% inflation target that they're desperately trying to get to and maintain the inflation at these days. But, it's not really the one report this morning, more so than the fact that, core inflation, where some of the measures that the Bank of Canada uses or focuses on to get a better understanding of the underlying price pressure here in Canada. They've been stuck at 3.5% to 4% range since late last year, and that to me is more concerning than one report alone. Obviously, today, again, some of the core measures actually accelerated to closer to 4%. We're averaging around that versus, their so-called super core measures have been sort of, again, at 4.3% on the 3-month basis. So it really is that persistent inflation pressure that we're more worried about these days. And to your point, interest rates might have to go higher. That's still not our forecast. So overall, does it change our forecast for the bank to pause in October? No, it doesn't. But it does add more risk and uncertainty to that sort of scenario that the Bank of Canada would have to go again.
I guess the messaging is as important these days. We just had a speech by the Deputy Governor of the Bank of Canada saying that she is seeing evidence that higher rates is having an impact, but reiterating that policymakers are prepared to hike further if necessary. I mean, you wonder if you'll see similar messaging from Jay Powell and the Fed tomorrow.
Yeah, that's actually very interesting because to me personally, sort of the position of the Bank of Canada versus the Fed are very similar these days. So, inflation rate, not exactly super high these days, around 3 to 4%, and obviously not back to target. So what they do, obviously, is they allow these central banks to take a step back and look at a fuller picture of not inflation, but other data as well. So the other data in Canada and the United States include labor market data. So in Canada, again, we saw unemployment rate increasing by 0.5% earlier in the summer. And some of the other measures as well on consumer spending are starting to show that broader aggregate demand is losing steam. So in Canada, what we have is inflation starting to pick up, but broader macro backdrop is deteriorating. So put those two pieces together. That allows the Bank of Canada to just say, hold on, just let's take a pause here and wait for more weakening in macroeconomic data to come through. And let's see if that can ultimately slow inflation back to target as well. And that's a good segue into the Fed because it's a very similar decision-making process or thinking process. It's quite the opposite. Their inflation is looking really good. But at the same time, consumer spending is incredibly strong. We're seeing some very strong retail spending data into Q3. So they're wondering, are low inflation readings sustainable? And then that's also allowing them to sort of hit a pause at this point. So it's kind of interesting how the same decision-making process allowed them, despite very contrary circumstances, to be on sort of making the same decision at this point.
Don't ever underestimate the U.S. consumer's ability to spend beyond our means. Claire, thanks so much for joining us. RBC economist Claire Fan there talking about the BOC and, of course, their fight against inflation. The Fed will be talking about our fight against inflation here in the U.S., John, tomorrow. And I think a widely expected hawkish pause. The most important thing will be to look at the dots and the summary of economic projections.
Absolutely. As we watch that oil price now moving into the red on the day, but obviously elevated oil prices, one of the inflationary considerations right now, with the S&P down about 0.3% on the day overall. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Bonds getting sold, oil getting bought, and the hottest ticket in equity markets today is a grocery delivery company. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. about 2 hours ago. It's not too pretty. You're looking at the S&P 500 down by about 0.3%. Big tech down by about 0.3%, we'll call it as well. Of course, on light volume as we await the Fed's decision tomorrow of that two-day meeting, widely expected to hold. All the while, you see 10-year yields down by about 3 basis points. Again, though, we're still above 4.3%. Very elevated levels across the Treasury curve. And we have to talk about oil. Right now, crude oil, it's actually lower on the day, flipping into negative territory, currently off by about 0.2% remain. But we know that earlier today, we were looking at $94 a barrel on crude.
Yeah, absolutely here. But let's start off with another sign of life for new stock listings here. We're talking about the new kid on the block, Instacart, the second marquee IPO in the past week, as the market for new issues leaves behind, finally, what was the longest drought since 2009. Now, the IPO specifically for the grocery delivery business was more than 23 times oversubscribed, with the top 10 clients taking about 65% of the shares offered. That was at $30 a piece. The stock just opened within the last hour, now trading right around $37, $38. That puts about $660 million into Instacart's pocket and gives a diluted valuation for the company of more than $10 billion. Now, while that's a fraction of the $39 billion valuation just a couple of years ago, it still ranks, of course, as one of the biggest companies to go public this year. I think some investors will take it. Meanwhile, crude oil continues to have its moment, as Katie was just saying, a 15th day of gains in the past 20 sessions for NYMEX crude, 15 days of gains that have pushed WTI futures from less than $80 a barrel to as much as 94 in just 4 weeks' time. Erin Brown, the portfolio manager for multi-asset strategies over at PIMCO, she says higher oil prices could drive the S&P down by as much as 15%, saying that while FOMC policymakers are so focused on core inflation, costlier oil will actually boost durable goods prices, and that will feed in to hurting the economy, making it difficult for the Fed to meet market expectations of 3 rate cuts next year. It's an interesting setup, of course, for the FOMC, which today began its two-day policy meeting at 10:30 a.m. Washington time, just as scheduled. One of at least 11 major central banks that are set to announce policy decisions over the next 36-hour stretch, Katie. Policy decisions, as some investors say, likely represents the last gasp of this rate tightening cycle.
And if you take a look at what's priced into the market right now, that's broadly what's expected. for the Fed. Right now, you have the Fed funds upper bound at about 5.5%. You look at what's priced in terms of the terminal rate for this tightening cycle, markets expecting about 5.6%. So maybe they go again, but really the finish line is in sight if you take a look at what bond traders are pricing. And of course, what we hear from the Fed tomorrow, from Fed Chair Jerome Powell, has many implications across the curve, not just for the front end, but also for the long end. And if you take a look at yields right now in the Treasury space, we're looking at year-to-date highs really across the curve, even on the long end. And you think about this sell-off, really it's been going on for 4 months. And given the levels that we're at right now, Romaine, a lot of investors are saying it's time to lock in those rates. It's time to extend duration. But again, a lot of that hinges on what we hear from the Fed tomorrow.
Of course, that will be the big story of the day tomorrow. Ron Temple is here today, Lazard's chief market strategist, joining us right now to help kick us off to the close. And Ron, always great to see you here. And of course, on the eve of a big Fed decision, a Fed decision that most people say is going to be no decision, basically no change. But what do you think they could telegraph to the markets about whether this tightening cycle might actually be over?
Well, I think we're on the cusp of a monetary policy inflection. This is a really important week between the Fed, the BOE, the BOJ, and I think about 9 other central banks this week in emerging markets and developed markets. So we've got a lot coming down the pike. But what I'm really looking forward to from the Fed is probably that they're not going to make any promises. They're going to praise themselves subtly in terms of having had great success at getting inflation down without causing recession. But they're also going to talk about being vigilant. And it's going to be very important to basically remind the markets that they're the cop on the beat and they're basically willing to raise rates if they have to, particularly given what we've been seeing lately in the energy complex in terms of oil prices being up 33% in the last 2.5 months.
Well, let's talk a little bit more about that, because that does seem to be kind of the wrinkle in the ointment here. I mean, of course, we know the Fed backs that out because they basically make it explicit they really have no control, no direct control over those prices. But that's going to be a major issue for consumers should prices stay elevated at these levels.
I agree. It's nice that economists always say X food and energy, but the last time I checked, we all use it. And so it's really important to consumers. It's important to wage demands from consumers. And ultimately, even if you look at inflation X food and energy do filter back into all the other inflation. And my favorite, usually I use an example. If you're getting your haircut, there are no commodities involved, but they do pay for utilities, right? They do pay workers who consume these, so it's really important. And I also think on a structural basis, there is a case to be made that energy prices will continue to go up for years to come, partly due to the energy transition and just the cost we're going to have to make to get away from fossil fuels. And frankly, climate volatility and climate change are likely to make food inflation a bit higher. So it's going to be hard for the Fed and other central banks to ignore these factors.
And of course, some of those non-core items, they do factor into inflation expectations. To your point, we all use food, we all use energy. And when you think about how that's being expressed in the market, when you take a look at break-even rates, especially on the front end, should they be higher right now?
I do think they should be. I mean, the markets basically have been for quite a while basically assuming that once we get through the next 12 months, it's back to low, stable inflation. And the way I look at that, by the way, is just look at the 5-year Treasury and look at the 5-year inflation index. And if you back out the next 12 months of inflation expectations, you're basically down to 2%. And so I think there's a little too much complacency there about structural inflation pressures. And those are pressures in many ways that central banks can't do anything about. Again, it's that energy transition. And it's also just the changing nature of global supply chains. And frankly, the rising cost of operating in China. A lot of people think about moving out of China, but honestly, workers in China have been getting double-digit wage gains for the last 20 to 30 years. It's just not as cheap as it used to be to operate in China.
And Ron, keeping that global perspective, you mentioned there's something like 1 million central bank meetings this week. If we boil it down to just 3, we have the Fed, we have the Bank of England, we have the Bank of Japan. Which bank has the potential to surprise markets the most here?
That's a really tough question. I think the Fed, basically the market is priced that nothing's happening, and the Fed historically does not disappoint the market positively or negatively. So I think that's unlikely. The BOE, the market is expecting the Bank of England to hike. Interestingly, in the last month or two, the expectations for the terminal rate or the peak rate in the UK has gone from 6.25%, 6.5% down to 5.25%, 5.5%. So there's been a big shift downward in terms of being less hawkish. I think there's room for surprise there in terms of the BOE and what they might say about expectations. I would have said the Bank of Japan.
Yeah.
But on the 9th, I mean, basically, Governor of Bank of Japan, Ueda-san, had an interview where he talked about maybe by the end of the year we'll have the data we need to decide if we should think about going out of negative rates. That was the big surprise. So I think he kind of was front-running himself in terms of the media headlines. So that's a long way to say, I'm not sure, but maybe the Bank of Japan, if we get a reiteration from Ueda, that the Bank of Japan thinks that they've won the battle against deflation, I think that would be a pretty significant surprise.
Yeah, that would be a huge structural shift, I think, at least for that part of the world, and I guess foreign investors invested there. I am curious here, Ron, about kind of how investors should sort of interpret where we are in this rate hiking cycle. If you do believe that they are done, then you must believe that market rates are either at or near their peak. So what does that mean in terms of the next decision that you make about what to buy or sell?
Yeah, I mean, honestly, this is the first time since the rate hike cycle began that I think the market is finally pricing things appropriately, meaning we've been too dovish for too long. When the market would finally get the peak rate, the terminal rate right, it would assume that the Fed would immediately turn on a dime and start cutting rates. And so if you look back, it was only a couple of months ago, 2-3 months ago, the market was saying Fed funds would be back at 4% by March of next year. Now it's saying we're basically not going to see a cut until the second half. So when I look at the markets, I think number one is if you're thinking about allocations to fixed income, it's looking pretty attractive. I think extending duration, locking in some of these higher rates might make good sense right now. I do worry that the equity market still doesn't seem to be pricing this in fully. And again, I have to be careful there because the equity market includes very different situations. The equally weighted S&P is at 15.2 times earnings. The S&P is at 19.2. So this to me is an argument where if you've been passive and you've really enjoyed this ride up in equities, maybe now is a good time to rethink that and allocate to some of the parts of the market that have not worked.
All right, Ron, always a great conversation here. Ron Temple over at Lazard helping us to kick you off to the close here. And of course, we are about 24 hours away from the Fed decision, full coverage starting tomorrow. Meanwhile, here today, a conversation coming up with Oksana Beshloff over at Rock Creek. She's actually here in New York over at the Plaza Hotel where the Earthshot Prize is being announced, the annual award for companies looking to tackle the world's environmental crisis. We'll check in with her in just a second.
Plus, we'll talk to the CEO of Edison International about the growing demand for electricity as the nation switches to EVs and other clean energy initiatives.
And we're going to hear from an exclusive interview with Sir Tony Blair, the former UK Prime Minister, and his insights on what can be done to bridge divisions among the members of the United Nations General Assembly. That conversation and so much more coming up in just a bit. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Treasury Secretary Janet Yellen is speaking out on U.S. climate initiatives. In an interview that she had with Bloomberg Green, she said, "We're working as fast as we can to move this agenda forward. You'll remember for the previous 4 years, the U.S. was nowhere, was actively opposing climate. we've turned the ship 180 degrees around. Those are the comments that she made to Bloomberg Green here on the eve of what is today the announcement here of the Bloomberg's Earthshot Prize Innovation Summit in New York. Is down at the Plaza Hotel in Midtown Manhattan. I'm pleased to say that Afsani Beshwas, the CEO over at Rock Creek, is joining us right now. She also sits on the board of the Rockefeller Foundation, and of course she has been very instrumental and out front here and looking for better ways to create sustainable investment. Afsani, talk to us a little bit here about what's going on right now at this event and the amount of money that is being committed to fighting climate change.
There is probably more enthusiasm you can see today as compared to, I would say, previous years. What we're seeing is a lot getting committed. I think what Secretary Len just talked about and we'll be talking about hopefully more is being the commitment to actual investment because those have been going a little bit more slowly. There's the two sets of funds. One is public sector funds and money going into emerging markets, particularly those more affected by droughts and famine and other natural disasters, but also and caused by climate change, but also private sector money going in. And what I should tell you is that the private sector stuff is moving faster than the public side.
Explain to us why it's moving faster. Is that because there is greater opportunity for profitability, or is it simply, I guess, a signal of maybe greater sense of responsibility?
I think probably both, but no question that now you get returns that are very significant in clean energy, in water projects, in areas that are broadly related to climate. And as you well know, solar energy is now very, very accessible and economic. And as particularly you go into other areas outside of California, for example, there is huge potential. Similarly, huge potential on the aviation side. We've been investing quite a bit on alternative fuels for aviation, on looking at technologies for de-icing planes, really across the board. And all of these are very economic and high return projects. So you see the private sector coming in, and of course the IRA certainly helps. But I think it's the economics that has changed dramatically in the last 10 years.
Do you think that the private sector alone can fund this energy transition, or does the public sector need to catch up here?
Ideally, you want both, because public sector can set the policies, public sector can de-risk certain kinds of projects that you need. But at the end of the day, the scale of private sector assets that wants to go in this area is much, much higher today. And they're doing it for two reasons. One is they want to not invest in risky projects. If you're investing in old-fashioned traditional energy, that might be high risk in future. But you also want to invest in high return projects. And right now, the biggest momentum you have got is in the energy transformation that we're going through globally.
And what's the biggest gridlock, the biggest holdup, if you will, when it comes to that transition?
I think, if you talk to industry, permitting is still slow, whether it is in the US, whether it's in Europe, where you need to move out of coal power plants, let's say, into cleaner energy. Permitting is still moving much slower than you would like it to go. The other areas, I think, in terms of policies, like it took a while, quite a long time, for example, after the IRA money was actually available until the rules were clearer about how they could get applied. So if you could get the public side to clarify and define standards and define how this money will get used faster, I think that will be a huge impetus.
When you look at the money coming out of this particular competition, as well as money, say, coming out of that $1 billion initiative from the Rockefeller Foundation and other efforts to sort of foster sustainable investment, is most of that money going to emerging market projects, or are they also going to developed markets?
I think if you look at the Rockefeller Foundation and other nonprofits, obviously, that work on emerging markets, a lot is going into India, into Africa, into other low-income countries. Similarly, money is going from World Bank and other multilateral into the US and some into Europe and Asia. And let's not forget, China is producing, in terms of the growth of CO2 emission, the largest amount of CO2 emission growth is supposed to come from China, and in future probably from India, maybe a distant second, and other parts of Asia in particular. So we need to really, really make sure that as we're making all these efforts we're talking about today, there's not additional CO2 emissions going into and creating the sort of essentially undoing the good that we're all doing.
Afsaneh, it's great to speak with you. Really appreciate your time. That is Afsaneh Beshlah. She is the CEO of Rock Creek. Now, coming up on the close, get ready for a slowdown. The latest report from the OECD says that rate hikes going to weigh on global growth. We'll have the details next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Will the Fed hold rates steady as expected?
The Fed trying to back into the shrubs and disappear.
They're as data dependent as we've ever seen.
And will they keep one more hike in the dot plot?
The services prices are going to be a concern.
There is this risk. Maybe inflation starts to pick up again.
Trust Bloomberg for the fastest coverage and exclusive analysis.
We could see more headwinds.
They may actually tip the economy into recession before they start cutting rates.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. Context changes everything.
As the world's movers and shakers gather in New York for UN Week, the global economy appears set for a slowdown. That's according to the latest forecast out of the OECD. Interest rate increases and China's disappointing pandemic rebound means GDP growth worldwide will slow to 3% next year and 2.7% in the year after. Bloomberg Economics Chief U.S. economist Anna Wong joining us right now to talk a little bit more about this. I mean, 2.7% growth a year or so out still seems pretty healthy, but well below where we've been over the last few years, Anna.
Yeah, that's right. I mean, for global growth to be negative is actually extremely hard because you have, China, which is the second largest economy, and even if there is a significant slowdown in China, China's GDP growth is still in positive territory. So I think that number you just posted there does tell you that so it's not the level of growth rate that matters. It's the momentum, and it is definitely going down because of lags of all the rate hikes around central banks in the world.
It's interesting when you go by region and country by country, as you see on the screen there. The biggest changes, of course, to the downside were the revision for China and the revision for the euro area.
Yeah, that's right. I think the surprise this year was that how weak euro area and China had been. So coming into the year, everybody thought that maybe Europe will go into recession early in the year during the winter, but they were resilient, and everybody thought they were out of the the bad phase. But it turned out that later in the year, the rate hikes from ECB finally caught on to the European economy, along with China's slowdown, which tends to affect Germany disproportionately because Germany is very much exposed to the global manufacturing cycle. So the war between Russia and Ukraine didn't do Germany in, but the rate hikes and also China's slowdown did do them in.
And when you look at the situation in Europe, how big of a risk is a stagflationary type environment right now?
Yeah, I think that I would call it a stagflation-light risk because we are not back to the 1970s world where oil price tripled. We're talking about just 20% increase in oil price. And also, in the past year, both Europe and U.S. has accelerated the transition to green energy. So I would say that the resilience, do not underestimate the resilience of economy to energy prices. But I will say that growth definitely will slow down a bit from higher energy prices, but not in the sense of the 1970s kind of situation.
And so, Anna, clearly we've seen rate hikes catch up with the European economy. When you look at China, though, how much of that can you tie back to monetary policy, or is this just a case of demand not coming back as maybe the rest of the world thought it would?
It would be the latter, Katie. So I think China's problem is more of a scarring from post-COVID, especially with the slump in real estate. And China's growth in the past 20 years has very much been intimately tied to its real estate market. Every time the real estate market goes down, you start having capital flight issues from China. And by some economists' estimate, given the intersectoral linkages between the sectors in China, the real estate sector could contribute as much as 40% of GDP growth in China. So for China, it is definitely more of a scarring from the years of COVID closures.
All right, Anna Wong, our chief U.S. economist over at Bloomberg Economics, down in our Washington bureau. A look at the global economy here in the revision downward in the OECD estimates, Katie Greifeld. And it was interesting here. We had one of the main economists over at the OECD. They were on with Bloomberg Surveillance a little bit earlier. Also, they're talking about the slowdown in growth, but they're also saying that these central banks need to stay the course. They're actually saying that we could actually need more rate hikes in order to tame inflation.
It's that delicate dance, right? Trying to bring in inflation while not totally killing growth. It seems like a lot of people are optimistic that the Fed maybe is out of the woods there. Maybe that mystical soft landing is achievable. But you think about the rest of the world, particularly Europe, it's a much more narrow path.
Yeah, meanwhile, here on the eve of that big Fed decision, we have a market well off the lows of the day, but still pretty much red across the board. One bright spot in the insurance sector, and we should talk about yields right now. Katie Greifeld, yields across the board right now near session highs. 509 on the rate-sensitive 2-year yield. Romaine Bostick alongside Katie Greifeld. This is The Close on Bloomberg.
Greece. When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is the countdown to the close, almost 2:30 here in New York. An eye on the broader markets, which remain in a bit of stasis ahead of a big Fed decision tomorrow, but a lot of volatility going on in the commodity space. Abigail Doolittle is standing by right now with our commodities close.
There really are some outsized moves here, Romaine. Take a look at natural gas, both here in the U.S. and European, and it seems to have to do, at least for European, the fact that Norway's Troll field is set to halt production on Wednesday, so that could add to fears around tight supply. We, of course, still have that strike, I believe, happening in Australia. LNG supply, possibly 5 to 10% of the world's LNG supply off of the market. As for wheat, down 1.3%. So it's interesting because the first grain ship since July has left the Ukrainian Black Sea port, defying the Russia trying to say that Ukraine cannot ship wheat out on that increased supply. We have wheat down 1.3%. Dr. Copper down 0.7%. So a little bit of a risk-off tone here. That's really accumulated by oil. We have oil fluctuating on the day, small gains and losses after having been higher earlier. What's so interesting here, Romaine, is if we go back in 2021, if you recall that big spike above $100 per barrel, we then had a bit of a collapse, just too far, too fast. It almost appears as though we might be setting up for something similar. This doesn't mean we couldn't still go up to 100 and then come back down, but it seems as though this rise might, in fact, at some point relatively soon, prove somewhat unsustainable.
Yeah, and for anyone interested in those technical levels, definitely put that into the Bloomberg terminal, and you'll see just how wild this day has been. Meanwhile, we turn back to the push to move away from fossil fuels and to cleaner forms of energy. There's a new report out from Edison International that looks at the growing demand for clean energy and how it could put unprecedented demand on electric grids. By 2045, in the state of California, electricity demand is expected to jump by 80% or more as 90% of vehicles and 95% of buildings become electrified. Joining us right now is the president and CEO of Edison International, Pedro Pizarro, here in our studio here in New York. Great to have you here, Pedro.
Thanks for having me.
You are going to be a busy man if you haven't already been here, because with all the talk about how we should all be maybe potentially moving to alternative fuel vehicles and other sort of forms of clean energy, there's a big discussion that has to be had as to whether the infrastructure is there to support all that. You run, obviously, a big electrical grid here. Have you actually seen an increase in, I guess, pressure on your electrical grid as a direct result of the adoption of EVs and other forms of renewable energy?
Absolutely, and it's moving faster than we expected. So a few years ago, we thought that load might stay flat through 2030. Now we see that it's growing at least 2% a year. Here's the good news, though. As you look across the entire industry, my colleagues and I in investor-owned utilities invested around $150 billion last year. 30 billion of that was for transmission. As we look at a report countdown to 2045, we see the need to continue that investment to address that 80% or more increase in load. What's important about that, there's a couple of things. One, it is a big lift for the state of California, world's 5th largest economy. We see needing to invest around $370 billion between now and 2045 across the power sector in California to make all that happen. But there's a good punchline to that. Because electric technologies are much more efficient than fossil fuel technologies, our average customer may see their electric bill go up and their usage go up, but their total energy bill, gasoline plus gas plus electricity, be 40% lower by 2045. So it's a co-benefit to this transition.
I'm just curious, though, and forgive me if this is a dumb question, but when we talk about sort of building up the grid, does that mean you have to build new power facilities, or do you just take the existing ones and make them more efficient? What does that mean?
It's all of the above.
Yeah.
And we see needing about 3 times the clean energy resources on the grid in 2045 that we have today, going from around 40 gigawatts to around 120 gigawatts. So it's adding renewables resources. It's adding storage to balance that out. It's adding grid, right, to move it all around. If you look at the historical rates of transmission additions, we think that we will need to have 4 times that rate as we move towards 2045. If you look at the additions for the local grid, the distribution grid, 10 times what we've had historically. So it's a massive investment that's needed. But again, that's to achieve what we think is the most reliable and affordable way to get the state's economy to net zero. And the lessons from California are ones that apply nationally and globally.
Well, when you think about the loftiness of these goals and some of the massive investments that are needed, $370 billion is quite a big number. Do you think net zero in California by 2045 is a realistic goal?
It is a realistic goal. But one of our messages in the paper is that we do need to preserve optionality. So right now the state has a net zero goal. It has a number of other point solution goals too. And so one of our messages is, let's retain some flexibility. Let's continue to evaluate this. Because the reality is, sitting here in 2023, we don't know with certainty how each technology will mature. We know we'll need all of the above. We'll need renewables. We'll need small modular reactors. We'll need geothermal. We'll need offshore wind. The pace of development will be different across technologies, so we want to make sure that we preserve the optionality to check and adjust and follow the market. Carbon capture will be another big part of the equation, so we want to make sure the state can access all of these technologies as they mature.
And before we get to 2045, let's just talk about the here and now in the past couple months, because extreme weather has become very common when you think about extreme heat, of course, hurricanes and the like, and fire season.
Right.
How worried are you about the next couple months, next couple years?
Well, I'll give you 2 answers to that. One is climate change will continue to manifest itself in extreme weather. We had a paper a couple of years ago, Adapting for Tomorrow, that talked about what's coming. 20% more fire risk, around 3-foot sea level rise, more droughts, more floods. But here's the key thing. Our industry, and certainly our company, we are investing to harden the grid, and I think the whole economy will need to do the same. So the wildfire example, just in the last 6 years, the investments we've made in things like replacing bare wire with insulated wire and adding new technologies has decreased the probability of our equipment starting a catastrophic fire by 85% compared to pre-2018. So our industry is continuing to use new technologies, make investments that make our community safer.
Pedro, really enjoyed this conversation on what is a very busy week for you. Hope to check in before 2045. That is Pedro Pizarro, Edison International CEO.
Me too, Katie. I'm still around.
We'll pencil it in. Still ahead, though, on the close today, the turnaround that investors of VF Corp were hoping for is taking a little longer than expected. It's part of the reason why Piper Sandler downgraded the stock. We're going to talk to the analysts behind that call next. This is Bloomberg.
move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
On the next episode of Hello World, meet the women driving Kyrgyzstan's tech revolution.
This is the first satellite in our country.
And some speedy horses. Watch Hello World Thursdays at 8 p.m. Eastern on Bloomberg Originals or 10 p.m. Eastern on Bloomberg TV.
Time now for our top calls, the big movers on the back of analyst recommendations, and we start off in the cruise ship space. Truist adjusting its view on the sector, and that led to an upgrade to buy for Royal Caribbean. The analyst saying trends point to upside for bookings and pricing and earnings expectations for some of these cruise line operators. They're actually a bit too conservative in the eyes of that analyst, especially for Royal Caribbean. Those shares having their best day in about a month. Next up, let's take a look at Deere, the farm equipment maker, getting cut today to inline over at Evercore ISI. The analyst actually saying that there's not a whole lot of visibility in this sector and saying there's a lot of revenue risk for the agricultural sector, including Deere and CNH. Deere shares down about 3% on the day. And finally, let's take a look at Starbucks, a downgrade for the coffee chain over at TD Cowen to market perform. The analysts over there chalking it up to macro pressures here and comp sales issues over in China amid increasing competition from cheaper stores. Starbucks shares down 2%, having its worst day in about a month, and those are some of our top calls. We do want to stay in the area of consumer spending and look at some of the changes there, particularly when it comes to clothing and apparel and inventory levels, where the crux behind a recent change in ratings over at Piper Sandler and their view on footwear companies, VF Corp and Skechers. Pleased to say that analyst over at Piper Sandler is joining us right now. Abby Zavanek actually downgraded VF Corp to neutral and upgraded Skechers to overweight. Abby, let's start off with VF Corp here and give us a sense here as to why you're seeing some material softness there.
Yeah, so I think our previous overweight thesis was based on a Vans brand turnaround. The brand got over inventoried, relied too heavily on core classics, and we are starting to see some traction from new styles, new product that they're putting out. But I think that the current state of the wholesale footwear environment in the U.S. is going to make it challenging. The timeline of that Vans brand turnaround, we have less certainty around, and that was really the reason for our downgrade. There's still too much inventory in the channel. Open to buys are extremely tight for wholesale retailers, and I I think, when open to buys start to open back up, they're going to favor brands that are seeing strong sell-through in the channel right now. And unfortunately, Vans is not one of them.
Well, okay. Well, let's talk about Skechers then. Is that just like the hipper thing right now? Is that what kids are buying?
I don't think it's necessarily that kids are buying, but they're seeing strong direct-to-consumer trends, which indicates strong underlying demand. They've had a lot of new product. I don't know if you've seen their new slip-ins product, but it's a technology that you can slide your foot in really easily, and you can use that in an array of silhouettes. And so that's seeing really strong traction with consumers and strong sell-through in that wholesale channel. So we think that restocking will occur as those open buys open back up. And there's also Skechers business is 60% international, and we're seeing really strong growth there with some tailwinds in China for that recovery as well.
And given that, so much of the growth is coming from overseas, we spend a lot of time talking on this program about potential cracks in China. Of course, the rebound over there hasn't been as strong as maybe some had predicted earlier in the year. When you think about China in particular, how much of a risk is that potentially?
Yeah, so Skechers' expectations have been really tempered when it comes to China, and I think the CFO John Vandemore has been very clear that they're not expecting a linear recovery in China, and so I think that successfully have baked into guidance a conservative view on recovery in that market, which will be a benefit in the future. Although they are seeing better than expected trends in that market, and so I think coming away from a conference that we just had, our Growth Frontiers conference where the CFO spoke, I actually felt more optimistic on growth in China in the near term.
And Abby, I just want to go back to VF Corp and your downgrade there. Of course, the Vans turnaround maybe not going as rosily as expected, but when you think about the rest of VF Corp's portfolio, what else under their umbrella could maybe temper what we're seeing out of Vans?
Yeah, that's a good point. The North Face brand has continued to produce strong growth. It grew 17% constant currency in their last fiscal year. And so, I think that they've successfully capitalized on secular tailwinds in outdoor and active, and have introduced a lot of great new products, which, is the thesis that they can use the same playbook now with Vans and in this turnaround. There's some other smaller brands that are doing well, including the Ultra brand, which, is a running shoe brand. We're still seeing a little bit of weakness in Timberland and Dickies, but, upside could come from that North Face brand, in my view.
All right, Abby, great to catch up with you here. Great insights. Abby Zavainix over at Piper Sandler. An interesting upgrade and downgrade, a pair's trade, if you will, Katie Greifeld on VF Corp and Skechers.
There you go. Skechers is cool.
Sir Tony Blair, you know him. He's a former UK Prime Minister. He actually had a chance to sit down with David Weston to discuss why the AI revolution should be a top issue for politicians. We're going to tell you what he had to say after the break. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
time now for Wall Street Week Daily with the host of Wall Street Week, David Weston. And David, I heard that you had a chance to sit down with the former Prime Minister of the UK, Tony Blair. Yeah. He's got a lot going on these days in his post-Prime Minister life.
No question about it. And he's in New York, of course, for the UN. And we did talk about AI, as you suggest, Romaine. But before that, we started with some of the world conflicts. This is Tony Blair, former UK Prime Minister and founder of the Institute for Global Change.
You've got a very divided world today, and a lot of the institutions have grown up on the basis that everyone can come together essentially around an American-centric view of the world. And Russia, you have China, you have countries that don't want to be aligned either with America or with China, but want to keep in with both. So you've got a completely different world that's evolving, and the institutions were all created for a different time. So even the UN Security Council, when you think about it, I mean, it's completely irrational that you don't have Germany or Japan or India, Brazil, Indonesia, large countries that aren't represented in the permanent structures of the UN. The difficulty is, how do you change those institutions when you require everyone's consent to do it? So I think you're going for the foreseeable future. There will be issues around which people come together, global pandemics, potentially climate change, maybe stabilizing the global economy. There's areas, of course, where America and China are going to have to work together. But the world is multipolar and polarized around essentially, I think, two blocks that are emerging. One of countries that are close allies of America, the other which are allies of China.
One of the areas where there is continued tension is something you know terribly well, which is the Middle East. You spent a lot of time over there, I know, particularly on the Palestinian issue. Now we hear that there may be the makings of a deal with Saudi Arabia, the United States, and Israel. What do you know about that? What are the prospects for it? I think you still advise the Saudi government, do you not?
Yeah, we've a close relationship with many of the countries in the region. We have a team of people work on the modernization program there in Saudi. I have an office in Israel and also in the United Arab Emirates. Well, the whole of the Middle East is undergoing a huge change. And I think the essence of the struggle in the Middle East really revolves around the desire of people there across the cultural spectrum, right? Whether you're in the Jewish state of Israel or in predominantly Muslim countries, the desire of people to move towards what I call rule-based economies and religiously tolerant societies. And when you look at the modernization program, for example, that's going on in Saudi or in the United Arab Emirates or elsewhere in the Gulf and Qatar, Bahrain, and so on, you can see that it's illogical for those countries to be hostile to Israel.
Let's turn to British politics, if we could, a bit. You've had something to do that in the past. According to the polls, if they're to be believed, the Labour Party, your Labour Party, seems like it's in reasonable good shape for the next election. We never know till the election happens, but in reasonably good shape. You were famous for New Labour, as we came to understand it in Britain. Is there room for a new Labour? Is there a different version of what the Labour Party did back in your day?
Yes, I think there is, and it's all around the technology revolution. I mean, in my view, the single toughest thing for politicians today is to get their heads around what is the big real-world event. I mean, leave all those things aside, all the things we're talking about in geopolitics, America, China, and so on. The big real-world event is this technology revolution. And particularly with generative AI, it's going to change everything. It's going to change the way we live, the way we work. It should change government, by the way government operates, the way public services operate. It's got enormous potential to change the healthcare system for the better. But then there are huge risks, because it's a general purpose technology. You can use it for bad as well as for good. So this is the biggest challenge. And I say to people on the progressive side of politics, the progressive mission for the 21st century is how you understand this revolution, master it, and harness it. And that's because interesting, when you look at the 19th century Industrial Revolution, it took politics a long time to catch up with the real world event that was happening. And if we're not careful, it'll be the same today, because the policymakers and the change makers often inhabit different spaces. We need to bring them together. We need to see what the opportunities are, see what the risks are. But this is, for me, if I was back in government today, I would be reshaping the whole of the government agenda around it.
Great Britain had a little something to do, as I recall, with the Industrial Revolution. But you were bestride an empire at that point. That empire no longer exists. Is Great Britain large enough to really help drive the generative AI revolution?
Well, it can be part of it. And it's already one of the leading countries on AI. We've got a strong university sector. We've got a great life science sector. We have one of the greatest AI companies in the world, DeepMind, in the UK. The UK technology sector is thriving. We need to keep this and we need to develop it. But no, Britain, if I had to characterize the economic niche for Britain going forward, one major part of it would be around being an AI hub for innovation and development.
What about the future for Brexit and what happens with the UK? Sir Keir Starmer has said that he'd like to kind of revisit that a little bit. You've been very outspoken about your views on Brexit in the past. How far can the UK go? How far should it go to try to reintegrate with Europe?
So it's hard to judge, because we got out of Europe. It was our major trading relationship. We ruptured our trading relations with Europe, but we also now are out of the political union of our own continent. And in a world where it's going to be dominated by America, by China, possibly in time India, those will be the three giants of world politics. You're going to find around the world people coming together in regional blocks in order to be able to sit at the same table as the giants. Right? You can see this happening all over the world. So for Britain to be absent from Europe is a real problem for us. However, having left it, getting back in is a tricky negotiation. There's an economic aspect. I think there are certain things that can move us closer with Europe without going back into the European bloc. But then I think there's a question of the political dimension to this. And there is a suggestion that we build a broader European political community. President Macron's talked about this. And Britain, I think, can play a part there. And in areas like defense or energy or science and innovation, we can build those blocks of cooperation with Europe that move us closer. Whether we get to a stage where Britain rejoins the European Union, I think that's for a future time. But you should never forget that 2/3 of the population over 65 voted for Brexit and 2/3 under 35 voted to stay.
That was Sir Tony Blair. He is the former British Prime Minister. And then on Friday, Romaine, you'll forgive the pun, we're going to shift gears back to automobiles. We'll welcome back Steve Ratner. He's Willard Advisors Chairman, who, of course, was the car czar. He said there's going to be a strike. There is one. Now we'll ask him how we're going to get out of it. That's on Wall Street at 6 p.m. Eastern time on Friday.
Yeah, I just want to know when the strike's going to end.
Yeah, that's what we all want to know.
Of course, I'll be sure to tune in to David Weston on Wall Street Week on Friday evenings, and he appears every day around this time right here on The Close as we round into the final hour of trading here on this FOMC Eve, if you will. A market still in relative stasis, well off the lows of the day, but not really going anywhere till they get maybe some potential clarity out of the Fed at 2 p.m. Washington time tomorrow. Full market coverage tomorrow with the team Bloomberg Surveillance and your team right here on The Close. A lot more coverage coming up right here on this Tuesday. Stick with us. This is Bloomberg.
Jonathan Farrow and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Almost 3 p.m. here in New York. This is the countdown to the close. Romaine Bostick here in Studio 2 at Bloomberg headquarters in New York.
Katie Greifeld as well, counting down to the Fed decision. This is pretty exciting.
Are you really excited by this? Because I'm told they're not going to do anything.
Apparently, but it's all about what Jerome Powell says, what the messaging is, what those dots show. I don't know.
Do you think he's going to be more forthcoming this time around?
You never
as opposed
know.
to the other times?
One of these meetings, he's going to surprise us.
Yeah, one of these meetings, he is going to surprise us. Look, we are supposed to get those economic projections, the SCP, and that could actually be a big market mover.
Oh, big time, especially when you think about the debate over 2024 right now. Will they cut rates to normalize, or are they going to have to hold higher for longer to really make sure we have inflation lift?
Well, the view from the top, well, not a whole lot to look at here with the NASDAQ 100 down about 0.4%. Now, the good news is we're well off the lows of the day, but right now testing some key technical levels. And I thought this was interesting. I came onto the show today. We're all prepared to talk about this massive rise in crude oil. And Abigail Doolittle set us straight during the commodities close about 30 minutes ago. Interesting reversal here. And she says when you look at technical levels, seem to suggest that we could actually start to move down on crude prices.
You know, it's a real bummer when the narrative flips in the hours leading up to the show. But, I mean, we'll see if this is a sustainable leg lower, whether, you know, maybe we hit some key levels and market participants are rethinking how far we've gone. But, I mean, if you think about where we were, it's been quite a rally.
Yeah, let's flip up the board real quick here, because I was taking a look here at the term premium. Of course, this is basically just what you get paid to take out duration risk, more or less here. The longer out you go, of course, in general, you want to get paid a little bit more. That has not necessarily been the case on a yield basis. You're actually still in the hole on a negative basis, but you are now starting to see that term premium get back to that waterline here. And it'll be interesting. There was an interesting note out by the folks over at Mizuho kind of talk about this idea here that there is a little bit more conviction here that that trend will continue.
And we'll see how that develops. Of course, that negative term premium has been bedeviling bond investors. But let's get to some of the single stock movers. I want to talk about Amazon really quickly. They plan to hire 250,000 logistics workers heading into the holidays. That's higher than previous years. Maybe that's why you see the stock down 2%. That has implications for broader markets as well. Let's also talk about Ford, of course, the United Auto Workers Union saying that more of its members will go on strike on Friday unless we see substantial headway. And it's interesting. You actually have Ford shares higher a little bit today.
Yeah, the automakers have actually held up pretty well, at least so far. Investors aren't too phased.
Yeah, we'll see if that changes between now and Friday. Let's also talk about Instacart. Of course, one of the big stories, it's the fourth biggest IPO of the year in the U.S. Shares up 22% in their debut. The valuation, I believe it's around $12.5 billion on a fully diluted basis. That's a pretty steep plunge from that $39 billion valuation in that funding round in 2021, but still, shares really rising today.
Yeah, still some optimism here that at least a major company can come to market. 2 major companies just in the past week alone, so maybe that signals that investor appetite is shifting and maybe market conditions as well. Right here on this Tuesday afternoon, we are about 1 hour away from that closing bell. Our cross-platform coverage, counting it down to the close, starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostic alongside Katie Greifeld. We're joined right now by our colleagues in the radio booth, Carol Masser and Tim Stenovic. Welcome to our audiences across.
It's just me.
Wait, what's happening?
I've got good news and bad news.
It's just Tim Stenovic.
Okay. The good news is I'm here.
Okay.
Okay. The bad news is Carol's not here.
Okay.
But she's coming here soon.
Okay, well, I know Carol, the pride of New Jersey, by the way. Did she get held up by transit issues? Because I've been reading all about New Jersey transit is just a mess, and anyone trying to get into work, was that the issue?
Fortunately, she walked. I told her to walk because New Jersey Transit has been having issues.
The reason you know there's a river separating us. So.
She walks on water.
There's a bridge you can get across.
Okay.
Yeah, you can do that.
I've heard about that.
So
a tunnel too. That I don't think you're supposed to walk.
You cannot walk in the tunnel.
Yeah.
No. You bring up a good point, Romaine, because anyone who's ridden New Jersey Transit has also probably complained about New Jersey Transit. We're getting some new stats about the on-time performance rate of New Jersey Transit. It's not just you. It has been below its goal of 94.7%. It's fell to a low of 88.9%. That was back in July. The reason we're talking about this is because companies are calling workers back to the office, Katie. And if they can't get from New Jersey to New York and back, well, it's going to be hard to get to the office.
Yeah, New Jersey, it's trying its best, but did it give a reason why?
Are they?
Like, why have delays picked up? Is this a labor issue? What's going on?
No, I mean, there's some unplanned things. There are some outages. It's actually interesting that you say that because New Jersey Transit pushed back and said, if you take out Amtrak and other preventable delays from the calculations, the on-time rate was actually 94.1% in July and 95.8% in August. So, Romaine, you're laughing.
So if you remove all the things that actually affects on-time delivery, they're totally on time here.
This reminds me of like adjusted EBITDA or adjusted earnings per share,
core
right?
Inflation.
Yeah, it's like if you just play with these numbers and remove those one-time events, delays, then the numbers actually look okay.
Well, that folds in kind of neatly to what I want to talk about, which is earnings, because over the past few seasons, companies have been talking about inflation, they've been talking about recession, but Bloomberg actually crunched the numbers. There's a new word that companies have been warning about on earnings calls. It's geopolitics. Apparently, if you look into it, S&P 500 chief executives have used the word geopolitics almost 12,000 times this year. That is almost 3 times as much as they did just 2 years ago, and it really tells you a lot about the global economy right now.
Yeah, I guess this isn't surprising. Given all the ructions, of course, with the relationship between the U.S. and China, the potential rise of India, the war in Ukraine with Russia, and of course, whatever the heck is going on with Taiwan, North Korea, and some of the other states here that we have to deal with.
Yeah, I guess the big question is to what extent is this like a new world economic order? It's the big take. It's what we're focusing on in the first part of our show today as well, guys. Bloomberg Economics crunched the numbers and found that of the $1.2 trillion in greenfield foreign direct investment invested in 2022, close to $180 billion shifted across geopolitical blocs from countries that declined to condemn Russia's invasion to those that did, according to the analysis. So does that stick? And also, how porous is that?
And we'll also see, we talk so much about supply chains, onshoring, friendshoring. It just feels like there's a lot of fundamental shifts that are going on in the economy right now. And Tim, to your point, how sticky is this? Once you start to shift your supply chain, it's pretty hard to undo that.
Yeah, absolutely. And it'll be interesting to see how long this continues, right? In the next earnings season, which is just around the corner, do we actually see go from 12,000 mentions or whatever you said, Katie, to, I don't know, something higher?
1 million?
Maybe
that
just
would be something.
Adjusted EBITDA all over again. That's what we're going to be focusing on, community adjusted EBITDA. Guys, that's going to do it for now. When I come back, Carol's going to be back here with me. So
do
don't
you promise?
Worry. Yeah, I promise. Okay. We'll be back again live on TV, radio, and YouTube on Bloomberg Quick Take, 4 p.m. for our Beyond the Bell coverage. We're going to take you through today's market close.
We continue to count you down to the close here on Bloomberg Television. We should point out here, volatility really starting to pick up in all of the markets across the board. We saw it in commodities early, including in equities, and now in the Treasury space. Your 10-year yield, 4.3586 and change at one point just a few minutes ago, actually hitting its highest level since 2007. Sonia Meskin joining us right now, Bank of New York Mellon's head of U.S. macro, to help us count you down to the close here on this Fed Eve. Is this a spooky eve, or should we maybe be encouraged about what we're going to hear tomorrow?
Well, to your point just earlier, if you've tortured the data long enough, it will confess to anything you'd like, and the Fed is expert at it as an organization.
Yeah, I mean, what exactly is, I think, what are you expecting to hear, or what do you want to hear more importantly? We know they're not going to change policy, at least that's what's been telegraphed for tomorrow here. But we are going to get some economic projections, and we're expecting some pretty significant revisions there. And of course, then Powell has to come out and jawbone the market to do what he thinks he wants the market to do.
Exactly. And, I wonder, on the one hand, I think they really want to sort of watch for how the economy evolves into the end of the year and early next year. On the other hand, they clearly have to upgrade their growth expectations for the year, their inflation expectations for the year, and downgrade unemployment. And all of that points to at least one more hike this year and more hawkish dots into 2024. So he's going to have to, play that message really carefully on the one hand, as far as the fears that potentially they will over-tighten in 2024. On the other hand, he can't just stay, on message that we're just here, waiting and watching when they're upgrading the projections.
How much are those over-tightening fears a real risk in terms of what could happen? Because we were talking about this yesterday. You look at the last few rounds of jobs data in particular, you see a cooling. But how worried are you that that could turn into something maybe more destructive?
Well, I think we're in a bifurcated market now. We do have higher rates that I do think is weighing on stocks other than major tech stocks. So this rally in stocks has really not been that broad and is having a tough time broadening out precisely because rates are high. So rates may bite in some sectors more than in others. And at what point this spreads to the rest of the economy and results in massive layoffs is a really hard thing to time.
Well, I want to talk about that a little bit more. The fact that you do have higher rates biting in some areas of the market, but not in big tech. And I mean, when I grew up, people told me that it's big tech that suffers when you have interest rates go like that. When does it start to hit big tech, if at all?
It's a great question. I do think AI is playing a big role here, and expectations for growth in big tech have just been ratcheted up. So I think the market is pricing in a significant growth over at least the next 5 years for these companies, which is making them much less, sensitive to higher rates.
Is the type of growth that we see in those companies, and more importantly, what's being priced into the market in terms of growth expectations, is that synced up with economic reality?
It may or may not be, because one of the questions for AI is how quickly it gets, it becomes accessible to small to medium-sized enterprises. Right now, it's all still in big tech, and estimates around that vary really widely.
Are we setting up for a massive reality check here? Because, I mean, looking through the last earnings season, I feel like the message was that AI, it's going to take a while to translate into the bottom lines of these companies for them to actually accrue the benefits of that. And when you think about how much optimism is priced in, are we just setting up for an accident here?
I think what could potentially happen, to your point, is that rates may begin to bite a lot more next year for corporates that don't have these optimistic growth expectations priced in. So everyone who needs to refinance into a higher rate environment in 2024 is really going to feel the brunt.
I want to get your thoughts before we let you go here, Sonia, about what we've been seeing in the commodities space. Obviously, the big jump in oil prices, somewhat moderating today here. When does that become a concern for the Fed? I know Powell is very quick to point out the Fed doesn't really control energy prices. They would love to just ignore it, but real people, as I'm sure you know, can't ignore higher energy prices.
Absolutely. Yeah. I think the longer energy prices stay higher, the more this starts feeding into input costs across the board, both goods and services. And of course, you have to incorporate that into your projections. We did have the shale revolution in the last business cycle that really suppressed energy prices. And if you look at how break-evens reacted, they also moved to the downside pretty sustainably with this shale revolution effect. That's no longer the case in this cycle.
All right, Sonia, really appreciate that preview of that big Fed decision tomorrow. Our thanks to Sonia Meskin of BNY Mellon. Now, Coming up, we're going to talk with Kendra Scott, founder, executive chairwoman, and lead designer of the Kendra Scott jewelry brand, and get her insight on the health of the consumer.
Plus, we're going to check in with the latest stock to pop here. Maple Bear, the share is up about 20% here. Selling shares at $30, opening at 42. Katie Greifeld, though, a little bit down here at 36, right as we move closer to the close.
Still up 20% or so, and we're going to count you down to that closing bell with Urian Timmer, Fidelity Investments Director of Global Macro. All that and more coming up. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
About 45 minutes until we get to the closing bell. Take the price action today with a bit of a grain of salt. Similar to yesterday's price action, it's a market kind of in relative stasis right now. There are some individual stories that are moving stocks higher, and in some cases, in the case of Disney, moving them lower. But overall, this is a market waiting for, well, one person, Jay Powell. The big Fed decision is at 2 p.m. Washington time tomorrow. The press conference right around 2:30 here. And what he says, and more importantly, what those economic projections out of the Fed say, are going to be a big determinant here of the type of price action that you see post-Fed meeting. As of right now, we're basically in a holding pattern for most of the major indices, down fractionally on the day, though we should point out volatility is elevated, particularly when it comes to the yield space here. You have your 2-year yield right now camped out around 5.1, and your 10-year yield just a few minutes ago actually hitting the highest level since 2007. NYMEX crude has also had an incredible ride here. At one point on the day, it was flirting with $94 a barrel, though it's peeling back just a little bit down around 91 here. But the damage is done here, Katie. The market setting us up here for what we're going to learn in about 23 hours' time. Not only what the Fed does, but more importantly, what they think of economic conditions.
And Romaine, looking past the Fed decision, falls just a few days away, which means we're pretty close to the rush of holiday shopping that comes with it. And that's theoretically good news for the jewelry industry, and particularly for brands like Kendra Scott. Of course, this brand, it offers quality designs at what it says at an affordable to mid-range price. And we welcome now Kendra Scott to the show. She is founder, executive chairwoman, and lead designer of the Kendra Scott jewelry brand. Kendra, it's great to have you with us. And before we get to the holidays, I want to talk a little bit about this inflationary environment that we're in. We've seen plenty of sectors of the retail industry hold up to it, particularly skincare. How has the jewelry business been faring?
For our customer, we've really been able to look, first of all, we're aware of it, right? And we always want to bring value to our customer. And so we're really thoughtful about how are we going to do that? We know that she's hurting right now in other areas. So we've been really, trying to stay true to what our pricing has always been. Great quality at an attainable price point. And, you look at our customer base and we have such a diverse customer. I mean, 82% in the United States makes under $100,000 a year. That's over 50% of our customer. And that customer base, we continue to bring her value. And I think that's going to be really important this holiday season, especially, moving forward.
Well, talk to us a little bit about the upcoming holiday season and how it might be different from past ones. When you think about coming out of the pandemic, obviously things got a little bit skewed. Inventory was an issue for a lot of retailers. How has it been at Kendra Scott?
Well, one of the things, fortunately, we started to do early in 2018 is we really started to diversify our manufacturing. We started to go into other countries. We were, very much in China for a while. Now, less than half of our manufacturing is done in China, and we're diversifying to India, North America, Vietnam, Thailand, even Mexico most recently. So I think that's been really important, and that's been able to get ahead of some of these supply chain issues that you see a lot of our competitors or even other fashion brands dealing with. So that diversification was key, and thankfully we did that ahead of the pandemic.
I am curious. I mean, you've been around long enough, Kendra, at least with this business, to kind of see different business cycles. And I mean, who knows what's going to come tomorrow, but there's obviously a lot of talk about softness in the economy, maybe even the potential for a recession. How does a jewelry business hold up if you have the consumer maybe backed into a corner?
Romaine, I love to tell this story because my company went through lightning in a bottle growth during the recession, the 2008 recession. And it really was one of those times where we realized that us making this direct connection to our consumer, which we had, and this attainable price point, this value that she wanted, really helped us accelerate. So we actually grew double-digit growth in 2020 to 2021 during, again, a really uncertain time within our economy. And I think that's really important for, businesses out there to understand is that you've got to really, meet your customers, one, where they're at. You can never be complacent. I think for us, we always put connection before transaction. During the pandemic, we were reaching out to our customers, whether that was via phone or FaceTime, to try to still service her. And we're always being creative with how we're going to connect with her.
I am curious, too, about the journey that this company has been on. It's pretty rare to have a company start up in a space that is already dominated by big players like Signet and others and actually gain a foothold. The only example I could think of is actually in the sports apparel where Under Armour kind of came out of nowhere and basically challenged Nike and Adidas in a way that I don't think anyone has. Is there sort of a pathway, I think, for, I guess, the next Kendra Scotts, if you will, whether it's in jewelry or in other areas, where they can also sort of go up against the big guns in this industry and find their own footing?
I think it's really important for anybody, right, whether it's jewelry or any industry, that you are, filling a white place in the market. For me, when I started out, there was fashion jewelry and there was bridge jewelry. And there really wasn't anything in between those two categories that gave customers the quality they wanted, but that they could still afford and figure out how to purchase. And so we kind of carved this path within the jewelry industry that was a very unique space. I think when you're looking at anything out there, right, what you're going to do, you've got to fill that white space. Second, you have to be disruptive. We have all of our own unique shapes. We create our own unique colors and stones and materials that we use are very identifiable to our brand. And that was something that no other jewelry company was doing or can do in this price point, or that I've seen do, I guess, in this price point. So I think both of those elements are extremely important if you want to be successful in business today.
And Kendra, we only have about 30 seconds left with you, but I'm curious about how people are buying jewelry. What divide do you see right now between brick and mortar shopping versus people buying online?
So about 50% of our business is in our retail stores. We actually are opening 9 retail stores this year, which is really exciting. A lot of people were saying, oh, it's the end of brick and mortar, but that is totally not true at Kendra Scott. For us, it's an experience. Our customer comes in because they're craving human connection. And that's something that we're seeing more and more of, especially post-pandemic. Those customers want to be able to be there with their friends, have experiences. 30% is still shopping on e-commerce. Some of them are coming for curbside delivery just to see their favorite folks at our stores. But regardless, again, we're meeting her where she is. And then 15% of our customers are shopping with other retailers in our wholesale division of our company. But we really see that our customers, they want that connection with each other and with our Kendra Scott family.
All right, Kendra, going to have to leave it there. Great to catch up with you. Great conversation. Kendra Scott, of course, she's the founder, executive chairwoman, and lead designer, of course, of her namesake company, Kendra Scott. Katie, you're very familiar with her, and I think the world has become familiar with her. I'm just fascinated by how fast this business got built, and obviously she's already seen some challenging times, as she mentioned, with the global financial crisis, and who knows where we're headed next.
I know. It's a really interesting history there, and I think that's a great point that you made. It's not often that you see an upstart really challenge some of the incumbents in a successful way.
Yeah, absolutely here. A lot more coverage coming up here on Bloomberg. Going to talk a little bit about Disney and their parks, planning on doubling its park spending over the next 10 years. I thought they were pulling back on the parks.
Apparently not.
I don't know what's going on over there. We're going to find out after the break. Stick around. This is Bloomberg.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Walt Disney is nearly doubling its investment in parks and resorts over the next 10 years to $60 billion. And Romaine, we spend so much time talking about the streaming business, but Disney said that it's seen record growth in customer spending at parks over the past 2 years.
Yeah, it was interesting. When Iger took over, remember, there was a little bit of a scale back of some of the initiatives that Chapek had taken with the parks, like the Star Wars themed hotel and a few others. And it raised a lot of questions. Are they kind of scaling back there? Because I feel like this is just like the ultimate cash cow, right? I mean, people, it doesn't matter what they charge. People pony up, they go here, spend thousands of dollars to stand in line.
Yeah, I mean, going to Disney as a child in America.
This is the emptiest you'll ever see this park. This must have been taken at like 3 in the morning or something.
Right, in 2020.
Right.
But yeah, it's like a rite of passage as an American child that you go to Disney.
Yeah.
And of course, it's a significant part of their revenue. So a nice reminder to think about parks when you think about
What percentage of revenue do you think parks is?
We just looked this up, 33%. This is Bloomberg.
given that we have this productivity enhancing technology that is AI, that has come off the back of this transformative communications network that's the internet, and we have a fundamental shift in the way the energy system is working, so there could be the ingredients of a pivot point of a kind that we've only seen a couple of times previously in history.
But let's ask what the driving forces will be. The world is propelled forward and has been for thousands of years by great power competition. That is the thing that drives innovation right now across the board. It is a competition which is intensifying between two superpowers, the United States and a communist-led superpower. Now, is this starting to sound familiar?
It does.
So what is really significant about this historical moment is that we are in the first inning, the early phase of Cold War II.
Right.
And that is going to drive all the things that we've talked about, and it will not necessarily drive these changes in directions that are benign. That the big technological advance of Cold War I was, of course, nuclear weapons. And the arms race with nuclear weapons was an extremely dangerous one that very nearly blew the world up, particularly in 1962, at the time of the Cuban Missile Crisis. I don't believe for a minute that we can have a Cold War II without a similar risk.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is the countdown to the close. About 30 minutes until we get to those closing bells, and about 22 and a half hours, Katie, until we get to that Fed decision.
And in anticipation, you have the S&P 500 lower right now by about 0.3%, so a pretty muted loss all told, which means it's a little bit surprising that you have nearly every sector in the red right now.
What's going on with healthcare?
I don't know. It's really fighting to stay green right now, flipping in and back and forth. We'll call that unchanged. You go down the list, though, you have communication services, technology down slightly. You go all the way down industrials, consumer discretionary, and energy, off by more than 1%. This time yesterday, I believe it was the biggest gainer on the day, but currently the tables have flipped, biggest loser on the day.
Yeah, let's check in on some of the individual movers here. I actually start at the bottom here with Elf Beauty, down about 8%. In fact, it's on an 8-day slide here, longest daily losing streak for the company going back to early 2020. I reached out to Bloomberg Intelligence analysts to ask what this was all about. They said there's no real fundamental news here, but we've been seeing a lot of softness in that space. Keep an eye on names like Coty and Ulta Beauty, also seeing some softness there as well. Meanwhile, SIBO actually rallying today, this on the back of losing CEO Ed Tilly, being pushed out here because of his failure to disclose some personal relationships that he had with employees. They've named a new CEO in the interim. Shares moving a little bit higher on the back of that here. And let's check in with ARM Holdings on a day where we get a new IPO in Instacart, which we're going to talk about just a bit. ARM down now for a third straight day here, down 5%, and at $55 is actually below that opening price that it had on the day it came to market, which I think was around $56.10 here. So not quite the best signal here for the secondary trading that we're seeing in that name. And a wild story on Microsoft here. Apparently the company uploaded a bunch of files to a federal court. This has to do with the case that it's part of now. It was a mistake, but what we learned in that report was, well, a lot of company secrets that I don't think they wanted to get out, including plans for a new Xbox refresh at the end of 2024. And we learned in that same leak that the company actually looked into buying Nintendo back in 2020. Ultimately, it passed, and of course, it then a couple years later made a big bid for Activision Blizzard, which is still struggling to close. Meanwhile, there's been a lot of activity in the oil market here, and a lot of concerns right now about whether we could see oil prices continue to move higher. A bit of a reprieve here on this day, but when you look at the time spreads here, you're still seeing WTI as well as Brent crude in backwardation. That's a signal that yes, supply is tight, and if supply is tight, particularly in this demand environment, that could potentially mean, Katie, that prices could go higher.
Well, let's turn back to Instacart, which, of course, you mentioned, Romaine. It's our stock of the hour. And, of course, Instacart, it made its market debut earlier today. And our own Katie Roof has been all over this story. And, Katie, you take a look at Instacart shares. We got as high as 43% higher. You take a look at trading right now, Instacart still up 15%. But it looks like some of that initial enthusiasm is starting to fade a little bit.
Sure, yeah. They had a very big pop. Now it's a more modest pop, but you know, they priced at the top of the range, and that range had been revised above from where it had been before. So you know, they're doing better than they initially hoped. You know, much ado has been made about how in 2021 they were valued at $39 billion, and where they're trading now, maybe it's $12 billion, $13 billion, depending on whether you use the fully diluted market cap or not. But they knew that they had gone down in value. They knew where the market was, and they lowered their own internal valuation to $13 billion last year. So it's about in line with that.
So give us a sense here, Kate. There's been a lot of talk. I mean, at least for people who want to sort of assess what the longer-term future of this company is, there's been a lot of talk about the data that they collect and how they've leveraged that into effectively having this side business, if you will, as an advertising company. That's something that some folks seem to think could become their primary business.
Yeah, I mean, obviously the data they have is really valuable for advertisers, particularly those in the food space. They know a lot about what their customers like to purchase, and so they've been able to grow their revenue streams beyond just their core delivery model, and that's also helped them turn a profit.
So there's been a lot of talk as to whether this means that sentiment in the market has shifted, Katie, whether there's going to be an opening now for other companies to sort of rush through the door and bring their companies to market here. Obviously, Katie Greifeld, the other Katie, excuse me, has been talking all day long about Birkenstock. And of course, there's another company that I'm told is supposed to price potentially this week.
Yeah, so Klaviyo is a tech company out of Boston. They do marketing tech, and they're pricing officially after the bell today to go public tomorrow. And they're actually about the same size as Instacart. I mean, you know, we're expecting a $10 billion company or more. And they get a little less attention, though, because they're not consumer-facing, but certainly this will be a big win for the early venture capitalists in this one.
And so it's interesting, if you look at ARM, if you look at Instacart, both of those companies actually lined up big investors heading into the listing to support that listing. Is that the new playbook here, to kind of try to stack the deck as much as you can?
It does seem like there's a pattern here. I mean, obviously, all three of these companies are in distinct categories within tech, but they all are profitable, and they all lined up big anchor investors. So, and they're all working with Goldman Sachs. So it seems to be that there was some sort of strategy that they're looking to make sure that these companies, you know, have a safe debut, because you know, the last thing the bankers need, the last thing the tech industry needs is for the window to close again. I mean, there haven't been any big tech IPOs since late 2021, so everyone who's in this space is rooting for these companies.
Well, that's the thing. Of course, there's a lot of optimism that maybe this is the sea change where you start to see some of those companies waiting in the pipeline actually come to market. But put this year up to this point into context for us. Just how dry has the IPO market been?
I mean, you see a lot of companies, a lot of tech stocks down 70, 80, 90%. So that has really scared a lot of tech companies from going public. So, I mean, this year, there have literally been no big tech companies up until now. There were none last year braving the IPO window. I mean, there have been a few smaller SPACs, but investors have really soured on that as well. So, I mean, this is the moment where they're trying to open the window.
All right, Katie, great reporting as always. Know you've been a busy woman. Our thanks to Bloomberg's Katie Roof. From New York, this is Bloomberg.
does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Welcome back to The Close. It's time now for our Options Inside segment. And we want to get you up to speed with the day's options trading with Abigail Doolittle, who's standing by with a look at the equal-weighted S&P 500 and why it could be a worry for stock bulls.
It's interesting, Romaine, because this year we do have the equal-weighted S&P 500 up 3 to 4%, the regular S&P 500, including those big mega-cap tech stocks such as Apple, Microsoft, Tesla, and so on, up 15%. The question is there a catch-up trade, or is the equal-weighted index signaling something to big cap? To talk more about this, let's bring in Mark Newton, head of technical analysis at Fundstrat. Great to have you with us back again, Mark. And a lot of people, I love catch-up trades. When you see that difference between whatever, like the two markets that you're comparing, often it does create a nice catch-up trade to the upside. However, it can also be to the downside. Which way do you see this going? Because that spread at some point should narrow.
Thank you. Yeah, I think eventually we ought to see technology start to deteriorate. We haven't seen that yet. The issue is that we've seen pretty rampant underperformance in groups like discretionary and industrials. Most of the consumer sector has been under tremendous pressure in recent months. So you can look at this two ways, as you mentioned. One is that the equal-weighted has underperformed the regular S&P. That also means that tech has dramatically outperformed. So that outperformance in technology has caused the equal-weighted index to actually underperform. My thinking is it's going to be difficult to make money in groups like financials, I think, with an inverted yield curve, and my analysis says that should be under pressure. But discretionary clearly looks to be an underperforming sector. There are areas that I want to overweight, like industrials. I do like technology, but I feel like the consumer area should be avoided. So I don't know if there's any clear-cut conclusion saying that tech has to roll over, or that the other equal-weighted has to rally. Right now, it's just something to be aware of. That, look, the last time this happened was really back in 2021 when equal-weighted indices fell substantially, and we were waiting, and tech held the market, and it really camouflaged the entire rally until the market fell.
Well, I'm guessing that tomorrow's Fed meeting and then one in November could be crucial because a lot of it having to do with rates, and if the right. Fed is to indicate or they do actually raise rates again, that could, of course, take money out of the system and pressure technology. And if you think discretionary is under pressure, it's kind of interesting because on the year, it's one of the top sectors at more than 30%, so we could really see something. Volatility, so we're starting to see it. I feel like we're starting to see it creep back into the markets. That's measured by the VVIX, which is relatively high. But you make a really interesting point that just over the last few weeks, the VIX is starting to creep higher relative to the VVIX. Right. Does that mean that we are going to see a big spike in vol finally?
I think that's right over the next 1 or 2 months. I think it doesn't necessarily have to happen in October. A lot of my cycle work says November is actually a key month. But whenever you see the spot VIX start to elevate versus the VVIX, the VIX of the VIX, oftentimes that brings about volatility. And it's very difficult to analyze the VIX VIX technically, as people know. But looking at that ratio between VIX to VVIX, that gives you very clean signals oftentimes on breakouts or breakdowns. And it broke out actually in late July out of a multi-month downtrend. So my thinking is the VIX will in fact go higher. We're ahead of this crucial time ahead of the Fed. The VIX was up near 18.5 last month. Now it's down at 14.5. So I think it makes great sense from a risk-reward standpoint.
So you mentioned July, and that, of course, reminds me of when the dollar started to break down and then quickly reverse higher, which has put so much pressure on a variety of asset classes. One asset class that has not put pressure on, though, it's so interesting, is oil. Oil is just screaming higher. This stealth rally up 25, 35, I think 35% actually since its low earlier this year. Chart-wise, though, it looks like it may not last. Where do you weigh in here?
I agree that in the short run, it's gotten overdone. I'm very bullish intermediate term on crude over the next 12 months. I think near term, though, it's not going to get above 100. That's everybody's thinking. Oil has to get above 100. I don't think that's true. It has gotten a little bit overdone. I see evidence of market exhaustion. There's huge backwardation now where, 1 year, spreads in crude is almost like 11 points lower on the back end. So I'm seeing evidence of exhaustion where I think it's going to dip down to the low 80s and probably eventually entering this seasonally tough time for crude. It might actually get to the 70s, but that would be honestly a very good time to buy. So intermediate term, I do see crude heading back up well above 100. I don't think it's going to be this year.
And how do you play that through options and tie the dollar into this?
Yeah, I just would look at simply just taking, for example, December crude futures, that expire actually in mid-November. I would look to buy puts on the 90. The 90 strike, and you can buy those right around $4 right now. So I think that makes a lot of sense. I think crude will pull back to the low 80s potentially over the next month, and so that would make great sense just from a traditional, not based on vol necessarily, but just based on directionally and where I think crude is going to go.
So maybe an opportunity for the bears on oil over the next month and a half, and then maybe a nice opportunity for the longs thereafter, and it's going to be interesting to see how the dollar plays into it.
That's correct.
Mark Newton of FundStrat, thank you so much for joining us for Options Insight today. We really love your analysis, as always.
Thanks, Evan.
From New York, this is Bloomberg.
What do you have for skincare for men in their 70s that have a lot of wrinkles? I mean, is there any way to get rid of the wrinkles?
I have a lot of amazing things,
Really?
but maybe it'll be a little bit beyond skincare.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is the countdown to the close. Romaine Bostick here, joined right now by Scarlett Fu. She joins us, of course, every day at this time to help take us to the bell and beyond here on the eve of a big Fed decision.
Yeah, and this is a Fed that's expected to remain on hold, so it's kind of surprising how big the sell-off is in bonds. And at one point, the S&P 500 down 0.8%. Some pretty big moves for what's going to be a pretty lackluster Fed decision.
Well, that decision is going to be lackluster, but I think everyone's so focused on this idea, are we going to get something telegraphed out of the Fed, either in those economic projections or in what Jay Powell says, to suggest that there might be more hikes to come.
Exactly. What's to come is the big question here. And of course, we're looking at a two-year yield now above 5.10%. Is the next stop 5.11%, which is what we saw in early July? That's a big question. Dollar not doing very much, but oil's move higher is a reminder once again of the vigilance that Powell and the Fed need to keep inflation from reigniting.
Yeah, of course, a pocket of the market, the economy, I should say, that he makes clear that Fed policy itself cannot move.
Yeah, and of course, there's a lot of excitement over the newest IPO, right? Instacart, rising as much as 43% on its trading debut. It's pulled back quite a bit, but certainly that's something that people in the markets want to see to get those animal spirits going. And Pinterest, I know that we always talk about Pinterest and, we're not quite sure who uses it. Teenage girls use it. That company reiterating third quarter revenue growth in the high single digits.
All right, let's get to our next guest here as we count you down to the close. Urian Timmer joining us, Fidelity Investments Director of Global Macro here. And Urian, I guess let's start with the macro. And I think what's on everyone's mind right now is, are the global central banks, whether we're talking about the Fed, the ECB, and I guess some of the other far-flung ones there, are they really at the end of this rate tightening cycle?
I think they are. Whether the Fed goes another 25 later this year, obviously no one's expecting them to move tomorrow. So I do think we're getting close to the end, but I think the big question rightfully in the market is, how long is it going to stay at these levels, right? The market has been incorrectly anticipating a pivot happening imminently, really for the last year plus. And at first it was down to, 3 and even below. Now it's down to the high 3s. But I think the Fed has been correctly signaling that they're going to be higher for longer. Inflation is coming down, but it's not down to the levels where the Fed would like it to be, and the base effects are in the rearview mirror, right? We saw the CPI actually ticked higher last month, and the core PCE remains at 4.2%, which is twice the Fed's target. So I think the Fed, what we're all going to be looking at with the FOMC meeting is that dot plot. How quickly are they going to revert back to a neutral rate, and what is even the neutral rate, these days anyway? Is it 3? Is it 4? Is it 5? And that's been a big question nagging the market as well.
Yeah, nagging the market. I guess it's kind of pick your own adventure here, Urian. You know these sort of market cycles well, and you have a market, of course, looking for some clarity out of a Fed that probably isn't going to give them that clarity. And one thing I love about you, Urian, you put out these notes every week, these kind of a look at the week ahead, if you will. And your latest one sort of references an old movie that a great movie, I should point out, that old Darren Aronofsky movie called Pi, coming up against the 25th anniversary of the release of that. And what's so great about that movie, this was really about one person really trying to make sense of the world, basically trying to place order on a world of chaos. And I kind of feel like we're seeing the same thing right now play out in the market when it comes to trying to divine the next moves of central banks.
Yes, and by the way, that was a great movie. And actually, I saw the 25th year anniversary re-release on IMAX on Pi Day in March. So just a piece of trivia there. But he was trying to solve the market puzzle. And of course, some puzzles are not meant to be or able to be solved. But, when we think about investing is making real-time decisions with imperfect information. And this is why investing, at least over short horizons, is so tricky, because the market's always anticipating the future, not always correctly, of course. Markets are very efficient in absorbing information and discounting it, but there are still a number of assumptions out there, right? So one of them is, how do we know our star is really 1%, which is what the Fed model says, because our star is not an observable actual market rate. And then I think the bigger question is, inflation is at 3.5%, 4%, depending on which headline measure you look at. The TIPS market, on the other hand, seems to be convinced that inflation is going to drop to 2% imminently and stay there basically for the next 30 years, right? If you dissect the TIPS forward market from 1 year to 30 year, it's at 2 to 2.5% during that entire term structure. And hopefully the TIPS market is correct. I mean, wouldn't that be great? And I think the TIPS market is betting on, don't fight the Fed. If the Fed wants 2 to 2.5, the Fed's going to get it one way or the other. But it's all assumptions, and that's why this is such a difficult puzzle to solve.
Right, and those are market measures. I'm curious, when you say imperfect information, data points provide a lot of that information. So are there any hard economic data points that you see as less reliable and maybe require some reassessment, some reinterpretation?
It's not that they're not reliable. It's just that the market moves so quickly to discount the information that, the market, so we know that over the long term, stock prices follow earnings. But over the short term, the market discounts the future, right? And this is why at cyclical inflection points, the market's always 2 to 3 quarters ahead, which is why during early cycle bull markets, like presumably what we've had over the past 11 months or so, the market will move up even though fundamentals are still kind of weakening. Earnings growth has been slightly negative, because the market's looking ahead. And so it's not a question of whether the data points are correct, but it's just how much the market has already anticipated them and how much of that is priced in. And so right now, a soft landing is priced in. And so, we better get it then.
Okay. Well, how are you thinking about the U.S. dollar's recent strength, Jurriën? Is it a driver of stock prices and other risk assets, or is it the outcome of moves into safe havens like Treasuries or other similar assets? Is there any causation at work here, I guess?
I think it's the latter. I mean, the dollar is driven by many things, capital flows, sentiment, but one of the hallmarks of what drives currencies is, of course, interest rate differentials, right? And so what we saw during the pandemic is that all countries eased policy. They did QE. We had negative real rates, and the Fed has been leading the charge in reversing that policy. The ECB close behind, but Japan, of course, still in the other direction with its interest rate control, and China also in the other direction. So when you look at the dollar, it really depends on which cross currency you're comparing it to. But against the euro, it's been kind of even-handed, even though the euro did fall to 106 last week when the ECB raised rates. But it's against the yen and the yuan where the dollar has been the strongest. And I think we can just point to the divergences in monetary policy to see why.
All right, Jurriën, going to have to leave it there. Always great to catch up with you. Great insights as always. Jurriën Timmer there over at Fidelity, head of global macro here on what could potentially be, Scarlett, a big macro day tomorrow. That Fed decision at 2 p.m. Washington time. We'll have full coverage then. In the meantime, stick with us as we move closer to the closing bells here on this Tuesday afternoon. Our full market coverage right here on Bloomberg starts as we take you to the bell and beyond.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right Now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friend Tim Stenovic. Welcome to our audiences across our Bloomberg platforms, television, radio, as well as those folks streaming on YouTube.
Carol's here too, I promise. She's here. I don't know.
I hear like a disembodied voice of somebody, but
there she is.
Wait, she gets her own box. Wow. Wow.
Really
the star of this show.
She was not stuck on New Jersey Transit. She was not at the American Dream Mall.
Well, I was solving climate change over at the Plaza with the Earthshot Prize and Bloomberg Philanthropies. You guys, what'd you do to the Treasury market here, guys?
Yeah, blame it on Romaine.
I am going to blame it. Look at the 10-year.
This is this is that reassessment I think a lot of people are making right now about just how much further rates have to go. Remember, this isn't just about the Fed anymore. This goes beyond monetary policy. It's about economic conditions.
Well, we just had a guest on too, right, who says, wait, you look at what the 10-year yields and you look at what the S&P 500 with a yield of about 1.5%. Like you start to say, wait a minute, it makes increasingly more sense, Tim, to put money in the Treasury.
Look, that was Charles Tan, the co-CIO over of Global Fixed Income at American Century Investments, Scarlett. But I have to tell you, there's also been a change in tone that I've noticed over the past couple of weeks, and especially today. Team Soft Landing has really seemed to be winning this, but this new note from Anna Wong over at Bloomberg Economics, there's a lot of pessimism out there right now.
Well, can I just on that point though, they also put out a note, her and one of her deputies, saying that the last 4 recessions have all been preceded by this drumbeat of soft landing.
That's what I'm saying.
Yeah, you saw the same thing. Yeah, interesting report. If you have a Bloomberg terminal, I definitely urge you to check it out. The data that they put, kind of sobering here, given how much we talk about, we might actually be out of the woods.
We're all inclined to believe that a soft landing's in the cards.
Yeah, absolutely here. On this Tuesday afternoon, market's still in a bit of a holding pattern. Fractional losses across the board with the Dow down about 0.3%. The S&P and the NASDAQ each down about 0.2%, while the Russell 2000 is going to finish the day lower. Carol Masser, if you are actually there, down 0.4.
I'm still hurting from that 3 box. I'm just going to say, I'm a sensitive little gal. Hey, S&P 500, by the way, about 199 names to the upside, guys, 302 to the downside. So we definitely are seeing more of a negative tone, but, we're all kind of waiting for the Fed decision tomorrow.
Yeah, the negative tone is really reflected in the sector performances, too. If you pull up the 24 industry groups of the S&P 500, let's start on the decliners. Retailers off by 1.25%. You've got chip companies losing about 0.9%. Energy stocks down 0.8%, even though oil prices remain somewhat high at new 15-month highs. Keep in mind, energy was the best performer over the last 3 months. On the upside, those that are bucking the decline, insurance companies, autos, and tech hardware are each up by at least 0.5%.
All right, interesting. All right, so that's your big look at the markets, the big major industry groups. Enphase Energy, let's get to some of the individual gainers. It's number 1 in the S&P 500 and the NASDAQ 100 today. It's up about 4.2%. After the close yesterday, news that company director Thurman Rogers reported a series of insider stock transactions. He reported that to the SEC. It's about $4 million worth. Stock, keep in mind, is down about 10% over the past month. It's down more than 50% year to date. 8% of the float is shorted, but nonetheless, news of that insider buying certainly sending that one as a top gainer in today's